Unit 1. Securities and Markets. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 1A. Recall the characteristics of equity, debt, and option securities. Learning Objective 1B. Calculate investment returns. Learning Objective 1C. Recall the process for bringing new issues to market. Learning Objective 1D. Differentiate the types of disclosure requirements. Learning Objective 1E. Determine what issues are exempt from registration under the Securities Act of 1933. Learning Objective 1F. Define the function and procedures of securities trading in the secondary market. Learning Objective 1G. Identify transaction procedures and unethical practices. Introduction. Corporations issue equity securities, stocks, and debt securities bonds as a means of raising capital to fund activities like expanding operations or paying for a merger or acquisition. Likewise, governments may issue bonds to raise capital for public projects and pay for government programs. Investing in equity securities is perhaps the most visible and accessible means of creating wealth. Individual investors become owners of a publicly traded company by buying stock in that company. In doing so, they can participate in the company's success over time. They also share in the risk of operating a business. They can lose their investment. Investors in debt securities tend to be more conservative and generally are seeking income from their investment. Investors interested in taking an aggressive approach or hedging a position may use derivatives. Derivative securities are a broad class of investments built on a two-party contract that derives its value from a relationship to another investment or a commodity. For the Series 6, you are expected to recognize that derivatives are a broad class that includes options. However, for the exam, the questions on derivative investments will be based upon options. When a corporation or government sells securities to raise capital, they are called issuers, as they are issuing a security. The process of issuing securities is covered in Lesson 1.2. The systems that allow investors to easily trade securities with other investors are covered in Lesson 1.3. Your exam will include approximately 13 questions from the topics covered in Unit 1. Lesson 1.1. Basic Securities, Stocks, Bonds, and Options. Learning Objective 1A. Recall the characteristics of equity, debt, and option securities. Types and characteristics of equity securities. When a corporation issues equity securities, it is conservative for the issuer and risky for investors. Once the corporation has an investor's money, it has no legal obligation to provide a return. Common and preferred stocks are two basic forms of equity securities. All corporations issue common stock. When you invest in stock, you buy ownership shares in a company, also known as equity shares. Your return on investment, or what you get back in relation to what you put in, depends on the success or failure of that company. If the company does well and makes money from the products or services it sells, you expect to benefit from that success. Common stock. Common stock, often referred to as simply stock, does not have a fixed value. The value of common stock is reflected in changing investor demand in the market. One of the greatest risks when investing in stock is volatility or large price changes in a short time span. In fact, in some cases, stock prices move from minute to minute or even in seconds. However, over longer periods, the short-term fluctuations tend to smooth out to show a gradual increase, a gradual decrease, or a basically flat stock price. Example: a stock is purchased for $25 per share and the price drops $5 per share the following week because of disappointing news about a new product. That is a 20% loss. 200 shares purchased for $5,000 would now be worth just $4,000. If the stock is sold at this point, and there may be a good reason to do so, the investor will realize a loss of $1,000, growth. An increase in the market price of shares is called capital appreciation. Historically, owning common stock, with its associated capital appreciation, has provided investors with high real returns compared to other types of investments. Take note: when an investor sells a security for more than its purchase price, the profit is defined as a realized capital gain. If money is lost on the sale, the loss is a realized capital loss. If the investor does not sell the stock, the investor has an unrealized gain or loss. Capital gains are taxable only when they are realized. Growth-oriented investors must be willing to accept higher levels of risk and invest for a longer time horizon. Many technology companies are growth-oriented. They may make money, but they reinvest profits back into the company to drive capital appreciation and as a result, may not have much money left over to pay dividends. Income. Many corporations pay regular quarterly cash dividends to stockholders based upon the company's earnings. A company's dividends may increase over time as profitability increases. Dividends, which can be a significant source of income for investors, are another reason many people invest in stocks. Equity securities that often generate income include utility stocks, blue-chip stocks that have a history of paying dividends, and preferred stocks. Growth and income. Common stock may also be purchased for both capital appreciation and dividend income. Usually, the investor is willing to accept moderate risk in this type of investment. Example: 10 years ago, an investor bought 100 shares of ABC Corporation for $20 per share for a total investment of $2,000. At the time, the company's business was profitable, earning $3 per share, of which it paid $1 per share in dividends to shareholders and reinvested the rest in growing the business. 10 years later, after moderate but consistent growth, the company earns $12 per share and pays $4 in dividends per share. The stock price has consistently increased with the earnings growth and now sells for $80 per share, $8,000 total value for our investors' 100 shares. The investor has had to pay income taxes each of the past 10 years on the dividend income he received, but will only have to pay capital gain taxes if he sells the stock. If he sells the stock now, his taxable capital gain will be $60 per share, $80 current value minus $20 original cost equals $60 per share capital gain. As an additional note, the amount of earnings that a company pays out to shareholders as dividends is called the dividend payout ratio. In the previous example, the company's dividend payout ratio has maintained at 33%, 1 divided by 3 equals 33%, and 4 divided by 12 equals 33%. Preferred stock. Preferred stock is an equity security because it represents ownership in the corporation. However, it does not normally offer the appreciation potential associated with common stock. Not all corporations issue preferred stock. Like a bond, a preferred stock is issued with a fixed, stated rate of return. In the case of the preferred stock, it is a dividend rather than interest that is being paid. As such, these securities are generally purchased for income. Although the dividend of most preferred stocks is fixed, some are issued with a variable dividend payout and are known as adjustable rate preferred stock. Like other fixed income assets, such as bonds, preferred stock prices tend to move inversely with interest rates. For the exam, preferred stock is non-voting. Although preferred stock does not typically have the same growth potential as common stock, preferred stockholders generally have two advantages over common stockholders. When the board of directors declares dividends, owners of preferred stock must receive their stated dividend in full before common stockholders may be paid a dividend. If a corporation goes bankrupt, preferred stockholders have a priority claim over common stockholders on the assets remaining after creditors have been paid. Because of these features, preferred stock appeals to investors seeking income and safety. Test topic alert: preferred stock has preference over common stock in payment of dividends and in claim to assets in the event the issuing corporation goes bankrupt. Take note, all corporations issue common stock, but they are not required to issue preferred stock. The decision to issue preferred shares depends on the corporation's capital needs. Fixed rate of return. A preferred stock's fixed dividend is a key attraction for income-oriented investors. Normally, a preferred stock is identified by its annual dividend payment, stated as a percentage of its par value, which is usually $100 on the Series 6 exam. A preferred stock's par value is meaningful to the investor, unlike that of common stock. A preferred stock with a par value of $100 that pays $5 in annual dividends is known as a 5% preferred. It may also be called a $5 preferred. For test purposes, you may assume that the par value of a preferred share is $100. The stated rate of the dividend payment causes the price of preferred stock to act like the price of a bond. Prices and interest rates have an inverse relationship. In addition to the following example, an inverse relationship is presented later in this unit under debt securities. Although it is a fixed income investment, preferred stock, unlike bonds, has no preset date at which it matures and no scheduled redemption date or maturity value. Example: consider a 6% preferred. If newly issued preferred stock has an 8% dividend and you want to sell your preferred, you will have to sell at a discounted price. Why would a buyer pay full value for an investment that is not paying a competitive market rate? But if preferred dividends fall to 5%, the 6% preferred will trade at a premium. If it is offering a stream of income above the current market rate, it will command a higher price. Test topic alert. Preferred stock represents ownership in a company like common stock, but its price is sensitive to interest rates, just like the price of a bond. Features of preferred stock. Separate categories of preferred stock may differ in the dividend rate, profit participation privileges, or other ways. However, all maintain a degree of preference over common stock. One or several of the features described next may characterize issues of preferred stock. Straight, non-cumulative. Straight preferred has no special features beyond the stated dividend payment. Skip dividends are not paid to the holder. The year's stated dividend must be paid on straight preferred if any dividend is to be paid to common shareholders. Cumulative preferred. Buyers of preferred stock expect fixed dividend payments. The directors of a company in financial difficulty can reduce or suspend dividend payments to both common and preferred stockholders. All dividends due to cumulative preferred shareholders accumulate on the company's books until the corporation can pay them. When the company can resume payment of dividends, cumulative preferred stockholders receive their total accumulated dividends in arrears, before the current year's preferred dividends. Only after all preferred dividends have been paid may a dividend be distributed to common stockholders. Therefore, cumulative preferred stock is considered safer than straight preferred stock because it has a more reliable income stream. Take note, any special feature attached to preferred, such as a cumulative feature, has a price. The cost for such a benefit is less dividend income. Cumulative preferred typically has a lower stated dividend than straight preferred. Less risk usually means less reward. Example: RST Corporation has both common stock and cumulative preferred stock outstanding. Its preferred stock has a stated dividend rate of 5%, par value $100. Because of financial difficulties, no dividend was paid on the preferred stock last year or the year before. If RST wishes to declare a common stock dividend this year, RST is required to first pay how much in dividends to the cumulative preferred shareholders. RST must pay missed dividends on the cumulative preferred, as well as the current dividend, before dividends are paid on common stock. RST must pay $5 for the year before last, $5 for last year, and $5 for this year, for a total of $15. For non-cumulative preferred stock outstanding, the answer would have been $5. Only the current year dividend would need payment before common because non-cumulative preferred is not entitled to dividends in arrears. Convertible preferred. A preferred stock is convertible if the owner can exchange each preferred share for shares of common stock. The price at which the investor can convert is a preset amount and is noted on the stock certificate. Because the value of a convertible preferred stock is linked to the value of the issuer's common stock, the convertible preferred stock's price fluctuates in line with the common. Convertible preferred stock is issued with a lower stated dividend rate than non-convertible preferred because the investor may have the opportunity to convert to common shares and enjoy capital gains. In addition, the conversion of preferred stock into shares of common increases the total number of common shares outstanding, which usually decreases earnings per common share and may decrease the common stock's market value. When the number of shares of the underlying common stock received at conversion has the same market value as the market value of the convertible preferred, it is said to be at its parity price. Example: XYZ Company's convertible preferred stock, with a par value of $100 and a conversion price of $20, can be exchanged for 5 shares of XYZ common stock. $100 divided by $20 equals 5. This is true no matter what the current market value is of either the preferred or the common stock. Thus, if an investor bought the preferred for $100 per share and the common stock rises in price eventually to more than $20 per share, the preferred stockholder could make a capital gain from converting. Participating preferred. In addition to fixed dividends, participating preferred stock offers owners a share of corporate profits that remain after all interest and dividends due to other securities are paid. The percentage to which participating preferred stock participates is noted on the stock certificate. Before the participating dividend can be paid, a common dividend must be declared. Example: if a preferred stock is described as XYZ 6% preferred participating to 9%, the company could pay its holders up to 3% in additional dividends in profitable years, if the board so declares. Callable preferred. Corporations often issue callable or redeemable preferred, which a company can buy back from investors at a stated price on the call date or any date thereafter. The right to call the stock allows the company to replace a relatively high fixed dividend obligation with a lower one should interest rates decline. When a corporation calls a preferred stock, dividend payments and conversion rights cease on the call date. In return for the call privilege, the corporation may pay a premium exceeding the stock's par value at the call, such as $103 for a $100 par value stock. Take note, callable preferred stock is unique because of the risk that the issuer may buy it back and end dividend payments. Because of this risk, callable preferred has a higher stated rate of dividend payment than non-callable preferred. Issuers are likely to call securities when interest rates are falling. Like anyone, an issuer would prefer to pay a lower rate for money. Issuers call securities with high rates and replace them with securities that have lower fixed-rate obligations. Remember, when rates fall, expect a call. Adjustable rate preferred. Some preferred stocks are issued with adjustable or variable dividend rates. Such dividends are usually tied to the rates of other interest rate benchmarks, such as the Treasury bill or money market rates, and can be adjusted annually, semi-annually, or even quarterly. Practice question. Which of the following choices would be a suitable recommendation for an investor who likes to receive a fixed income but also would like to take advantage of capital appreciation if the company's common stock rises? A cumulative preferred stock. B. Convertible preferred stock. C. Adjustable rate preferred stock. D. Participating preferred stock. The answer is B. All of these provide a fixed dividend income payment, but only the convertible also provides a chance at capital appreciation, along with the common stock of the company. Test topic alert. When the test says stock, you should assume common stock. The test will specify preferred when asking about preferred stock. Types and characteristics of debt securities. When investors purchase a company's bonds and other debt securities, they lend money to the company. As the investor is a creditor of the company is obligated to pay investors back. Therefore, when a corporation issues debt, it is considered risky for the issuer and conservative for investors. Bonds have a fixed principal value, usually $1,000 per bond, par or face value. If a bond is held until maturity, the investor will get that amount back plus the semi-annual interest the bond pays during the time until maturity, unless the issuer of the bond defaults, meaning fails to pay. In addition to the risk of default, investors also face potential market risk if bonds are sold before maturity. For example, if the price of the bonds in the secondary market, or what other investors will pay to buy them, is less than par and the bonds are sold at that point, the investor may realize a loss on the sale. The market value of bonds may decrease if there's a rise in interest rates between the time the bonds were issued and their maturity dates. In that case, demand for older bonds paying lower rates decreases. If sold at that time, investors potentially take that loss. Market prices can also fall below par if the bonds are downgraded by an independent rating agency because of problems with the company's finances. Corporate bonds. Corporations issue two primary types of corporate bonds, secured and unsecured. Other terms used to describe bonds are also discussed in this section: guaranteed bonds, income bonds, and zero-coupon bonds. Secured bonds. A bond is secured when the issuer has identified specific assets as collateral for interest and principal payments. A trustee holds the title to the assets that secure the bond. In a default, the bondholder can lay claim to the collateral. Holders of secured bonds do not have a specific claim on any of the other assets of the corporation in a liquidation, only those specifically pledged as collateral. If the value of those assets is insufficient, the bondholder becomes a general creditor for the unpaid balance. Unsecured bonds. Unsecured bonds have no specific collateral backing and are classified as either debentures or subordinated debentures. Debentures is another term for an unsecured corporate bond. Debentures are backed by the general credit of the issuing corporation. A debenture owner is considered a general creditor of the company. Debentures are junior to secured bonds and senior to subordinated debentures and preferred and common stock in the priority of claims on corporate assets. Subordinated debenture claims are junior to the claims of all other creditors. Subordinated debentures generally offer higher income than either straight debentures or secured bonds due to their subordination, and therefore riskier status, and they often have conversion features. Subordinated debentures are often subject to the lower ratings that classify them as high yield or junk bonds. Take note, Guaranteed income and corporate zero-coupon bonds are other types of unsecured corporate debt. Treasury securities. The U.S. Treasury Department determines the quantity and types of government securities it must issue to meet federal budget needs. The marketplace determines the interest rates those securities will pay. In general, the interest that government securities pay is exempt from state and municipal taxation, but is subject to federal taxation. The federal government is the nation's largest borrower, as well as the best credit risk. Interest and principal on securities issued by the U.S. government are backed by its full faith and credit, which is based on its power to tax. Although there is no default risk to speak of with Treasury securities, that does not mean investors can't lose money. Government securities trade in the secondary market, over the counter, and are subject to interest rate risk just like other debt securities. These are the Treasury securities you should be aware of for your exam. Treasury bills, T-bills. These mature in 1 year or less, so they are, in essence, a very liquid cash position. Treasury notes, T-notes. These mature in 2-10 years. Treasury bonds, T-bonds. These mature in more than 10 years. Treasury inflation-protected securities TIPS. A type of Treasury issue known as TIPS helps protect investors against purchasing power risk. They are issued with a fixed interest rate, but the principal amount is adjusted semi-annually by an amount equal to the change in the Consumer Price Index, the standard measurement of inflation. These issues are sold at lower interest rates than conventional fixed-rate Treasury securities because of their adjustable nature. Treasury strips, separate trading of registered interest and principal of securities. The Treasury Department has its own version of a zero-coupon bond known as Treasury strips. The Treasury Department designates certain issues as suitable for stripping into interest and principal components. Banks and broker-dealers perform the actual separation of interest coupon and principal and trading of the strips. Strips are a type of zero-coupon bonds. Take note, the longer the maturity, the greater the sensitivity to interest rate changes. Therefore, Treasury bonds have the greatest volatility when interest rates move up or down. Government agency securities. In addition to the U.S. Treasury-issued securities, e.g., T-bills, T-notes, and T-bonds, the U.S. Congress authorizes certain agencies of the federal government to issue debt securities, called agency securities. Farm Credit System, FCS. The Farm Credit System, FCS, is a national network of lending institutions that provides agricultural financing and credit. The system is a privately owned, government exclamation-sponsored enterprise that raises loanable funds through the sale of farm credit debt securities to investors. These funds are made available to farmers through a nationwide network of banks and farm credit lending institutions. The Farm Credit Administration, FCA, a government agency, oversees the system. Government National Mortgage Association, Ginnie Mae or Ginnie Mae. The Government National Mortgage Association, Ginnie Mae, is a government-owned corporation that supports the Department of Housing and Urban Development. GNMAs are the only agency securities backed by the full faith and credit of the federal government. Although many of these securities have a stated 30-year life, GNMAs are typically sold based on an average life expectancy because the issues are backed by mortgages, which are often retired early. When a mortgage is paid off before its stated maturity, the Ginnie Mae investor will receive back all outstanding principal of that loan at par. This early payout is called prepayment risk. Federal Home Loan Mortgage Corporation, Freddie Mac or Freddie Mac. The Federal Home Loan Mortgage Corporation, Freddie Mac, is a public corporation. It was created to promote the development of a nationwide secondary market in mortgages by buying residential mortgages from financial institutions and packaging them into mortgage-backed securities for sale to investors. Federal National Mortgage Association, Fannie Mae or Fannie Mae. The Federal National Mortgage Association, Fannie Mae, is a publicly held corporation that provides mortgage capital. Fannie Mae purchases conventional and insured mortgages from agencies such as the Federal Housing Administration, FHA, and the Veterans Administration, VA. The securities it creates are backed by the Fannie Mae's general credit. Take note, Fannie Mae and Freddie Mac are publicly owned, held corporations. They are sometimes called government-sponsored entities, GSEs. Take note, the settlement of agency-issued securities occurs regular way. Trade date plus 2 business days, T+2. These securities are generally known as asset-backed securities or, in the case of Ginnie Mae, Fannie Mae, and Freddie Mac, mortgage-backed securities. Municipal bonds, a bond issued by a form of government other than the federal government or agency of the federal government, is a municipal bond. Municipal bond issuers include states, counties, cities, townships, villages, school districts, and transportation authorities. Municipal bonds and other types of municipal debt are generally considered very safe. Only U.S. government and U.S. government agency securities are safer in terms of default risk. Of course, the degree of safety varies among issues and among municipalities. Municipal bonds pay interest semi-annually. The interest payment schedule is set when the bonds are issued. Tax benefits: the federal government, with some exceptions, does not tax the interest from debt obligations of municipalities, but any capital gains from municipal transactions are taxable. This tax-advantaged status of municipal bonds allows municipalities to pay lower interest rates on their bond issues. Municipal securities are more appropriate for investors in high tax brackets than those in low tax brackets because the amount of tax savings for high tax bracket investors is larger. Practice question: a 27-year-old client is in a low tax bracket and wants an aggressive long-term growth investment. If a representative recommends a high-rated municipal bond fund, the representative has violated the suitability requirements of FINRA. B recommended a suitable investment because municipal bond funds are good long-term investments. C committed no violation because municipal bond funds weather the ups and downs of the markets well. D committed no violation if the customer agrees to the transaction. The answer is A. The investor is young and is seeking growth, capital appreciation. Municipal bonds produce a steady income but little or no growth. Also, the customer is in a low tax bracket and will not benefit from the tax-free, but lower, returns found in municipal debt. Take note, industrial development revenue bonds are a type of municipal bond. The proceeds of the bond are used to build a facility that a corporation will lease. The lease payments are used to service the debt. The corporation's credit backs the bond. Bond ratings: the purchase of a debt security is only as safe as the strength of the borrower. That strength can be enhanced if the loan has collateral. Because safety of the bond will frequently be a very important consideration for clients, most investors consult the rating services. There are a number of different rating organizations. The following, take note, lists the ones most likely to appear on your exam. Take note, there are 3 major credit rating agencies: Fitch Ratings, Inc., Moody's Investors Service, Inc., Standard & Poor's Rating Service, S&P. You may see a reference to AM Best Co., Inc., which is historically associated with rating insurance companies' ability to pay claims and their debt issues, and though a registered credit rating agency, is not one of the majors. The most important rating organizations for the exam are Standard & Poor's and Moody's. Both organizations have highly qualified personnel who analyze all the details of the debt issue and arrive at a letter rating indicating their opinion of the debt's quality, safety. You might see reference to the Fitch ratings and should note that they follow the same pattern as S&P investment risks, including a chart of the ratings from the major rating agencies, is covered at Learning Objective 4D Volatility. Bond prices move in an inverse direction to interest rates. A bond's sensitivity to these movements is called volatility. The more a bond moves in response to a change in interest rates, the more volatile it is said to be. The less it moves, the less volatility it has. As a rule, the more time left to maturity, the more volatile a bond's price will be given a change in interest rates. With little exception, a bond with 10 years to go until it matures will be more volatile than a bond with 5 years to maturity. Secondarily, the lower a bond's coupon rate, the more volatile it is. A 3% bond with 5 years remaining will be more volatile than a 6% bond with the same 5 years left. A way of measuring a bond's volatility that combines maturity and coupon rate is called duration. A higher duration means a more volatile price. Lower duration brings less price volatility. Duration may also be used to measure the overall volatility of a portfolio of bonds. You may need to recognize the concept of duration, but will not need to calculate it. Features: bonds can be issued with different features attached. Among the most common are the following. Call feature. As noted previously, a call feature allows an issuer to call in a bond before maturity. Issuers will generally do this when interest rates are falling. From the issuer's perspective, why pay 6% interest to investors on an existing bond if current interest rates have fallen to 4%? It is better to call in the 6% bond and simply issue a new bond, paying the lower current interest rate. This feature benefits the issuer. If called the former, bondholder now has the dilemma of finding a similar rate of return in a lower interest rate environment. Put feature. A put feature for a bond is the opposite of a call feature. Instead of the issuer calling in a bond before it matures, with a put feature, the investor can put the bond back to the issuer before it matures. Investors will generally do this when interest rates are rising. From the investor's perspective, why accept 6% interest on a bond one owns if current interest rates have risen to 8%? It is better to put the 6% bond back to the issuer, take the principal return, and invest it in a new bond paying the current interest rate of 8%. This feature benefits the bondholder. Convertible feature. Much like our discussion of convertible preferred stock, convertible bonds are issued by corporate issuers, allowing the investor to convert the bond into shares of common stock. Giving the investor the opportunity to exchange a debt instrument for one that gives the investor ownership rights, shares of common stock, is generally considered a benefit for the investor. If the related stock rises in value, convertible bonds may often track the value of the underlying shares that the bondholder would be entitled to upon conversion. Investors often engage in arbitrage transactions, which involves the simultaneous buying and selling of the bond and underlying stock in an attempt to capture price differentials between the related securities. Take note, when bonds are issued with features that benefit the issuer, such as a call feature, the issuer generally will need to pay a slightly higher coupon rate of interest to make the bond attractive to new investors. Conversely, when bonds are issued with features that benefit the bondholder, such as put or conversion features, the issuer will usually pay a slightly lower coupon rate of interest because the feature will compensate for the lower return. Money market instruments, securities. Money market instruments are debt securities with short-term maturities, typically 1 year or less. Because they are short-term instruments, money market securities are highly liquid, and they provide a relatively high degree of safety because most issuers have high credit ratings. For that reason, they are ideally suited for emergencies and for taking advantage of investing opportunities. Money market securities issued by the U.S. government and its agencies include the following: Treasury bills that trade in the secondary market, Treasury and agency securities with remaining maturities of 1 year or less, short-term discount notes issued by various smaller agencies. The primary risk investors face with these types of investments, including U.S. Treasury bills and money market mutual funds, is losing ground to inflation, known as inflation risk, constant dollar risk, or purchasing power risk. In addition, you should be aware that money in money market funds offered by investment companies usually is not insured. While such funds have rarely resulted in investor losses, the potential is always there. A short list of money market instruments follows. Bankers' acceptance, BA. Certain corporations in the import-export business will often use BA as a short-term time draft with a specified payment date drawn on a bank exclamation, essentially a post-dated check or line of credit. The payment date of a BA is normally between 1 and 270 days. BA are issued at a discount to face value. American corporations use BA extensively to finance international trade. That is, a BA typically pays for goods and services in a foreign country. Commercial paper, prime paper. Corporations issue short-term, unsecured commercial paper or promissory notes to raise cash to finance accounts receivable and seasonal inventory overages. Commercial paper interest rates are lower than bank loan rates. Commercial paper maturities range from 1 to 270 days, although most mature within 90 days. Commercial paper is issued at a discount from face value. Negotiable CD, jumbo CD. These represent time deposits, which banks issue. They have minimum face values of $100,000, but most are issued for $1 million or more. Any amount issued that is greater than FDIC insurance, $250,000, is an unsecured promissory note of the bank. Most negotiable CD mature in 1 year or less, with the maturity date often set to suit a buyer's needs. Because the CD are negotiable, they can be traded in the secondary market. Negotiable CDs are different than many money market securities in that they are issued at face value and pay interest. Those issued with a maturity of 1 year or less pay all interest at maturity. Negotiable CD that are issued with maturities greater than 1 year pay interest semi-annually. Note that jumbo CD that have 1 year or less remaining until maturity are considered money market instruments. Options, calls, and puts. An option is a contract that gives the buyer a right to do something with an underlying security over time, usually a maximum of 9 months. The right will be to buy or sell the underlying security at a stated price. The seller of the contract is obligated to fulfill the terms of the contract if it is exercised. The buyer is the owner of the contract, and the seller is often referred to as the writer of the contract. An option is also a type of derivative because the value of the contract is primarily based on the value of the underlying security. Buying and selling option contracts can expose investors to elevated and even unlimited financial risk. Therefore, before an investor can open an options trading account, such an account must be determined to be suitable for the investor. An options disclosure document must be delivered before an account receives approval to trade options. This document is mostly educational in nature and reviews basic options terminology, definitions, and risks. Listed option contracts are issued in standardized formats by the Options Clearing Corporation (POC) and traded on the Chicago Board Options Exchange, CBOE, or another exchange. Because the CBOE and other exchanges provide forms to trade, and the OCC stands behind option contracts in the event of a firm's failure, options are easily tradable. Options are speculative in nature and require additional disclosure documentation, the options disclosure document discussed earlier, and additional suitability information before an account is opened. There are two basic types of option contracts, calls and puts. Each contract will control 100 shares of an underlying security. The contract includes a strike price or exercise price that guarantees the security can be bought or sold regardless of the security's market price, and the standard option contract lasts for 9 months. A call option gives the buyer of the contract the right to buy the security at the strike price, a bullish position. If selling a call contract, the seller becomes obligated to sell the stock at the strike price if the call option is exercised, a bearish position. A put option gives the buyer of the contract the right to sell the security at the strike price, a bearish position. If selling a put contract, the seller becomes obligated to buy the stock at the strike price if the put option is exercised, a bullish position. Leverage or income. Option contracts provide purchasers with leverage. A relatively small cash outlay allows an investor to control an investment that would otherwise require a much larger sum. If a stock is currently $20 per share, 100 shares would cost $2,000, but a call on 100 shares might only cost $200, $300. As the seller of an option contract, there is one main objective, income. The writer sells the contract, collects the premium, and hopes the contract expires so she can keep the premium. Take note, in a call, the buyer of the call has the right to buy. The seller of the call has the obligation to sell. In a put, the buyer of the put has the right to sell. The seller of the put has the obligation to buy. Test topic alert. The exam will have very few questions about options. You should be well prepared if you know the information in the following table. Practice question. When investors buy options, which of the following is not true? A, buying a call gives the investor the right to buy the stock. B, buying a put gives the investor the right to sell the stock. C, the buyer of a call has unlimited loss potential. D, the maximum amount the buyer of a put can lose is the premium she paid for the contract. The answer is C, the buyer of an option has only the premium she paid at risk. This is true for both calls and puts. If the stock price moves against them, they simply do nothing and allow the worthless option to expire. Non-equity options. Non-equity, currency and index, options function nearly the same as equity options. However, because the underlying instruments are not shares of stock, non-equity options have different contract sizes and delivery and exercise standards. Index options. Options on indexes allow investors to profit from the movements of markets or market segments and hedge against these market swings. They may be broad-based or narrow-based or based on other indexes with a particular focus. Broad-based indexes reflect movement of the entire market and include the S&P 100 Index, OAKS, S&P 500 Index, and the Major Market Index, XMI. Narrow-based indexes track the movement of market segments in a specific industry, such as technology or pharmaceuticals. Some indexes have a very particular focus, such as the VIX, Volatility Market Index. This index is a measure of the implied volatility of the S&P 500 index options traded on the CBOE. VIX index options, also traded on the CBOE, are designed to reflect investor expectations of market volatility over the next 30 days. It is often referred to as the fear gauge or index. High readings are not bullish or bearish, but instead are a measure of the expectation fear that the market will be volatile. The expectation of greater volatility generally translates into higher premiums for options contracts. Index option features. Index options typically use a multiplier of $100. The premium amount is multiplied by $100 to calculate the option's cost, and the strike price is multiplied by $100 to determine the total dollar value of the index. Purchases and sales of index options, like equity options, settle on the next business day. Index options stop trading at 4:15 p.m. Eastern Time if they are broad-based. Narrow-based index options stop trading at 4:00 p.m. Eastern Time. The exercise of an index option settles in cash rather than in delivery of a security, and the cash must be delivered on the next business day. If the option is exercised, the writer of the option delivers cash equal to the intrinsic value of the option to the buyer. When index options are exercised, their settlement price is based on the closing value of the index on the day of exercise, not the value at the time of exercise. Index options expire on the third Friday of the expiration month, just as equity options do. Take note, with regard to settlement, there is one major difference between index options and equity options. The exercise of an index option settles next business day, whereas the exercise of an equity option settles regular way, 2 business days. With regard to trading, i.e. buying or selling, settlement is the next business day for both. Example: following is an example to take you through the process from purchase through exercise, or through expiry for an index option. A customer buys one OEX Jan 1460 call at 3.20 when the OEX index is trading at 1461. What is the premium? $320. 3.20 times $100. What is the break-even point? 1463.20, strike price plus premium. What is the intrinsic value? $100. 1461 minus 1460. What is the time value? $220. $320 minus $100. 1 month later, with the index at 472, the customer elects to exercise. How much does the customer receive for the exercise? $1,200. Index 472 minus the strike price 460 equals 12. 12 times 100 equals $1,200. Index options strategy. Index options may be used to speculate on movement of the market overall. If an investor believes the market will rise, he can purchase index calls or write index puts. If an investor believes the market will fall, he can purchase index puts or write index calls. Hedging a portfolio is an important use of index options. If a portfolio manager holds a diverse portfolio of equity, he can buy a put on the index to offset loss if the market value of the stocks fall. This use of index puts is known as portfolio insurance. Index options protect against the risk of a decline in the overall market, which is systematic risk. Interest rate options. Interest rate options are yield-based, i.e., they have a direct relationship to movements in interest rates. These options are based on yields of T-bills, T-notes, and T-bonds. A yield-based option with a strike price of 35 reflects a yield of 3.5%. Assume an investor believes that rates on T-notes, currently at 3.5%, will rise in the near term. The investor could purchase a call option with a 35 strike price at the money. If rates rise to 4.5%, the investor could exercise and receive cash equal to the intrinsic value of the option. Rates have gone up by 10 points, 35 to 45, so the investor would receive $1,000 because each point is worth $100. The profit would be the $1,000 received on exercise less the premium paid. On the other hand, the investor could have closed his position, profiting from the difference between the premium paid and the premium received on closing the position by selling the option. The strategy is straightforward. If a portfolio manager believes rates will fall, the manager will buy puts or write calls. If the manager believes rates will rise, buying calls and writing puts would be appropriate. Take note, all yield-based options are European-style exercise. That is, they may be exercised only on expiration day. European-style exercise options are discussed later. Currency options. Currency options allow investors to speculate on the performance of currencies other than the US dollar, or to protect against fluctuating currency exchange rates against the US dollar. Currency options are available for trading on US-listed exchanges on the Australian dollar, the British pound, the Canadian dollar, Swiss francs, Japanese yen, and the euro. Importers and exporters frequently use currency options to hedge currency risk. Currency options expire on the third Friday of the expiration month, just as equity options do. Currency option trades settle on the next business day. When a foreign currency option is exercised, settlement occurs on the next business day. Exchange-listed foreign currency options are European-style exercise only. Take note, if you are in the import/export business, which currency option should you use? If you are an exporter, you are concerned with the value of the foreign currency dropping, so buy puts. If you are an importer, you are concerned with the value of the foreign currency rising, so buy calls. To keep it easy, remember that trade is epic. Exporters buy puts, importers buy calls. Administration and compliance. The primary regulators for options are the OCC and, for trading options, the Chicago Board of Options Exchange. The OCC provides an options disclosure document, OD, which must be provided at or before the account approval. This document explains options strategies, risks, and rewards, and it is designed to provide full and fair disclosure to customers before they begin options trading. Before any trading can take place, an options account must be approved by a registered options principal (ROP) of the firm. Steps for setting up an account to trade options. A representative must believe that options are a suitable investment for a client based on the client's circumstances and objectives. The representative provides the customer with a copy of the ODD. The account is approved for options trading by a ROP. Once approved, options trades may be entered. Then, not later than 15 days after the account approval, the customer must return the signed options agreement. The options agreement states that the customer has read the ODD, understands the risks of options trading, and will honor all rules and regulations regarding options trading. By signing, the customer also agrees to advise the firm if any changes occur in her financial situation, investment objectives, and so forth, that would impact whether or not the account should still be approved for options trading. If the signed options agreement is not returned within 15 days of account approval, the investor cannot open new options positions. Only closing transactions are allowed if the options agreement is not returned as required. Take note the chronological conundrum that exists. The options account must be approved before trading can occur. However, it is possible that the account has been approved and trades have occurred, and yet the customer, having 15 days after approval to do so, still has not returned the signed options account agreement. Learning Objective 1B. Calculate investment returns. Calculate current yield. Yield is a measurement of the amount of income an investor will receive as a percentage of the cost of the investment. The term current yield may apply to both stocks and bonds. If the income is from a cash dividend from a common stock share, it is also called dividend yield. The formula, annual income in dollars divided by current market value equals current yield. Pay attention to the questions on yield. The question may provide you with the quarterly dividend. Current yield is an annual figure. You will need to get to the annual amount of the dividend before you divide. Example, ABC Corporation pays a 25-cent quarterly dividend. ABC stock is trading at $20 a share. What is the current yield of ABC stock? 0.25 times 4 for 4 quarters in a year, divided by 20 equals 1 divided by 20 equals 0.05 or 5%. Calculate capital gains and losses. Closing an open position occurs when you sell a position you own or purchase a position you sold short. Capital gains are generated from closing an open position at a profit. If you close an open position for a loss, you have a capital loss. The formula is sales proceeds minus adjusted cost basis equals capital gains if a positive number, capital losses if a negative number. Adjusted cost basis is the amount paid for a position modified by any adjustments. The effect of a stock dividend is an example of adjusting a cost basis. Example, your customers purchased 100 shares of ABC Corporation for $22 per share 3 years ago. Last week, they sold 100 shares for $25 per share. Sales proceeds, $2,500. Cost basis, $2,200. Equals $300 gain. Take note, capital gains and losses only become taxable when a position has been closed. These are called realized gains or losses. Unrealized gains or losses are calculated for positions that are still open. The formula for unrealized gains and losses is the same except that the current value of the position is used in place of sales proceeds. Unrealized gains and losses have no effect on taxes. Practice question. John purchased 500 shares of the Amazing Pizza Parlor stock for $45 a share. He later sold the stocks for $44 a share after receiving $2 in taxable dividends from a stock. John has realized a $1 capital gain. B. A $1 capital loss. C. A $3 capital gain. D. A $3 capital loss. The answer is B. John realized a $1 capital loss. The formula sales proceeds, cost basis, gives a result of negative $1. 44 minus 4 to 5 equals negative 1. Dividends are not used in this calculation. Calculate total return. Total return is a measure of the return an investor receives from an investment that includes both income and any gain or loss realized. This is expressed as a percentage of the cost basis of the investment. The formula for calculating capital gains is income received plus gains or less losses, divided by cost basis equals total return. Example, Mary Levine purchased 100 shares of Highlands Real Estate, Inc. for $20 a share. After holding the stock for 1 year, she sold the shares for $21 a share. Over the year, the company paid a $0.25 quarterly dividend. What is Levine's total return? 4 25-cent dividends is $1 in income. She sold the stock for a $1 gain, $21 $20. $1 income plus $1 gain equals $2. Divide the $2 divided by $20, cost basis, equals 0.10, 10%. Take note, a total return calculation may use realized capital gains or losses for closed positions, but it may also be used for open positions using unrealized capital gains or losses. Knowledge Check 1.1 Question 1. An investor who seeks income from equity securities and has a conservative risk tolerance might be interested in all of the following except A. Utility stocks, B. Blue chip stocks, C. Technology stocks, D. Preferred stocks. The answer is C. Tech companies are normally focused on growth and pay very little, if any, dividends. Most utility and blue chip stocks pay steady dividends, and preferred stocks are focused on paying dividends. Question 2. If a preferred stock pays a stated dividend of 6% and the issuer calls the stock, which of the following is not related to the call? A. Interest rates are probably lower than when the stock was issued. B. The investor will likely be paid at least the par value. C. Dividends scheduled to be paid after the call date are not paid. D. If a preferred stock is going to be called, it must happen on or after the first available call date. The answer is C. Callable preferred stocks and callable bonds may be called in by the issuer anytime on or after the call date. On the call date, the investor will receive the par value plus any declared dividends, but no dividends after that. Calls generally happen when rates have declined. When rates fall, expect a call. Question 3. Your 4 to 5-year-old client is interested in obtaining the highest current income possible from his investment. He is willing to accept fluctuations in investment principal. Which of the following would best suit this client's investment objective? A. High-yield bonds, B. Aggressive growth stocks, C. Tax-free money market securities, D. A balanced portfolio of stocks and bonds. The answer is A. A high-yield bond has, as the name suggests, a relatively high yield. It produces a higher yield by investing in lower credit quality bonds. Aggressive growth stocks generally have very low dividends. Tax-free securities and balanced portfolios tend to have modest dividends as well. Question 4. Secret Airlines, Inc. pays a $0.40 a share quarterly dividend, and shares are currently trading at $32 a share. The current yield for Seabird is A. 1.25%, B. 2.50%, C. 5%, D. 10%. The answer is C. Seabird has a dividend yield of 5%. A $0.40 quarterly dividend is $1.60 annually. $1.60 divided by $32, the current price, equals 0.05, 5%. Lesson 1.2, New Securities, the Primary Market. Learning Objective 1C. Recall the process for bringing new issues to market. Introduction. Understanding the process of bringing a new security to your customers is an important part of the registered representative's role. The Series 6 exam will build on the knowledge acquired for the SIE exam and expand on the knowledge as well. Bringing new issues to market. Corporations issue equity and debt securities as a means of raising capital to grow the business. They may grow by building, buying factories, stores, equipment, or by acquiring another company. In general, securities are bought either as new issues from a corporation, municipality, or the federal government, or in the secondary market as trades between investors. This section explains the process for bringing new issues to market. The Securities Act of 1933. Following the First World War, the nation began to grow, and the economies of the individual states became more unified. It became more common for an investor to be located some distance from the company they invested in. Investors had little protection from fraud in the sale of new issues of securities. Rumors, exaggerations, and unsubstantiated claims led to excessive speculation in newly issued stock. Congress passed the Securities Act of 1933 to require issuers of new securities to file registration statements with the Securities and Exchange Commission, SEC, to provide investors with complete and accurate information about the investment. This information came in a disclosure document. The most common form is a prospectus, which must be delivered before or with the confirmation. Think of the Securities Act of 1933 as the Paper Act because of the registration statement and prospectus. It will remind you of the paperwork requirements for full and fair disclosure. New securities that are subject to the Act's requirements are called non-exempt issues. Exempt securities are not subject to these requirements, but often have other requirements. Participants in a corporate new issue. The main participants in a new issue are the companies selling the securities and the broker-dealer acting as the underwriter. Issuer. The company wishing to raise the capital is referred to as the issuer. The issuer, with the help of an underwriter, must file an S-1 registration statement with the SEC, unless there is an exemption. Underwriter. A business or municipal government that plans to issue securities usually works with a broker-dealer as an underwriter, investment banker, a securities broker-dealer that specializes in underwriting new issues. An investment banker's functions may include advising corporations on the best ways to raise long-term capital, raising capital for issuers by selling new securities, buying securities from issuers and reselling them to the public, distributing large blocks of stock to the public and to institutions, and helping issuers comply with securities laws. Take note, investment bankers help issuers raise money through the sale of securities. They do not loan money. They are also called underwriters. All underwriters of corporate securities must be FINRA member firms. Types of underwriting agreements. Different types of underwriting agreements require different levels of commitment from the underwriters. This results in different levels of risk for the underwriters and the issuer. Best efforts underwriting investment banker acting as agent. A best efforts underwriting calls for the underwriters syndicate to assist their customers in buying securities from the issuer, acting simply as an agent, not as a principal. This means that the underwriters are not committed to purchase the shares themselves and are therefore not at risk. Best efforts deals are closed by collecting client funds into an escrow account, so no underwriter capital is at risk in these types of offerings. The underwriter is acting as an agent contingent on the underwriter's ability to sell shares in either a public offering or a private placement. The underwriter is not at risk for the shares, but the issuer is. If a minimum number of shares cannot be sold, the issuer will not raise the needed capital. The following are two types of best efforts underwritings to be familiar with. All or none AON. In an AON underwriting, the issuing corporation has determined that it wants an agreement outlining that the underwriter must either sell all of the shares or cancel the underwriting. Because of the uncertainty over the outcome of an AON offering, any funds collected from investors during the offering period must be held in escrow pending final disposition of the underwriting. Minimax. A minimax underwriting sets a floor or minimum, the least amount the issuer needs to raise to move forward with the underwriting, as well as a ceiling or maximum on the dollar amount of securities the issuer is willing to sell. The underwriter must locate enough interested buyers to support the minimum floor issuance requirement. Once the minimum is met, the underwriter can expand the offering up to the maximum ceiling amount of shares the issuer specified. Firm commitment underwriting investment banker acting as principal. Firm commitment underwriting is a widely used type of underwriting contract. Under its terms, the underwriters contract with the issuer to buy the securities. The underwriter buys shares from the issuer and resells the securities to the public at a higher price, the public offering price, POP, and earns this price differential, spread, for its efforts. Here the underwriters are acting as principals rather than agents. They are committing to purchase any unsold shares for the syndicate account. In this type of underwriting, it is the underwriters who are at risk for any shares they cannot sell to the public, not the issuer. If the shares cannot be sold, the underwriter must place the securities into its inventory and runs the risk of losing money should the position fall in value. The issuer knows that all of the capital needed will be raised because the underwriter has committed to purchase the entire offer. Please note that a firm may never guarantee to a customer that it will agree to repurchase the shares at the POP if the security trades lower. Registration of securities. The Securities Act of 1933 requires new issues of corporate securities to be registered with the SEC. The corporate issuer does so by filing a registration statement. Most of the registration statement becomes the prospectus. The registration process. After an issuer files a registration statement with the SEC, a cooling-off period begins. During this time, the SEC reviews the securities registration statement and can issue a stop order if the statement does not contain all of the required information. This document, called an S-1, requires that the issuer supply sufficient information about the security, the corporation, and its officers to allow an investor to make a sound investment decision. After receiving it, the SEC will review it. While it is being reviewed, during what is known as the 20-day cooling-off period, it is said to be in registration. During this time, which can be longer than the minimum 20-day period, the regulators will look for sufficiency of investment information rather than accuracy, though they do not guarantee adequacy or accuracy of the disclosures upon completion of the review. If all disclosures are met, the S-1 goes on to form the basis of the prospectus, the full disclosure document. Ultimately, it is the issuer and underwriter who are responsible for making sure everything being disclosed to the public through the prospectus is accurate. During the cooling-off period, the issuer and underwriters hold a number of due diligence meetings. Test topic alert. Permitted activities during the cooling-off period. Distribute red herrings. Publish tombstone advertisements. Gather indications of interest. Prohibited activities during the cooling-off period. Offer securities for sale. Distribute final prospectuses. Disseminate advertising material. Accept post-dated checks. Disseminate sales literature. Take orders. Learning Objective 1D differentiate the types of disclosure requirements. Preliminary prospectus. A preliminary prospectus, red herring, for a new offering carries a legend showing the registration statement has been filed with the SEC. The preliminary prospectus can be used as a prospecting tool, allowing issuers and underwriters to gauge investor interest and gather indications of interest, not orders. There is no final price included in the preliminary prospectus, though a range is often included. The preliminary prospectus must be made available to any customer who expresses interest in the securities during the cooling-off period. Final prospectus. When the registration statement becomes effective, the issuer amends the preliminary prospectus and adds information, including the final offering price for the final prospectus. Registered representatives may then take orders from those customers who indicated interest in buying during the cooling-off period. A copy of the final prospectus must precede or accompany all sales confirmations. The prospectus must include the description of the offering price, the selling discounts, the offering date, the use of the proceeds, the description of the underwriting, but not the actual contract, the statement of the possibility that the issue's price may be stabilized, the history of the business, the risks to the purchasers, the description of management, the material financial information, the legal opinion concerning the formation of the corporation, and the SEC disclaimer. Test topic alert. The SEC does not approve or endorse any offering for sale. They simply clear or release the offering for sale. The standard SEC disclaimer reads as follows. These securities have not been approved or disapproved by the SEC, nor have any representations been made about the accuracy or the adequacy of the information. Every prospectus must have an SEC disclaimer. Disclosure documents for mutual funds. Mutual funds have a number of important disclosure requirements that are covered in more detail in the lessons on investment companies. Other disclosure documents, municipal securities. The primary disclosure document for a municipal security is the official statement. It contains much of the same sort of information you would find in a prospectus. Private placements, Regulation A, and other exempt securities. The common term for the disclosure document for other types of exempt securities is the offering circular. Sometimes the term notice of sale is used. This document is very similar to a prospectus, but often not as detailed in its disclosures. Learning Objective 1E determine what issues are exempt from registration under the Securities Act of 1933. When securities are required to be registered to be sold to the public, they are known as non-exempt securities, not exempt from registration and must be registered. However, there are exemptions from the registration requirements, which we will discuss now. Exempt issuers. Certain securities are exempt from the registration and prospectus requirements of the Securities Act of 1933 because the issuer is the federal government, an agency of the federal government or a municipal government, or because another government regulatory agency has jurisdiction over the issuer. Examples of exempt issuers include the U.S. government, municipalities, national and state bank, not bank holding company, securities, building and loan and savings and loan securities, charitable, religious, educational, and nonprofit association securities, interests in common carriers, e.g., railroad equipment certificates. Take note, the bank exemption applies only to the securities of banks, not to the securities of bank holding companies. Securities issued by the First National Bank of Bigtown, e.g., common stock, are exempt. The bank is owned by the Bigtown Bank Holding Company. Inc. The holding company's securities are not exempt. Exempt securities. Some securities are exempt from registration due to the nature of the security. Examples of exempt securities include commercial paper, bankers' acceptances, and securities that have maturities of 270 days or less. Take note, insurance policies are not included in the definition of security. However, variable annuities, variable life insurance, and variable universal life insurance are funded by separate accounts investing in securities. Therefore, these products must be registered as securities with the SEC. For the exam, if you see the word variable or the phrase separate account product, the product must be registered. If the insurance product is fixed, like a fixed annuity or whole life insurance, it is not a security. Exempt transactions. Some securities are exempt from registration requirements due to the nature of the transaction. Often these are smaller offerings or have restrictions on who may invest. Regulation A. Small and medium-sized offerings. With the passage of the JOB Act, a rule was put into place that would ease the requirements for small and medium-sized companies to raise capital. Under the JOB Act, regulation provides two offering tiers for small and medium-sized companies that will allow the companies to raise capital in amounts substantially more than the $5 million previously allowed under regulation at Tier 1. Securities offerings up to $20 million in a 12-month period will be allowed. Of the $20 million, no more than $6 million can be sold on behalf of existing selling shareholders. The offering would be subject to a coordinated review by individual states and the SEC. Tier 2. Securities offerings up to $75 million in a 12-month period will be allowed. Of the $75 million, no more than $22.5 million can be sold on behalf of existing selling shareholders. These offerings are subject to SEC review only and none at the state level. Tier 2 offerings are still subject to rigorous disclosure requirements to the SEC, including audited financial statements, annual, semi-annual, and current reports. Offerings under both tiers are open to the public and general solicitation. Advertising is permitted for both tiers. However, Tier 2 investors must be qualified investors, and there are two ways to qualify. Be an accredited investor, as defined in Rule 501 of Regulation D. Definition of an accredited investor may be found in the following section on Regulation D. Limit the investment to a maximum of the greater of 10% of the investor's net worth or 10% of the investor's net income per offering. Note that self-certification for Tier 2 as to net worth and income is all that is required with no burdensome filings. Note that Tier 1 has no investment limits. Finally, remember that regulation is intended for small and medium-sized companies. The regulation specifically excludes investment companies, i.e., private equity funds, venture capital funds, and hedge funds. In a regulational offering, the issuer files an abbreviated notice of sale or offering circular with the SEC regional office. Investors are provided with this offering circular rather than a full prospectus. Rule 147, the Intrastate Offering Rule. Under Rule 147, offerings that take place entirely in one state are exempt from registration when the issuer has its principal office, headquarters, in the state and all purchasers are residents of the state. In addition, the company must meet one of the following criteria. Receives at least 80% of its income in the state. At least 80% of the issuer's assets are located within the state. At least 80% of the offering proceeds are used within the state, and the majority of the company's employees must work in the state. Also, if there is a broker-dealer acting as underwriter, the broker-dealer must be based in the state. Securities sold under Rule 147 may not be resold to non-residents of the state for 6 months after the initial purchase. Note that Rule 147 allows for offers, advertisements, to go out to non-residents, but actual sales are limited to residents. This rule was put in place to allow for use of the Internet and other technology when advertising these offers. Regulation D. Exempt transactions or private placements. The SEC does not require registration of an offering under Regulation D as long as there are no more than 35 non-accredited investors. There is no limit to the number of accredited investors that may invest in the private placement. Purchasers must have access to the same type of information they would receive if the securities were being sold under prospectus in a registered offering. The amount of capital that can be raised is unlimited. A private placement investor must sign a letter stating that he intends to hold the stock for investment purposes only. Private placement stock is referred to as lettered stock due to this investment letter. The certificate may bear a legend indicating that it cannot be transferred without registration or exemption. Therefore, private placement stock is also referred to as legend stock. The SEC requires that all companies raising capital in a non-public offering that qualify under the Regulation D exemption file the information on Form D electronically via the Internet. The SEC also specifies the instances when an amended Form D be filed, such as to correct a mistake of fact or error or to reflect a change in information. Definition of an accredited investor. Accredited investors are a subset of investors made up of all institutional investors and certain retail investors. Retail investors who are accredited investors are insiders of the securities issuer, officers, board members, major stockholders, or meet certain financial criteria, such as an income of at least $200,000 or more the past 2 years and expected to meet that criteria in the current year. If the purchase is in a joint name, this number is increased to $300,000. Or have a net worth of $1 million or more, not including equity in the primary residence, or natural persons that hold certain professional certifications, designations, or credentials. The Series 7, 65, and 82 are so recognized. Note that the investor must meet at least one of the earlier criteria, but does not need to meet all of them. The assumption is that the accredited investor will have a higher sophistication level than the average retail investor and does not need the same level of protection. General solicitations and advertising private placements. To solicit or advertise private securities offerings, private placements, a business will need to meet certain requirements regarding the intended investors. First, meeting the requirements assumes that the securities are in fact being offered under the Regulation D registration exemption. Beyond that assumption, the requirements are as follows. All purchasers of the advertised securities must be accredited investors, or the issuer must reasonably believe that the investors are accredited investors at the time of the sale. In other words, while issuers may sell to up to 35 non-accredited investors, to solicit or advertise, all purchasers must be accredited. The business must take reasonable steps to verify that all purchasers are accredited, considering background, relevant facts, such as reported income, and particular circumstances of each purchaser. Take note, state securities laws, also called blue sky laws, also require registration of securities, broker-dealers, and registered representatives. An issuer or investment banker may blue sky an issue by one of the following methods. Qualification. The issuer files with the state, independent of federal registration, and must meet all state requirements. Coordination. The issuer registers simultaneously with the state and the SEC. Both registrations become effective on the same date. Notice filing. Securities listed on the major exchanges and on the NASDAQ, as well as investment companies registered under the Investment Company Act of 1940, are known as federal covered securities. State registration is not required, but most states require the filing of a notice that the issuer intends to offer its securities for sale in that state, and the state may assess a filing fee. Knowledge Check 1.2. Question 1. Which of the following statements is not true? A. Before the filing of the registration statement, the SEC will set up a cooling-off period to ensure all registration requirements have been fully met. B. The front of every prospectus must contain the SEC disclaimer. C. The preliminary prospectus may be used to gather indications of interest. D. The Securities Act of 1933 required issuers of new non-exempt securities to file registration statements with the SEC. The answer is A. The cooling-off period begins after the S-1 registration statement is filed, not before. Question 2. Seabird Airlines is selling shares to the public for the first time. The company intends to use the proceeds from the sale of its stock to purchase several new passenger aircraft. This offering is an example of a secondary offering. B. A rights offering. C. An initial public offering. D. A subsequent primary offering. The answer is C. This is the first time this company has made its stock available to the public, so this is an initial public offering. This transaction is in the primary market. The issuer is receiving the proceeds. Question 3. An underwriter that assists a corporation on the sale of a new issue without taking the security into inventory is underwriting on which type of underwriting? A. Best efforts. B. Firm commitment. C. Partial commitment. D. Full or none. The answer is A. If the underwriter does not commit capital and take the issue into its inventory, it is acting on a best efforts basis. Question 4. A regulation exemption covers an offering of $75 million or less in 12 months. B. An offering of letter stock. Lesson 1.3, Trading Securities, the Secondary Market. Learning Objective 1F. Define the function and procedures of securities trading in the secondary market. Introduction. Since the 1930s, the securities industry has been closely regulated. The stated purpose of the regulations is the protection of the investor. To that end, the processes of issuing securities and trading them once issued are subject to strict regulatory procedures. Investing carries risk. Laws cannot require that risk be eliminated. Rather, the laws require that the investor receives enough information to be able to assess the risk accurately. To apply an understanding of the requirements the registered representative must follow, the representative must recognize regulatory standards. Therefore, this unit can be generally considered a view of the regulatory directives, the mechanics of what happens when the customer decides to implement a decision to buy or sell securities. Before getting into the specifics of trading in the secondary markets for customer accounts, it is necessary to establish a foundation of basic information. Securities markets within the United States are regulated as a whole by the SEC, which was created by the Securities Exchange Act of 1934. Under the SEC, the exchanges regulate themselves and their members. The Financial Industry Regulatory Authority, FINRA, is the largest self-regulatory organization, SRO, in the securities industry and regulates participants in the over-the-counter, OTC, market in securities, as well as members of the New York Stock Exchange, NYSE, the Municipal Securities Rulemaking Board, MSRB, and the CBOE are other SRO within the industry. Note that SRO themselves are not federal agencies. They are membership organizations that enforce their own rules as well as federal securities laws on their members. The SRO are accountable to the SEC for their enforcement activity. Once issued in a primary offering, also known as a primary market transaction, securities typically trade between investors in what are known as secondary market transactions. These trades take place on stock exchanges, in the OTC market, or, in the case of some securities, both. Exchange-listed securities, like those listed on the NYSE, are priced by auction on the trading floor. Brokerage houses purchase the securities for their customers at the lowest available asked or offering price, or they sell securities for their customers at the highest available bid price. Because there is no centralized trading location, OTC securities are priced by negotiation. Within this market, regulated by FINRA, broker-dealers called market makers maintain inventories of certain OTC securities and sell to other broker-dealers out of their inventory at their asked or offering price, or they buy from other broker-dealers for their inventory at their bid price. Thus, market makers serve as a source for securities that customers wish to buy through their broker-dealers and as a repository for securities that customers wish to sell through their broker-dealers. It is important to remember that market makers buy and customers sell at the bid price, and that market makers sell and customers buy at the ask price. Competition among market makers ensures the customer receives the lowest ask price available if the customer is buying, or the highest bid price available if the customer is selling. Broker. A broker includes an individual or a firm that charges a fee or commission for executing buy and sell orders submitted by another individual or firm. A brokerage firm when it acts as an agent for a customer and charges the customer a commission for its services, and any person engaged in the business of effecting transactions in securities for the accounts of others that is not a bank. Broker or agent transactions receive a commission for the trade. Dealer. A dealer includes the role of a brokerage firm when it acts as a principal in a particular trade. A firm acts as a dealer when it buys or sells a security for its own account and at its own risk, then charges the customer a markup or markdown. Broker vs. dealer comparison. Broker. Other terms. Agent, agency buys and sells on behalf of the customer. No inventory. Charges a commission. Little capital at risk. Dealer. Other terms. Principal, market maker, buys into inventory, sells from inventory, maintains inventory, profits on the difference between the buy and sell prices, spread, markup, markdown. Significant capital at risk. Take note. A broker-dealer may act in either capacity, but not both on the same trade. Securities markets. The market in which securities are bought and sold is known as the secondary market, as opposed to the primary market for new issues. All securities transactions take place in one of two trading markets. These two markets consist of the exchanges, where prices are established by auction, and the OTC market, where prices are established by negotiation. Exchanges. The exchange market consists of the national exchanges, such as the NYSE, and various regional exchanges. The NYSE is the model exchange for your exam. The regional exchanges list stocks and bonds of local interest in their areas. The national exchanges list securities of national trading interest, and on a typical day, billions of shares change hands on their floors. Each stock exchange requires companies to meet certain criteria before it will allow their stock to be listed for trading on the exchange. Pricing system. Although the vast majority of trades at exchanges take place electronically, you'll want to be aware that exchanges also operate as double auction markets, buyers competing with buyers and sellers competing with sellers for the best price. Floor brokers compete among themselves to execute trades at prices most favorable to the public. If you see the term auction market, think exchange. Over-the-counter, OC, market. The OTC market is an interdealer market in which unlisted securities, securities not listed on any exchange, trade. In the OTC market, securities dealers across the country are connected by computer and telephone. Thousands of securities are traded OTC, including stocks, bonds, and all municipal and U.S. government securities. Historically, the criteria a company needed to meet to have its stock traded in the OTC market were rather loose. In recent years, however, the quality of companies that trade OTC has improved substantially with some of the best-known companies in the world trading there. Third market, OC listed. The third market is the term given to describe exchange-listed securities being traded in the OTC market. Broker-dealers registered as OTC market makers in listed securities arrange third market transactions. Very simply, anytime a security whose principal trading market is an exchange is traded off the floor of that exchange, it is said to be trading in the third market. Fourth market. The fourth market is a market for institutional investors in which large blocks of stock, both listed and unlisted, trade in privately negotiated transactions unassisted by broker-dealers. The networks used for these transactions are called electronic communication networks. Practice question. A broker-dealer that maintains an inventory in CDO stock sells to a customer from that inventory at the asked price. The broker-dealer is acting as an agent, B, a market maker, C, a broker, D, a selling group member. The answer is B. This is also acting on a principal basis or acting as a dealer. When acting as an agent, broker, the broker-dealer is not selling from their inventory. As the broker-dealer maintains an inventory, it is not an acting member of a selling group. Take note, you may see a question regarding the standard size of a stock trade in the secondary markets. Stocks trade in round lots of 100 shares. If you see 5 round lots, that is 500 shares. An amount under 100 shares is called an odd lot. Learning Objective 1G identify transaction procedures and unethical practices. There are too many procedures that occur within the confines of a broker-dealer's office to cover in depth each one individually. Therefore, we will focus on the specific procedures for accepting a customer's order to buy or sell and ensure you have an understanding of settlement. Information required on an order ticket. A representative accepts a buy or sell order from a customer by filling out an order ticket. Before processing the order, The representative should verify that the customer will be able to pay for a purchase or deliver securities, if a sale. A brokerage order ticket must contain the identity of the associated person taking the trade. The ticket must indicate whether the trade was solicited, unsolicited, or was entered subject to discretionary authority. In addition, a brokerage order ticket must include the time at which the broker-dealer received a customer order. The next step requires the representative to present the order ticket to the trading department or wire room for execution. All order tickets must include the following: buy or sell, name of security, number of shares or bonds, account name and number, account type, i.e., cash or margin, price and time limits, if any, solicited or unsolicited, discretionary authority exercised or discretionary authority not exercised, if applicable, timestamp when entered, executed, changed, or canceled. When the trade is completed, an execution report is filled out. Take note: the account name or number must be on an order ticket before order execution. If a mistake is made, e.g., a wrong account number, no change to the order can be made without the approval of a principal or the branch manager. All of the facts surrounding the change must be put in writing and retained for 3 years. The trade confirmation. A trade confirmation is a document that confirms a trade, its settlement date, and the money due from or owed to the customer. Remember, for each transaction, a customer must be sent or given a written confirmation of the trade on or before the completion of the transaction, the settlement date. If a customer agrees, the confirmation may be sent electronically. A registered representative receives a copy of a customer's confirmation and checks its accuracy against the order ticket. Take note: trade confirmations must be maintained by the firm for 3 years. Test topic alert. Confirmations must be sent to customers no later than the settlement date of a transaction. Transaction settlement dates and terms. The settlement date is the date on which ownership of a security changes between buyer and seller. It is the date on which broker-dealers are required to exchange the securities and funds involved in a transaction and the date on which customers are requested to pay for securities bought and deliver securities sold. FINRA's Uniform Practice Code Up standardizes the dates and times for each type of settlement. It may help to keep in mind that the UPC is a series of rules, interpretations, and explanations designed to make uniform, where practicable, custom practice, usage, and trading techniques in the investment banking and securities business, particularly with regard to operational and settlement issues. In other words, the UPC was created so that the transactions of day-to-day business between members may be simplified and facilitated, that business disputes and misunderstandings, which arise from uncertainty and lack of uniformity in such matters, may be eliminated, and that the mechanisms of a free and open market may be improved and impediments removed. Regular way settlement. The phrase regular way settlement is used so often in the industry that it is a common assumption everyone understands to what it is referring. However, many have never been informed in an easy-to-understand way. So what does regular way mean? Think, what is the regular or normal way we do business? Regular way settlement for most securities transactions is the second business day following the trade date, T+2. As mentioned earlier, the UPC is the way regulators make our procedures for doing business uniform. Even if we, as brokers or associated persons, have never previously done business with each other, we know and understand what the other party's responsibilities are on the first transaction. Therefore, any transaction outside the regular way we do business must be looked at in its other contexts, i.e., time, delivery, place, type of security, etc. And we must ensure any non-regular aspect is disclosed at the time of the trade. If one expects a trade to be regular way delivery, but the norms are not met, the usual response can be to either accept the delivery as transacted anyway, which is up to the buyer, or, if the trade is turned into a losing proposition before delivery, to reject the delivery, called rejection. Regular way settlements for U.S. government securities are defined differently than for corporate and agency securities. For government securities, regular way settlement is T+1 business day. When investors purchase and redeem mutual funds, there really is no settlement. Mutual fund trades are primary market transactions. They settle the next time the net asset value, NAV, is calculated. Take note, if a trade occurs on a Tuesday, trade date, it settles regular way on Thursday. If the trade is on a Thursday, it settles regular way on the following Monday. Cash settlement. Cash settlement trades require delivery of securities from the seller and payment from the buyer on the same day a trade is executed as long as settlement occurs before 2:30 p.m. ET. Stock or bonds sold for cash settlement must be available on the spot for delivery to the buyer. Cash trade settlement occurs no later than 2:30 p.m. if the trade is executed before 2:00 p.m. If the trade occurs after 2:00 p.m., settlement is due within 30 minutes. Keep in mind that cash settlement is not an entitlement and must be requested of the broker-dealer. On your exam, always assume regular way settlement, unless the question states otherwise. Take note, because a cash settlement occurs on the same day as the transaction, cash settlement trades are not considered regular way. Summary of settlement dates: corporate, agencies, and municipal securities. Cash settlement by 2:30 p.m. on the same day as the trade, regular way settlement. On the second business day after the trade date, T+2. Option trades and government securities. Cash settlement by 2:30 p.m. on the same day as the trade, regular way settlement. On the first business day after the trade date, T+1. Take note, be sure to review the dates around a dividend, declaration, ex-dividend date, record date, and payable date, DIRP. All of these are set by the Board of Directors, except the ex-date. Regulation T. Federal Reserve Board Regulation T specifies the date customers are required to pay for purchase transactions. Under Regulation T, payment is due 2 business days after settlement. Therefore, on a regular way trade, customer payment is due 4 business days after the trade date. Regular way settlement is an industry standard that all customers agree to when opening an account. Regulation T requirement is the federal regulation. Take note, under regular way settlement, payment is requested 2 business days after the trade. Under Regulation T, payment is due 2 business days later, which is 4 business days after the trade. Regulation T payment is sometimes referred to as Settlement Plus 2, S+2. Example: WANA purchases 100 shares of NMO stock on Monday, March 10. Regular way settlement is Wednesday, March 12, T+2. If WANA fails to pay for the trade by that date, the broker-dealer may take action. If the trade is not complete by Friday, March 14, S+2, or T+4, the regulations require the broker-dealer to take action. Extensions. If a buyer cannot pay for a trade within the time limit prescribed under Regulation T, the broker-dealer may request an extension from its designated examining authority, D, before the deadline. DEAs include FINRA and the various exchanges. If the customer cannot pay by the end of the extension or the extension request is denied, the broker-dealer sells the securities in a closeout transaction. After the closeout, the account is frozen for 90 days. A frozen account must have sufficient cash in the account before a buy transaction may be executed. If the payment due is $1,000 or less, the broker-dealer is not required to freeze the account. Take note. Consider the relationship between regular way settlement and Regulation T payment this way, because brokerage firms must comply with industry trade practices and settle those trades on the second day. They request that their customers settle within that time period as well. However, if the customer does not settle by then, there is, in essence, a 2-day grace period under Regulation T, giving the firm time to correct the problem and, if necessary, request an extension. Any question about settlement date will always be referring to the UPC, cash or regular way. Final time for payment comes under Regulation T, Test Topic Alert. Be careful about Regulation T, both the payment date requirement, S+2, and the minimum deposit requirement, margin, are rules under Regulation T. Read the question carefully to be sure you are answering the question being asked. Practice question. Your customer, Jonah, buys 200 shares of Parker Pictures, Inc. on Tuesday, June 12, in a cash account. What is the last day for Jonah to pay for the trade and meet the Regulation T requirement? A. Tuesday, June 12, B. Thursday, June 14, C. Saturday, June 16, D. Monday, June 18. The answer is D. The Regulation T requirement is S+2 or T+4 on a regular way stock trade. A cash account means the trade was not made on margin. It does not mean the trade was for cash settlement. Regular way settlement on this trade would be T+2 or Thursday, June 14. Add 2 business days and the Regulation T required payment date is Monday, June 18. Fair dealing. The conduct rules and the laws of most states require broker-dealers, registered representatives, and investment advisors to inquire into a customer's financial situation before making any recommendation to buy, sell, or exchange securities. This includes determining the client's other security holdings, income, net worth, and financial goals and objectives. The following activities violate the fair dealing rules: recommending any investment that is not suitable for the customer's financial situation and risk tolerance, short-term trading of mutual funds, setting up fictitious accounts to transact business that otherwise would be prohibited, making unauthorized transactions or use of funds, recommending purchases inconsistent with the customer's ability to pay, committing fraudulent acts such as forgery and the omissions or misstatements of material facts, guaranteeing customers against loss, guarantees and sharing in customer accounts. Speaking of guarantees, broker-dealers, investment advisors, and registered representatives may not guarantee any customer against a loss or guarantee that he will achieve a gain. Members, advisors, and representatives are also prohibited from sharing in any profits or losses in a customer's account. An exception is made if a joint account has received the member firm's written approval. If the member firm authorizes such a shared account, any such sharing must be directly proportionate to the financial contributions each party makes. If a member or an associated person shares an account with a member of that person's immediate family, directly proportionate sharing of profits and losses is not required. Immediate family members include parents, siblings, spouses, in-laws, and children. It also includes any person who is financially dependent on the employee. Tape recording of registered persons by certain firms, FINRA Rule 3170. If a member firm hires representatives who were previously associated with a disciplined firm, the hiring member may be required to establish procedures for monitoring the telemarketing activities of all of its registered persons. A disciplined firm is one that has been expelled from membership in any SRO or is the subject of an SEC order revoking its registration as a broker-dealer. The criteria used by FINRA are as follows. Level: A. Number of registered representatives employed, 5 through 9. Number of registered representatives from disciplined firms, 40% or more level. B. Number of registered representatives employed, 10 through 19. Number of registered representatives from disciplined firms, 4 or more. Level. C. Number of registered representatives employed, 20 or more. Number of registered representatives from disciplined firms, 20% or more. Example. If a member with 15 registered representatives hires 4 or more representatives who, within the prior 3 years, were associated with a disciplined firm, the member is required to monitor the phone calls of all of its registered persons. The member must record and review all phone conversations of its representatives with existing or potential clients, even cold calls. Once the member is advised by FINRA that special supervisory procedures are required, the firm has 60 days to implement them, and must tape record all telephone conversations between the registered persons and both existing and potential customers. These special supervisory procedures must be maintained for 3 years. In addition, the member must provide FINRA with quarterly reports on its telemarketing supervision. All recordings made, as well as the quarterly reports, must be maintained for 3 years. Take note: if a firm is notified by FINRA for the first time that it is subject to the recording rule, it has a one-time opportunity to obtain relief by adjusting its staffing levels to below the threshold levels. It can only do so by terminating representatives from disciplined firms. It cannot do so by hiring additional representatives to fall below the stated thresholds. If a firm wants to avoid the taping rule by adjusting its staffing levels, or if it wants to seek an exemption from the rule, it must do so within 30 days of receiving written notice from FINRA. Best execution. Broker-dealers must recognize the duty they carry of best execution. Best execution is an investor protection requirement that essentially obligates a broker-dealer to exercise reasonable care when executing an order so that the most advantageous terms are obtained for the customer. Each order and its accompanying trading environment varies, and so does the determination of what is best execution. Broker-dealers owe customers such care when they receive, handle, route, or execute orders in equities, options, and debt securities. If a broker-dealer receives an order routing inducement, such as payment for order flow or trades as principal with customer orders, it must not let those factors interfere with its duty of best execution nor take them into account when analyzing market quality. Generally, FINRA Rule 5310 requires that in any transaction for or with a customer, a member and persons associated with a member have to use reasonable care to find out the best market for the security and buy or sell it in the market, so that the price to the customer is as favorable as possible. Interpositioning. Interpositioning is the act of adding another broker-dealer to a transaction when there is no benefit to the buyer or seller. The prohibited practice occurs when one broker-dealer inserts another into their own transactions, simply to generate commissions or fees for the other broker-dealer. Violations of interpositioning have revealed that these prohibited practices are generally reciprocal arrangements between broker-dealers. Test topic alert. All trades are reviewed by a principal of the firm. They're not necessarily approved, but are definitely reviewed. Disclosure of compensation to brokers or dealers when transferring accounts to a new firm. FINRA developed Rule 2273 out of concern that former customers may not be aware of other important factors to consider in making a decision whether to transfer assets to the recruiting firm, including direct costs that may be incurred. It's important to note that no member shall interfere with a customer's request to transfer an account in connection with the change in employment of the customer's registered representative when the account is not subject to any lien for monies owed by the customer or other bona fide claim. FINRA Rule 2273 requires registered representatives who move to a new firm and try to convince former customers to move with them to provide educational material outlining things for the customer to consider, including financial incentives that could rise to a conflict of interest for the representative. The rule states that an educational communication would have to be delivered when the member firm, directly or through a representative, individually contacts a former customer of that representative to transfer assets, or a former customer of the representative, absent individual contact, transfers assets to an account assigned or to be assigned to the representative at the member. A former customer is defined as any customer who had a securities account assigned to a registered person at the representative's previous firm. Educational communication. The FINRA-prepared educational communication highlights the following potential implications of transferring assets to the new firm. Whether financial incentives received by the representative may create a conflict of interest. Some assets may not be directly transferable to the recruiting firm, and as a result, the customer may incur costs to liquidate and move those assets or account maintenance fees to leave them with the current firm. Potential costs related to transferring assets to the recruiting firm, including differences in the pricing structure and fees imposed by the customer's current firm and the recruiting firm. Differences in products and services between the customer's current firm and the recruiting firm. Contacting the customer may be done with written, electronic, or oral communication. Electronic communication may include a hyperlink directly to the educational communication. If the contact is oral, the member or registered person must notify the former customer that an educational communication that includes important considerations in deciding whether to transfer assets to the member will be provided in writing within 3 business days after the contact. If a former customer attempts to transfer assets before an individualized contact occurs, the member must deliver the educational communication with the account transfer approval documentation. The delivery of the communication applies for 3 months, following the date the registered person begins employment or associates with the new member. Communication exception. FINRA Rule 2273 is not applicable when a former customer who is contacted to transfer assets expressly states that she is not interested in transferring assets to the member. If the former customer later decides to transfer assets to the new member without further individualized contact within the period of 3 months following the date the registered person begins employment with the member, then the educational material must be sent. This rule is not applicable to institutional accounts. Rather, it is solely for natural persons. Adjustment of open orders. Certain orders on the order book are reduced when a stock goes ex-dividend. On the ex-date, the stock price opens lower by the amount of the distribution. All orders entered below the market are reduced on the ex-dividend date or ex-date, the first date on which the new owner of stock does not qualify for the current dividend. Orders reduced include buy limits, sell stops, and sell stop limits. These orders are reduced by the dividend amount. Without this reduction, trading at the lower price on the ex-dividend date could cause an inadvertent execution. Example: ABC stock is priced at $20 and the board of directors has declared a $0.50 dividend. If there are outstanding buy limits or sell stop orders priced at $19.75, those orders will be reduced to $19.25 on the morning of the ex-date, unless the orders are marked DNR, do not reduce. If those orders were not adjusted, they might be inadvertently triggered and executed on the morning of the ex-date, when the price of the security opened trading at $19.50. The reduction of the price of the stock is not a true downturn, but only an adjustment for the dividend, which buyers will not receive if purchased on the ex-date. DNR instructions. Unless marked "Do not reduce," DNR, open buy limit or sell stop order prices shall be first reduced by the dollar amount of the dividend. Take note. In the previous example, if the buy limit or sell stop was placed at $19.50 DNR, the orders would be executed and triggered on the morning of the ex-date. Adjustments for stock dividends and stock splits. When a stock split or stock dividend takes place, outstanding orders not yet executed will be adjusted to maintain the integrity of the order when it was placed. Take note. A customer has placed an order to buy 100 shares of ABC stock at $40. If ABC declares a 2:1 stock split, the order will be adjusted to buy 200 shares of ABC stock at $20. The same is true for a stock dividend. If ABC declares a 20% stock dividend, the order to buy 100 shares of ABC stock at $40 would be adjusted to buy 120 shares of ABC stock at $33.33. 100 shares times 1.2 increases 20%, results in 120 shares total. $4,000 divided by 120 equals $33.33. Note that the value of all the transactions and adjustments is constant at $4,000. Report of execution. The registered representative receives a report after a trade is executed. She first checks the execution report against the order ticket to make sure that everything was done as the customer requested. If everything is in order, she reports the execution to the customer. Incorrect trade reports. If an error exists, the representative must report it to the branch office manager or principal immediately. Changing an account number on an order ticket, cancel and rebill, requires manager approval. Sometimes the details of a trade are reported to a customer incorrectly. Despite the mistaken report, the actual trade is binding on the customer. However, if an order is executed outside the customer's instructions, the trade is not binding. Reporting an error. FINRA rules require that a record of any errors may be reported to the person designated to receive such error reports by the firm. At a broker-dealer, that individual would always be a manager or someone who holds a principal's license. All such reports should be made immediately in writing and retained for 3 years under the General Record Retention Rules. These reports may be referred to as error reports, error records, trade correction reports, or any number of generic names a firm might assign to such records. Take note. The regulatory requirement for the mailing of client account statements is quarterly, even if there is activity in the account. Although most broker-dealers have made it a practice to send out monthly statements for any account with activity, this is not a regulatory requirement. The regulatory requirement is for quarterly statements. Please note that any account with a penny stock holding must receive monthly statements. Unethical trading practices. Transactions intended to portray an artificial market for a stock are prohibited. Following is a list of unethical trading practices. Painting the tape. When one party sells stock to another with the understanding that the stock will be repurchased later in the day at virtually the same price, it is known as painting the tape. The intent of such transactions is to make it appear that far more activity in a stock exists than actually does. Marking the close. Affecting trades or falsely reporting trades to influence the closing price of a stock is called marking the close and is prohibited. Example, a firm's proprietary trader is compensated by salary and bonuses based on profits in the firm's trading account each quarter. On the last day of trading in March, the calendar quarter end, he enters numerous small buy orders at 3:55 p.m. Eastern Time in securities the account already holds long positions in. This could be an attempt to mark the close, push prices of these securities up 1 or 2 ticks just before the close of the day, and thus the quarter, inflating the paper profits the account will show for the end of the quarter to secure a larger bonus. Marking the close is a prohibited activity. Payments designed to influence market prices. FINRA member firms are prohibited from attempting to influence the market price of securities by paying for favorable reviews, articles, or other mentions in financial publications. This prohibition does not apply to paid advertisements placed in these publications and marked as such. Spreading false information. Broker-dealers must not promote or disseminate false or misleading information. Front-running. If a firm or any associated person has non-public knowledge of an impending block order to buy or sell, that firm or person cannot place an order in front of the block order. For purposes of this rule, a block order is an order for 10,000 shares or more. Example, assume that a representative has non-public knowledge of an impending order to buy 100,000 shares of a NASDAQ stock. If the representative places an order to buy stock for her personal account in front of the order, the representative would likely benefit from this action because the stock would likely rise on the execution of the large block trade just behind or after the representative's personal trade. Insider trading. The Insider Trading Act adds significant penalties for the use of material non-public information to make a profit or avoid a loss, called insider trading. The law defines an insider as any person who has access to material non-public information about a company. Material information is information that would most likely influence the price of the company's stock. The Securities Exchange Act of 1934 prohibited the use of insider information in making trades. Under the Act, the penalties for insider trading were up to $5,000 in fines. As we entered the 1980s, people with inside information were in a position to make millions of dollars, and the fines were seen as a cost of doing business. The Insider Trading and Securities Fraud Enforcement Act of 1988, or Insider Trading Act, amended its provisions and specified significant penalties for insider trading and securities fraud, giving some real teeth to the prohibitions against using inside information. All broker-dealers must establish written supervisory procedures specifically prohibiting the misuse of inside information. Additionally, they must establish policies that restrict the passing of potentially material non-public information between a firm's departments. This barrier against the free flow of sensitive information is known as a firewall or an information barrier. Take note, the possession of inside information is not illegal. It is the use of such information to make a gain or avoid a loss that constitutes insider trading, which is illegal. The Insider Trading Act prohibits insiders from trading on or communicating non-public information. Both the tipper, the person who relays the information, and the tippee, the person who receives the information, are liable, as is anyone who trades on information that they know or should know is not public or who has control over the misuse of this information. The key elements of tipper and tippee liability under insider trading rules are as follows. Is the information material and non-public? Does the tipper owe a fiduciary duty to a company or its stockholders? Has he breached it? Does the tipper meet the personal benefits test, even something as simple as enhancing a friendship or reputation? Does the tippee know, or should the tippee have known, that the information was inside or confidential? Test topic alert. Inside information, by definition, is any material non-public information, that is, any information that has not been disseminated to or is not readily available to the general public. Penalties for insider trading. The SEC can investigate any person suspected of violating any of the provisions of the Insider Trading Act. If the SEC determines that a violation has occurred, civil penalties of up to 3 times profits made or losses avoided may be levied. A controlling person, such as a registered representative or broker-dealer, could be fined $2.14 million. 2020 this number adjusts for inflation, or 3 times the profit made or loss avoided, whichever is greater. Violators may also face criminal penalties of up to $5 million and up to 20 years in jail. If the violator is an employee of a broker-dealer, a firm, which is supposed to have procedures in place to prevent this, could be fined up to 3 times damages or $25 million, whichever is greater. Knowledge Check 1.3. Question 1. Which of the following statements regarding transactions in the different securities markets are true? Roman numeral 1. Transactions in listed securities occur mainly in the OTC market. Roman numeral 2. Transactions in unlisted securities occur in the OTC market. Roman numeral 3. Transactions in listed securities that occur in the OTC market are said to take place in the fourth market. Roman numeral 4. Transactions in listed securities that occur directly between institutions without the use of broker-dealers as intermediaries are said to take place in the fourth market. 8 Roman numerals 1 and 3b Roman numerals 1 and 4. See Roman numerals 2 and 3d Roman numerals 2 and 4. The answer is D. Listed securities traded on exchanges constitute the exchange market. Unlisted securities traded over the counter, OTC, make up the OTC market. Listed securities traded OTC compose the third market. Securities traded directly between institutions constitute the fourth market. Question 2. All the following are required on an order ticket except of the customer's objective. B. Whether the order being placed is a discretionary order. C. The time of the execution of the trade. D. The date of the order. The answer is A. The customer's objective is certainly considered when entering an order, but is not a requirement to be included on the order ticket. Question 3. Regular way settlement for securities transactions in corporate issues. It depends on the type of account. B is 2 calendar days after the trade takes place. C is the trade date plus 2 business days. D determines if the security is delivered in certificate form or not. The answer is C. Regular way settlement for corporate and municipal securities is the trade date plus 2 business days. Unit 2 Investment Companies and Investment Taxation. Learning objectives. When you have completed this unit, you will be able to accomplish the following. Learning objective 2A. Identify the different types of investment companies. Learning objective 2B. Relate the purchase and liquidation process for different investment companies. Learning objective 2C. Differentiate the fees, sales charges, and expenses for investment companies. Learning objective 2D. Recall the characteristics of variable annuities. Learning objective 2E. Recall the characteristics of variable life insurance. Learning objective 2F. Differentiate long-term capital gains, short-term capital gains, and income taxation, including reinvestments. Learning objective 2G. Recall the pipeline theory of taxation and how it applies to investment companies. Introduction. The official name of the Series 6 is the Investment Company and Variable Contracts Products Representative Exam. With the Series 6 exam, a registered representative may sell securities that are defined as investment companies under the Investment Company Act of 1940 if those investments are offered by prospectus. The 2 most common securities that meet this definition are mutual funds and separate accounts within variable annuities. These 2 products make up most of a security sales made by Series 6 representatives. Unit 2 takes a deeper dive into investment companies than the SID, particularly the content regarding mutual funds. Taxation is a significant factor in investing and in making an investment recommendation. Understanding a customer's circumstances includes understanding her tax situation and how the different investments will change her tax situation. Your exam will include approximately 14 questions from the topics covered in Unit 2. Lesson 2.1. Investment Companies. Learning objective to identify the different types of investment companies. An investment company is a corporation or trust that pools investors' money and then invests that money in securities on their behalf. By investing these pooled funds as a single large account, the investment company management attempts to invest and manage funds for people more efficiently than the individual investors could themselves. Additionally, it is expected that a professional money manager should be able to outperform the average investor in the market. Among the requirements for investment companies is that they must have a clearly defined investment objective, and the investment manager must manage the fund to achieve that objective. This allows the investor to choose those funds that best meet the investor's objectives. Like corporate issuers, investment companies raise capital by selling shares to the public. Investment companies must abide by the same registration and prospectus requirements imposed by the Securities Act of 1933 on other issuers. Investment companies are also subject to regulations regarding how their shares are sold to the public, and they are regulated by the Investment Company Act of 1940, ICA. The ICA established the 3 types of investment companies, 2 of them, management companies and unit investments trusts. UITs are covered here. The third, face amount certificates, FACS, is not actively tested. If FAC appears on the exam, it is likely as an incorrect answer. To register as an investment company with the SEC, the company must have net assets of $100,000. If the investment company does not have at least $100,000 in net assets, it may still register a public offering with the SEC if it can meet these requirements within 90 days of registration. A clearly defined investment objective. Once defined, the objective may be changed only by a majority vote of the company's outstanding shares. As mentioned earlier, the ICA classifies 3 types of investment companies: management companies, UITs, and FAC. Unit investment trusts, UITs. Unit investment trusts, UITs, pool money from many investors and invest it based on specific investment goals, like all investment companies. The key difference with UIT is once a UIT sets its portfolio, it remains the same for the life of the trust, barring any major corporate events, such as a merger or bankruptcy proceeding, and the term lifespan of the trust is fixed. UIT raise money by selling shares known as units to investors. typically in a one-time public offering. Each unit represents an ownership slice of the trust and gives the investor a proportional right to income and capital gains generated by the fund's investments, typically either stocks or bonds. The performance of a UIT underlying investments, minus fund fees, determines the trust's investment return. Those investments are generally fixed, with the UIT generally holding the securities in which it invests for the life of the fund, which is determined at the time of the fund's initial offering. UIT are designed to be held for the life of the fund. A UIT may be redeemed with the issuer, the trust, according to the redemption rules established by the trust. Many offer daily redemption, but a UIT may establish rules other than daily, e.g. weekly or monthly. Take note, UIT are trusts but may be referred to as a fund. Test topic alert: UIT are investment companies as defined under the Investment Company Act of 1940. UIT shares, units, are not traded in the secondary market. They must be redeemed by the trust. UIT are not actively managed. There is no board of directors or investment advisor. Management companies. The most familiar type of investment company is the management investment company, which actively manages a securities portfolio to achieve a stated investment objective. A management investment company is either open-end or closed-end. Both closed and open-end companies sell shares to the public in an initial public offering. The primary difference between them is that a closed-end company's initial offering of shares is limited. It closes after its authorized number of shares have been sold, and an open-end company is perpetually offering new shares to the public. It is continually open to new investors. Closed-end management companies. A closed-end management company will raise capital for its portfolio by conducting a common stock offering, much like any other publicly traded company that raises capital to invest in its business. In the initial offering, the company registers a fixed number of shares with the SEC and offers them all to the public with a prospectus for a limited time through underwriters. Once all the shares have been sold, the fund is closed to new investors. Many times, a fund elects to be a closed-end company because the sector in which it intends to invest has a limited number of securities available. Closed-end investment companies may also issue bonds and preferred stock. Closed-end investment companies are often called publicly traded funds. After the stock is sold in the initial offering, anyone can buy or sell shares in the secondary market, i.e., on an exchange or OTC, in transactions between private investors. Supply and demand determines the bid price, price at which an investor can sell, and the ask price, price at which an investor can buy. Closed-end fund shares may trade above, at a premium to or below, at a discount to, the share's NAV. When buying and selling closed-end investment companies in the secondary market, there will generally be a commission paid to execute the trade. Test topic alert: once issued, closed-end company shares trade in the secondary market where price is determined by supply and demand. A registered representative with a Series 6 can sell closed-end shares only in the primary market, as part of an initial public offering or an additional primary offering, not in the secondary market. Open-end management companies. Mutual funds are, by far, the largest segment of the open-end management company sector. There are other types of open-end management companies. For test purposes, though, the term mutual fund is often used for questions referring to an open-end company. A mutual fund only issues one class of security, a common share. It does not specify the exact number of shares it intends to issue, but registers an open offering with the SEC. In other words, a mutual fund conducts a continuous primary offering of common shares. You should understand that the mutual fund can purchase common stock, preferred stock, bonds, and other investment types for their investment portfolios, but an investor only purchases common shares of the mutual fund. With this registration type, they can raise an unlimited amount of investment capital by continuously issuing new shares. Conversely, when investors want to sell their holdings in a mutual fund, it is the fund itself that redeems those shares. The shares do not trade in the secondary market. Each share represents an ownership slice of the fund and gives the investor a proportional right, based on the number of shares she owns, to income and capital gains that the fund generates from its investments. The particular investments a fund makes are determined by its stated objective and, in the case of an actively managed fund, by the investment style and skill of the fund's professional manager or managers. The holdings of the mutual fund are known as its underlying investments, and the performance of those investments, minus fund fees, determines the fund's investment return. Test topic alert: A comparison of open and closed-end management companies. Open-end capitalization, unlimited. Continuous offering of shares. Closed-end capitalization, fixed. Single offering of shares. Open-end issues, common stock only. No debt securities. Permitted to borrow. Closed-end issues. May issue common and preferred stock and debt securities. Open-end shares, full or fractional. Closed-end shares, full only. Open-end offerings and trading. Sold and redeemed by the fund only. Continuous primary offering. Must redeem shares. Closed-end offerings and trading. Initial primary offering. Secondary trading OTC or on an exchange. Does not redeem shares. Open-end pricing. Selling price determined by formula in the prospectus. Closed-end pricing. Current market value plus commission. Price determined by supply and demand. Open-end shareholder rights, dividends, when declared. Voting. Closed-end shareholder rights, dividends, when declared. Voting and preemptive rights. Open-end ex-date, set by Board of Directors. Closed-end ex-date, set by SRO. Test topic alert. The ex-date for a mutual fund is typically the day after the record date. Remember that mutual funds do not trade in the secondary markets. Exchange-traded funds. Exchange-traded funds, ETFs, are a type of open-end management company. ETF combine aspects of mutual funds and conventional stocks. Like a mutual fund, an ETF is a pooled investment fund that offers an investor an interest in a professionally managed, diversified portfolio of investments. But unlike mutual funds, ETF shares trade like stocks on stock exchanges and can be bought or sold throughout the trading day at fluctuating prices. ETF function like open-end companies in that they offer a daily purchase and redemption at NAV directly to investors, primary market. Unlike a mutual fund, an ETF does not accept money, but only assets in kind. It issues creation units, shares, and has a minimum for both purchases and redemptions of $1 million of value, often higher. For redemption, the investor would receive securities equal to the redeemed value instead of cash. The mechanics of ETF purchases and redemptions are such that only institutional investors deal with the fund directly. Once the institutional investors own the shares, they may sell them on the secondary markets. It is in the secondary markets that retail investors buy and sell shares of ETF. Test topic alert. As most ETF trading is in the secondary market, the Series 6 license does not allow a representative to place these trades. Be aware of this for the exam. Secondary market trades are prohibited for a Series 6 representative. Separate accounts, variable life and variable annuity sub-accounts, the investments, separate accounts, within variable life and annuity products are a type of open-end management company. Though similar, they are different from mutual funds. Variable life and annuity products are covered later in this unit. Practice question. All of the following are defined as types of investment companies under the Investment Company Act except A. Closed-end management companies. B. Mutual funds. C. Hedge funds. D. Exchange-traded funds, ETFs. The answer is C. A hedge fund is not defined as an investment company under the ICA of 1940. Mutual funds, ETFs, and closed-end funds are all types of management companies. Disclosure documents for mutual funds. Mutual funds provide disclosure documents to investors. 4 types of disclosure documents are described as follows. Full statutory prospectus. This is the full and fair disclosure document that provides a prospective investor with the material information needed to make a fully informed investment decision. If using a prospectus to solicit a sale, it must be distributed to an investor before or during the solicitation. The front of a mutual fund prospectus must contain key information to appear in plain English in a standardized order. Information in this clear and concise format includes the fund's objective, investment policies, sales charges, management expenses, and services offered. It also discloses 1, 5, and 10-year performance histories or performance over the life of the fund, whichever is shorter. Example, if a fund has been in existence for 8 years, it will show performance for 1, 5, and 8 years. If it has been in existence for only 4 years, it will show 1 and 4 years. The delivery of any type of sales literature is considered a solicitation of sale and therefore must be accompanied or preceded by the delivery of a prospectus. A mutual fund is said to have an ongoing prospectus. As all purchases in a mutual fund are primary market sales of new shares, there must always be a prospectus available. Take note, a mutual fund prospectus is updated annually. It may be used for sales solicitations for a period of 16 months from the date of publication. The 16 months allows for a 4-month overlap to throw out the old prospectus and stock the new ones. This rule is a throwback to the day that all of these documents were in paper form. Test topic alert. A prospectus may not ever be altered in any way. This means that no highlighting, writing in, or taking any measure to bring attention to any specific passage or section is permitted. Summary prospectus, Rule 498. A mutual fund can provide a summary prospectus to investors and may include an application that investors can use to buy the fund's shares. The summary prospectus is a standardized summary of key information in the fund's full prospectus. Investors who receive the summary have the option of either purchasing fund shares using the application found therein or requesting a full, statutory prospectus. An investor who purchases fund shares on the basis of the summary prospectus must be able to access a full prospectus no later than the confirmation of the sale. Delivery may be made online. There are some very specific requirements for a summary prospectus. The following must be included on the cover page of the summary prospectus or at the beginning of the summary prospectus: the fund's name and the class or classes of shares, the exchange ticker symbol for the fund's shares, a legend which must appear on the cover page that refers to the summary nature of the prospectus and the availability of the fund's full statutory prospectus. The legend must provide a toll-free number to request paper delivery of prospectus or a website where one may be downloaded. Additionally, the summary must provide specific information in a particular sequence, such as investments, risks, and performance, fee tables, investment objectives, investment strategies, and any related risks, the portfolio holdings and details regarding management, shareholder information, and any financial highlights. Statement of additional information, S.of.I. Mutual funds and closed-end funds are required to have an SAI available for delivery, without charge, within 3 business days of an investor's request. Investors can obtain a copy of the SAI by calling or writing to the investment company, or by contacting a broker-dealer that sells the investment company shares, or by contacting the SEC. While a prospectus is always sufficient for the purpose of selling shares, some investors may seek additional information not found in the prospectus. This additional information is not considered mandatory to make an informed investment decision, but may be useful to the investor. The SAI affords the fund an opportunity to have expanded discussions on matters such as the fund's history and policies. It will also typically contain the fund's consolidated financial statements, including the balance sheet, a statement of operations, an income statement, and a portfolio list at the time the SAI was compiled. Take note, an investment company must send a copy of its balance sheet to any shareholder who requests one in writing between semi-annual reports. Omitting prospectus, Rule 482 Prospectus. The omitting prospectus is the official name for an advertisement for a mutual fund. These will often take the form of a tombstone ad for a new fund. The key to remember is an omitting prospectus omits most of the information an investor would need to make an investing decision. Omitting prospectus are not sufficient for soliciting a sale. Categories of mutual funds. While there are literally thousands of individual mutual funds, there are only a handful of major fund categories. Stock funds invest in stocks. Bond funds invest in bonds. Balanced funds invest in a combination of stocks and bonds. Money market funds invest in very short-term investments and are sometimes described as cash equivalents. Take note, money market mutual funds for retail investors are designed to have a stable NAV of $1 per share. They are not guaranteed, nor are they protected by EPTIC insurance. It is rare, but it is possible to lose money in a money market mutual fund as a retail investor. As a result of the 2007-2008 economic crisis, the SEC adopted amendments to reduce credit and liquidity risks of money market mutual funds. In addition, institutional money market mutual funds are now allowed to float their NAV and include liquidity fees and redemption gates to reduce the possibility of another run on these securities. The only other funds with a stable NAV are government money market funds. At least 99.5% of the portfolio of these funds must be in very liquid investments, namely cash, government securities, and / or repurchase agreements that are collateralized fully with government securities. Mutual funds are equity investments. When you buy shares of a fund, you become a part owner of the fund. This is true of bond funds as well as stock funds. That means there is an important distinction between owning an individual bond and owning a fund that owns the bond. When you buy a bond, you are promised a specific rate of interest and return on your principal. That's not the case with a bond fund, which owns a number of different bonds with different rates and maturities. What your equity ownership of the fund provides is the right to a share of what the fund collects in interest, realizes in capital gains, and receives back if it holds a bond to maturity. In other words, with a mutual fund, you own a piece of what it is worth, its value, not a piece of the securities held in its portfolio. Stock funds. A mutual fund that uses stock to meet its stated objectives can generally be referred to as a stock fund, sometimes equity fund. Common stock is normally found in the portfolio of any mutual fund that has growth as a primary or secondary objective. Equity funds have historically outpaced inflation over most 10-year time horizons. Growth funds. Growth funds invest in stocks of companies whose businesses are growing rapidly. Growth companies tend to reinvest all or most of their profits for research and development rather than pay dividends. Growth funds are focused on generating capital gains rather than income. Growth managers may consider stocks that many feel are overvalued because there may still be upside potential. As such, funds managed for growth tend to have elevated levels of risk. Blue chip or conservative growth funds invest in established and more recognized companies to achieve growth with less risk. Generally, these funds own shares of companies with fairly large market capitalization. Market cap, as it is usually referred to, is the total number of shares of common stock outstanding multiplied by the current market value per share. So, a listed company with 300 million shares outstanding where the share price is $50 would have a market cap of $15 billion and would be considered a large cap stock. Funds investing in stocks like this are sometimes called large cap funds. Their portfolio consists of companies with a market capitalization of more than $10 billion. These types of funds can be more stable and less volatile in a turbulent market. Example: an investor who is willing to take moderate risk and is willing to invest for a minimum of 5 to 7 years may be interested in a blue chip or large cap growth fund. Aggressive growth funds. Aggressive growth funds are sometimes called performance funds. These funds are willing to take greater risk to maximize capital appreciation. Some of these funds invest in newer companies with relatively small capitalization, less than $2 billion capitalization, and are referred to as small cap funds. Mid-cap funds are somewhat less aggressive and have in their portfolio shares of companies with a market capitalization of between $2 billion and $10 billion. Large cap funds have market capitalization of greater than $10 billion. The lower the market cap, the greater the volatility. Example: an investor who is seeking high potential returns with the understanding that there can also be significant losses and is willing to invest for 10-15 years may be interested in an aggressive growth fund that focuses on small or mid-cap companies. Value funds. Value funds, and therefore value managers, focus on companies whose stocks are currently undervalued. Earnings potential is not reflected in the stock price. These undervalued companies are expected to perform better than the reports indicate, thus providing an opportunity to profit. Value stocks typically have dividend yields higher than growth stocks. Funds managed for value are considered more conservative than funds managed for growth. Example: an investor who is willing to take moderate risk when investing to purchase a vacation home in 7-10 years may be interested in a fund that is value-oriented. Equity income funds. An income fund, also known as an equity income fund, stresses current income over growth. The fund's objective may be accomplished by investing in the stocks of companies with long histories of dividend payments, such as utility company stocks, blue chip stocks, and preferred stocks. These are managed for income, not growth. Example: an investor who is willing to take low to moderate risk and seeks income from equity investments in the form of dividends with some capital appreciation may be interested in an equity income fund, utility fund, or preferred stock fund. Option income funds. Option income funds invest in securities on which call options can be sold, known as covered calls. They earn premium income from writing, selling the options. They may also earn capital gains from trading options at a profit. These funds seek to increase total return by adding income generated by the options to appreciation on the securities held in the portfolio. Growth and income funds. A growth and income fund, combination fund, may attempt to combine the objectives of growth and current yield by diversifying its stock portfolio among companies showing long-term growth potential and companies paying high dividends. Often, both value and growth management styles are utilized. Example: an investor seeking dividends and capital appreciation with moderate risk may be interested in a growth and income fund. Specialized sector funds. Many funds attempt to specialize in particular economic sectors or geographic areas. These funds must have a minimum of 25% of their assets invested in their specialties. Sector funds offer high appreciation potential but may also pose higher risks to the investor as a result of the concentration of investments. These funds are speculative in nature. They include gold, technology, pharmaceutical, and biotechnology funds, but they can also be geographic, such as investing in companies located in the Pacific Basin or Silicon Valley. Sector funds are often labeled as such in the listings of mutual fund companies that offer them. Example: an investor who believes the pharmaceutical industry is going to outperform the market over the next 5-10 years and is willing to speculate on the investment may be interested in a sector fund that focuses on the pharmaceutical industry. Take note: if a mutual fund uses the name of an industry, sector, or geographic area in its name, it must have at least 80% of the fund's assets in that industry, sector, or area. This is called the names rule. Special situation funds. Special situation funds buy securities of companies that may benefit from a change within the companies or in the economy. Takeover candidates and turnaround situations are common investments. These funds are also speculative, high risk. Example: an investor believes the banking industry is going to be going through a phase of mergers and acquisitions. He is willing to take additional risk to possibly profit from the potential consolidation of the industry. He may be interested in a special situation fund that specializes in mergers and acquisitions. Blend/core funds. Blend/core funds are stock funds with a portfolio comprised of a number of different classes of stock. Such a fund might include both blue-chip stocks and high-risk/high potential return growth stocks. Both growth and value management styles are used. The purpose is to allow investors to diversify their investment via management and securities in a single fund. Take note: value funds are considered more conservative than growth or blend/core funds. Index funds. Index funds invest in securities that mirror a market index, such as the S&P 500. An index fund buys and sells securities in a manner that mirrors the composition of the selected index. The index may be broad, such as the S&P 500, or narrow, such as a transportation index. The fund's performance should closely track the underlying index performance. Turnover of securities in an index fund's portfolio is minimal, as the only trades that take place are triggered by a change in the index. One company is replaced by another company. As a result, an index fund generally has a lower expense ratio due to reduced management fees, commissions, and taxation. Example: an investor does not believe in paying for the professional stock selection of a managed fund. In other words, the belief is that it is difficult to outperform the market as a whole or in part. Under these circumstances, recommending an index fund is appropriate. Foreign and international funds. Foreign stock funds and international funds invest only in the securities of foreign countries, companies that have their principal business activities outside the United States. Long-term capital appreciation is their primary objective, although some funds also seek current income. Global funds. Global funds and worldwide funds invest in the securities of both the United States and foreign countries. The risks involved in a fund concentrating in foreign securities are somewhat different from those for a domestic fund. When a portfolio has a large percentage of foreign securities, currency risk and political risk become paramount. These risks are elevated when investing in frontier funds, which invest in pre-emerging economies, as accounting and regulatory schemes are often much less rigorous than what we are used to here in the United States. Foreign funds and global funds are often purchased to diversify an investor's portfolio. After all, investing inside and outside the United States provides a more diversified portfolio than just investing within the United States. A foreign stock fund, international fund, or global or worldwide fund may be suggested with disclosure that the foreign and international funds provide greater diversification but have more risk than a domestic fund. Example: an investor has a well-diversified portfolio of domestic stocks and bonds. To increase the diversification of the portfolio, the investor may add a foreign or global fund. Take note: foreign stock funds are often purchased to diversify an investor's portfolio, decreasing volatility. Balanced funds. Balanced funds, also known as hybrid funds, invest in common stocks for appreciation and bonds for income. In a balanced fund, different types of securities are purchased according to a formula the manager may adjust to reflect market conditions. A balanced fund's portfolio might contain 60% stocks and 40% bonds. Example, a balanced fund may be appropriate for an investor who seeks a conservative balance between stocks and bonds. Asset allocation funds. Asset allocation funds split investments between stocks for growth, bonds for income, and money market instruments or cash for stability. Fund advisors switch the percentage of holdings in each asset category according to the performance or expected performance of that group. These funds can also hold hard assets, such as precious metals like gold and silver and real estate. A fund may have 60% of its investments in stock, 20% in bonds, and the remaining 20% in cash. If the stock market is expected to do well, the advisor may switch from cash and bonds to stock. The result may be a portfolio of 80% in stock, 10% in bonds, and 10% in cash. Conversely, if the stock market is expected to decline, the fund may invest heavily in cash and sell stocks. Many asset allocation funds are target funds. See the following, that target a specific goal, e.g. retirement, in a 5, 10, 15, or 20-year period. As the target year gets closer, the mix of investments becomes more conservative. Example, an investor seeks an investment for retirement in 20 years that performs well under most market conditions and is diversified by purchasing multiple types of securities. An asset allocation fund that targets the year of retirement may be appropriate. Target date funds. One increasingly popular investment option is a target date fund, sometimes referred to as a life cycle fund. According to a report by a large retirement plan provider, target date funds are offered by nearly 90% of employer-sponsored defined contribution plans, such as 401k plans. Target date funds are designed to help manage investment risk. With a target date in mind that is closest to the year an investor anticipates needing the money, i.e., retiring in 2030, a 2030 fund gradually reduces risk by changing the investments within the fund. That said, target date funds are not risk-free, even when the target date has been reached. FINRA is concerned that many investors surveyed do not understand that target date funds do not provide guaranteed income. Many investors also did not realize that similar sounding funds may, in fact, have different investments and risk profiles. Like all investments, target date funds can lose money if the stocks and bonds owned by the fund drop in value. And even though funds with identical target dates may look the same, they may have very different investment strategies and asset allocations that can affect how risky they are and what they are worth at any given time, including when and after retirement takes place. Bond funds. Bond funds have income as their main investment objective. Some funds invest solely in investment-grade corporate bonds. Others, seeking enhanced safety, invest only in government issues. Still others pursue capital appreciation by investing in lower-rated bonds for higher yields. Test topic alert. Remember, bonds pay interest, bond funds pay dividends if declared by the fund's board of directors. Dividends are typically paid on a quarterly or semi-annual basis, but there are income funds, both equity and debt-oriented, that pay monthly dividends. When interest rates rise, the prices of bonds and therefore bond funds fall, and vice versa. Conduit pipeline theory allows that the characteristics of the source of a conduit's dividend is transferred to the dividend. For example, in a municipal bond fund, the dividends from the fund comes from municipal bond interest. These dividends are treated as municipal bond interest for tax purposes. Corporate bond funds in general have higher credit risk than various government issues, but can still be classified as investment grade, safer or non-investment grade, riskier portfolios. The greater the risk, the greater the yield. High-yield bond funds provide the highest yields due to their increased credit risk, and are considered speculative investments. Tax-free, tax-exempt bond funds. Municipal bond funds invest in municipal bonds or notes that produce income, dividends, exempt from federal income tax, and are therefore known as tax-free bond funds. These funds are appropriate for investors in a high marginal tax bracket seeking income. Example, an investor is in a high marginal tax bracket and seeks income. A municipal bond fund may be appropriate. Principal protected funds. Principal protected funds are designed to guarantee the return of an investor's initial investment if the investment is held for a specified period. The guarantee does not apply if the investor liquidates before the specified period. These investments are good for investors concerned with safety, preservation of principal, and less concerned about capital appreciation. U.S. government funds. U.S. government funds purchase securities issued by the U.S. Treasury or an agency of the U.S. government, such as Ginnie Mae. Investors in these funds seek current income and maximum safety. Agency security funds are not considered quite as safe from default risk as U.S. government funds. Therefore, the yields on agency security funds will be higher than U.S. government fund yields. Agency funds. The word agencies is a generic term used to describe two types of bonds. 1. Bonds issued or guaranteed by U.S. federal government agencies, and 2. Bonds issued by government-sponsored enterprises, GSEs corporations created by Congress to foster a public purpose, such as affordable housing. Bonds issued or guaranteed by federal agencies, such as the Government National Mortgage Association, Ginnie Mae, are backed by the full faith and credit of the U.S. government, just like treasuries. This is an unconditional commitment to pay interest payments and to return the principal investment in full to you when a debt security reaches maturity. Bonds issued by GSEs, such as the Federal National Mortgage Association, Fannie Mae, and the Federal Home Loan Mortgage Corporation, Freddie Mac, are not backed by the same guarantee as federal government agencies. Agency securities are considered moral obligations of the federal government. There is a strong assumption that the federal government will back these issues if they default, so they are seen as safer than corporate debt. Example: an investor is risk-averse and seeks income, but the U.S. government bond fund yields are too low. An agency security fund may be appropriate. Learning Objective 2B. Relate the purchase and liquidation process for different investment companies. Buying and selling closed-end funds. A Series 6 licensed representative may sell shares of a closed-end management company as part of a primary offering. During a primary offering, the shares are offered by the prospectus. Once the shares begin to trade in the secondary market, the Series 6 representative may no longer enter trades for these securities. This point is likely to appear on the exam, but little else about the trading of closed-end funds will be on the exam. In the secondary market, an investor pays a brokerage commission in an agency transaction or pays a markup or markdown in a principal transaction. Closed-end funds may trade at a premium above or discount below relative to their NAV. Test topic alert. Closed-end funds trade in the secondary market where supply and demand sets the price, the bid and ask. Bid is similar to NAV, and bid is similar to public offering price, POP, but these are not the same thing. NAV and POP are covered elsewhere in this manual. UITs? UIT are sold via a prospectus directly from the issuer, so they are within the scope of a Series 6 representative. A UIT issues a set number of units that have a sales charge built into the price. Once the shares are sold, the investor may redeem the shares with the issuer. Issuers have different rules for when and how redemptions are processed. This variation in redemption processes means that specifics are not tested. However, all UIT have an end date where all securities are liquidated and the proceeds are distributed to the investor. Note that mutual funds do not have this type of end date as part of the structure of the fund. Mutual funds. Mutual funds are not traded in the secondary markets. An investor who wants to buy a fund buys the shares from the fund directly. A broker or fund sponsor may act as an intermediary for the transaction. In the same way, an investor who wants to redeem shares to get cash does so directly with the fund. All orders are processed based upon the next calculation of NAV. This process is called forward pricing. Net asset value, NAV, all mutual funds must calculate an NAV a minimum of once per business day. They may perform this calculation more than once per day, but few do. To calculate the NAV of a fund share, the fund starts with its total assets and subtracts out its liabilities, such as amounts due for securities purchased but not yet paid for and other expenses for the day. Total assets minus liabilities equals net assets of the fund. The fund then divides the net assets by the number of shares outstanding. This gives the NAV per share of the fund. Example: the ABC fund has total assets of $100 million and $5 million in liabilities. If it has 10 million shares outstanding, what is its NAV per share? Net assets. $100 million minus $5 million equals $95 million. NAV, $95 million divided by 10 million shares outstanding equals $9.50 per share. The NAV of a fund share is the amount the investor receives upon redemption. It must be calculated at least once per business day. A typical fund calculates its NAV at 4:00 p.m. Eastern Time every business day, because that is when the NYSE closes. The price the customer receives is the next NAV calculated after receipt of the redemption request. We always have to wait until the next available calculation to determine the value of shares redeemed or, for that matter, the number of shares purchased. Take note, funds may calculate NAV more than once a day if they so choose. If they calculate more than once a day, at least one of the calculations must be based on the portfolio value as of the close of that trading day. Take note, when an investor redeems shares of a mutual fund, the redemption price is based on the next NAV calculation after the redemption request is made. The fund must forward the proceeds of the redemption to the investor no later than 7 days after the redemption. Learning Objective 2C differentiate the fees, sales charges, and expenses for investment companies. These commissions or fees are charged by broker-dealers for trades in the secondary market. When buying or selling closed-end funds or ETF, most broker-dealers will charge a fee or commission for the trade. Take note, the term fees is used very broadly in the securities industry. It may be used to refer to sales charges, commissions, and other sorts of charges not related to trading. Test topic alert. Commissions are charged by broker-dealers for doing trades in the secondary markets for their customers. Net assets divided by shares outstanding equals NAV sales charges, loads. Sales charges, also called loads, are charges applied by a fund sponsor for buying or redeeming shares of a mutual fund. All sales commissions and expenses for an open-end fund are embedded in the POP or other fees. Sales expenses include commissions for the managing underwriter, dealers, brokers, and registered representatives, as well as all advertising and sales literature expenses. Mutual fund distributors use different methods to collect the fees for the sale of shares and to compensate reps on an ongoing basis. Trailer commissions. Front-end loads, difference between POP and NAV. Back-end loads, contingent deferred sales loads. Level loads, asset-based fees, provide trail commissions to the registered representative servicing the account. No-load funds, no sales charge imposed by the sponsor, but they may be subject to a commission charged by a broker-dealer. Loads, sales charges, are sometimes called distribution fees. Front-end loads, shares sold with a front-end load, are called classes shares. Front-end sales loads are the charges included in a fund's POP. The charges are added to the NAV at the time an investor buys shares. Front-end loads are the most common way of paying for the distribution services a fund's underwriter and broker-dealers provide. Classes shares are best for larger dollar investors, for the breakpoints and long periods. The sales price may not be discounted by a broker-dealer except when sold to another broker-dealer. The maximum sales load allowed under FINRA rules is 8.5%. Example, an investor deposits $10,000 with a mutual fund that has a 5% front-end load. The 5% load amounts to $500, which is deducted from the invested amount. In this example, $9,500 is invested, at NAV, in the fund's portfolio on the investor's behalf. Reducing front-end sales loads, breakpoints. Breakpoints are quantity discounts on open-end management company shares. Mutual funds, the greater the dollar amount of a purchase, the lower the sales charge. There is no industry standardized breakpoint schedule, so they can vary across mutual fund families. Example, a purchase of $1 to $9,999 has a sales charge of 8.5%. A purchase of $10,000 to $24,999 has a sales charge of 6.5%. A purchase of $25,000 to $49,999 has a sales charge of 4.0%. A purchase of $50,000 and more has a sales charge of 2.0%. Using this sample breakpoint table, assume a customer had $23,000 to invest. At that level of investment, the sales charge would be 6.5%. Being close to the $25,000 breakpoint, a registered representative would be required to inform the customer that for $2,000 more, the investment amount would qualify for the next breakpoint, reducing the sales charge to 4%. Take note, most mutual funds allow investors to combine orders among related accounts to achieve a better breakpoint. Individuals, spouses, and minor children may all combine in order to accomplish this. Corporations may do this among the different divisions and subsidiary companies. One group, the investment clubs, may not get breakpoints. Letters of intent. A person who plans to invest more money with the same mutual fund company may immediately decrease the overall sales charges by signing a letter of intent, LOI. In the LOI, the investor informs the investment company of the intention to invest the additional funds necessary to reach the breakpoint within 13 months. The LOI is a one-sided contract binding on the fund only. However, the customer must complete the investment to qualify for the reduced sales charge. The fund holds the extra shares purchased from the reduced sales charge in escrow. A customer who deposits the money to complete the LOI receives the escrowed shares. Appreciation and reinvested dividends do not count for the LOI. If a customer has not completed the investment within 13 months, he will be given the choice of sending a check for the difference in sales charges or cashing in escrowed shares to pay the difference. Example, referring back to the sample breakpoint schedule, a customer investing $9,000 is just short of the $10,000 breakpoint. In this situation, the customer might sign an LOI promising an amount that will qualify for the breakpoint within 13 months from the date of the letter. The initial $9,000 investment receives the 6.5% sales charge. An additional investment of $1,000 within 13 months also receives the 6.5% sales charge and fulfills the LOI rights of accumulation. Rights of accumulation, like breakpoints, allow an investor to qualify for reduced sales charges. The major differences are that rights of accumulation are available for subsequent investments and do not apply to initial transactions, allow the investor to use prior share appreciation to qualify for breakpoints, and do not impose time limits. The customer may qualify for reduced charges when the total value of shares previously purchased and shares currently being purchased exceed a certain dollar amount. For the purpose of qualifying customers for rights of accumulation, the mutual fund bases the quantity of securities owned on the higher of current NAV or the total of purchases made to date. Rights of accumulation allow an investor to combine prior investments in the fund with today's investment to determine today's sales charge. Referring back to the sample breakpoint schedule, once an investor accumulates $50,000 in the fund, each additional investment, no matter how small, qualifies for the lowest sales charge, in this case, 2%. Combination privilege. A mutual fund sponsor frequently offers more than one fund and refers to these multiple offerings as its family of funds. An investor seeking a reduced sales charge may be allowed to combine separate investments in two or more funds within the same family to reach a breakpoint. Exchange privilege. Many sponsors offer exchange or conversion privileges within their families of funds. Exchange privileges allow an investor to convert an investment in one fund for an equal investment in another fund in the same family, often without incurring an additional sales charge. This exchange is considered a taxable event, and there may be tax consequences. Breakpoint sale. Breakpoint sales, on the other hand, is a term used in the securities industry that means sales just below the breakpoint. Allowing a sale to occur in an amount just below a breakpoint can be viewed as an effort by representatives to share in the higher sales charges. This is inconsistent with just and equitable principles of trade. FINRA does not define near or just below a breakpoint, or how close a purchase can be to a breakpoint triggering a violation. Therefore, members must make certain that customers are advised of a fund's breakpoint schedule. The rule is in place because members and, indirectly, registered representatives could earn more concession dollars on a smaller customer investment with a higher sales charge than on a larger customer investment with a smaller sales charge. Take note, it is not the order below the breakpoint that is a violation. It is the failure to disclose the breakpoint that triggers a breakpoint sale violation. Back-end loads. Shares sold with a back-end load are called Class B shares. A back-end sales load, contingent deferred sales charge, or CDSC, or redemption fee is charged if and when an investor redeems mutual fund shares. The sales load, a declining percentage charge that is reduced annually, e.g., 6% the first year, 5% the second, 4% the third, etc., is applied to the proceeds of any shares sold in that year. The back-end load is usually structured to drop to zero after an extended holding period, such as 6 or 7 years. The sales load schedule is specified in a fund's prospectus. Once a share has been held long enough for the CDSC to drop off, the share is converted to a share and no sales charge is applied to this conversion. The CDSC is often based on the cost basis. Some funds may base the charge on the current NAV if it is lower than the purchase price. Class B shares are best for smaller dollar investors with long periods. Take note, with a back-end load, when an investor deposits $10,000 in a mutual fund, the full $10,000 is invested in the portfolio on the investor's behalf. The sales load is deducted only if the investor withdraws the money before the CDSC expires. This type of sales charge is intended to discourage frequent trading in mutual fund accounts. Level loads. Class C shares typically have a 1-year, 1% CDSC, a 0.75% 12B1 fee, discussed shortly, and a 0.25% shareholder services fee. Because these fees are relatively high and never go away, Class C shares are commonly referred to as having a level load. Class C shares are appropriate for investors who have short time horizons, as they become quite expensive to own if investing for more than 4 to 5 years. 12B1 asset-based fees. As an asset-based fee, 12B1 fees are often referred to as asset-based distribution fees. Named after the SEC rule that allows them, 12B1 fees are used to cover the costs of marketing and distributing the fund to investors. These 12B1 fees are also used to compensate registered representatives for servicing an account, trailer commissions, but shouldn't be confused with sales charges. The fee is deducted quarterly as a percentage of the fund's average total NAV. The maximum 12B1 fee is 0.75% for distribution and promotion. The fee must reflect the anticipated level of distribution services. Board of Directors. If the fund charges a 12B1 fee, a simple majority of the board must be made up of non-interested persons, not just 40%. Misuse of no-load terminology. A fund that has an asset-based 12B1 fee of more than 0.25% of average net assets cannot be described as a no-load fund. To do so violates the conduct rules. The violation is not alleviated by disclosures in the fund's prospectus. Adding a 12B1 fee requires a majority vote of the non-interested board members, the whole board, and the shares. The board reviews the 12B1 fee quarterly. Removing a 12B1 fee requires a vote of either the non-interested board members or the shares. The definition of a non-interested board member is found later in the lesson. Test topic alert. Expect questions about 12B1 fees and know the following points. A 12B1 fee is expressed as an annual amount, but is charged and reviewed quarterly. Charges covered by 12B1 fees include advertising, sales literature, and prospectuses delivered to potential customers, not fund management expenses. In order for a fund to market itself to the public as a no-load fund, the fund cannot charge more than 0.25% of average net assets for 12B1 fees. The maximum allowable 12B1 charge under FINRA rules is 0.75%, 75 basis points. FINRA does permit an additional 0.25% charge for shareholder services, 25 basis points, but that is treated separate from the 12B1 fee for marketing and promotion. Computing the sales charge percentage. For the following examples, we have a fund with an NAV of $10.00 and a POP of $10.50. When the NAV and the POP are known, the sales charge percentage can be determined. If the NAV, expressed in dollars, and the sales charge, expressed as a percentage, are specified, the formula for determining the POP of mutual fund shares is NAV $10 plus sales charge dollar amount 50 cents, a POP dollar amount $10.50. A mutual fund prospectus must contain a formula that explains how the fund computes the NAV and how the sales charge is added. The sales charge is always based on the POP, not on the NAV. Because of the sales charge, loaded funds should be recommended for long-term investing. Example: NAV equals $19 and POP equals $20. What is the sales charge percentage? The sales charge percentage is calculated by finding the sales charge amount, $20, $19, and dividing by the POP. Remember, sales charge is a percentage of the POP, not the NAV. $1 divided by $20 equals 5%. Assume a NAV of $19 and a sales charge of 5%. What is the POP? POP is found by dividing the NAV by 100% minus the sales charge percentage. $19 divided by 0.95 equals $21.05. In determining the POP when provided with the NAV, the answer has to be more than the NAV. If such a question has only one choice with a higher POP than the NAV, the correct answer should be immediately apparent. No-load funds. As the name implies, a no-load fund means that the fund does not charge any type of sales load. However, not every type of shareholder fee is a sales load. No-loads may charge fees that are not sales loads. For example, a no-load fund is permitted to charge purchase fees, account fees, exchange fees, and redemption fees, none of which are considered to be a sales load. Although a redemption fee is deducted from redemption proceeds, just like a deferred sales load, it is not considered to be a sales load. In addition, under FINRA rules, a fund is permitted to pay its annual operating expenses and still call itself no load. However, the combined amount of the fund's 12b-1 fees or separate shareholder service fees cannot exceed 0.25% of the fund's average annual net assets. No-load fund shares are often sold to investors directly by the fund. Mutual fund expense ratio. A fund's expense ratio compares the management fees and operating expenses, including any 12b-1 fees, with the fund's net assets. All mutual funds, both load and no load, have expense ratios. The expense ratio is calculated by dividing a fund's expenses by its average net assets. Stock funds generally have expense ratios between 1% and 1.5% of a fund's average net assets. Typically, more aggressive funds have higher expense ratios. For bond funds, the ratio is typically between 0.5% and 1%. A fund's expense ratio includes the manager's fee, administrative fees, trading, transfer agents, accountants, attorneys, etc., board of directors costs, and 12b-1 fees. This list is not exhaustive. The fund's expenses are a direct charge against the assets of the fund and are a drag on the fund's returns. Everything else being equal, a fund with higher expenses will provide lower returns. Take note, the expense ratio does not include sales charges or loads. Example, a fund with an expense ratio of 1.25% deducts $1.25 for every $100 of the fund's assets annually. Take note, you may see a reference to a fund's turnover ratio. Turnover ratio is a measure of how much trading a mutual fund does, how often it turns over the portfolio. Higher turnover ratios will tend to raise the fund's expense ratio. Trading costs money. Board of directors for mutual funds. All mutual funds have a board of directors that make strategic decisions in the management of the fund. The board is made up of interested and non-interested members. As mentioned earlier, at least 40% of the board must be non-interested. A non-interested board member is a person who has no position with the fund or the fund's sponsor outside of their role on the board. The requirement for non-interested board members is to ensure that the public is represented on the board. The board of directors oversees the 12b-1 fee policy, the investment manager, including negotiating the manager's contract, and the relationship and contract with the fund sponsor and other support services, e.g., the transfer agent, attorneys, and accountants. Take note, directors have a fiduciary responsibility to act in the best interest of the shareholders of the fund. Accumulation plans. Mutual funds have a number of arrangements to implement an investment program. A voluntary accumulation plan allows a customer to deposit regular periodic investments on a voluntary basis, minimum amounts found in the prospectus. The plan is designed to help the customer form regular investment habits while still offering some flexibility. Voluntary accumulation plans may require a minimum initial purchase and minimum additional purchase amounts. Many funds offer automatic withdrawal from customer checking accounts to simplify contributions. If a customer misses a payment, the fund does not penalize him because the plan is voluntary. The customer may discontinue the plan at any time. Take note, in a voluntary accumulation plan, once the account has been opened, the size and frequency of contributions are very flexible. Dollar cost averaging. One method of purchasing mutual fund shares is called dollar cost averaging, where a person invests identical amounts at regular intervals. This form of investing allows the individual to purchase more shares when prices are low and fewer shares when prices are high. In a fluctuating market and over time, the average cost per share is lower than the average price of the shares. However, dollar cost averaging does not guarantee profits in a declining market because prices may continue to decline for some time. In this case, the investor buys more shares of a sinking investment. Example: the following illustrates how average price and average cost may vary with dollar cost averaging. Month January, amount invested $600, price per share $20, number of shares 30, Month February, amount invested $600, price per share $24, number of shares 25. Month March, amount invested $600, price per share $30, number of shares 20. Month April, amount invested $600, price per share $40, number of shares 15. Total, amount invested $2,400, price per share $114, number of shares 90. The average price per share is the sum of the prices paid divided by the number of investments. $114 divided by 4 equals $28.50. The average cost per share is the total amount spent divided by the number of shares purchased. $2,400 divided by 90 equals $26.67. In this case, the average cost is $1.83 per share less than the average price. Test topic alert. It is most important to understand the concept of dollar cost averaging. It involves investing a fixed amount of money every period, regardless of market price fluctuation. If the market price of shares is up, fewer shares are purchased. If the market price of shares is down, more shares are purchased. Over time, if the market fluctuates, dollar cost averaging will achieve a lower average cost per share than average price per share. Take note, dollar cost averaging neither guarantees profit nor protects from loss. It merely results in a lower cost per share than the average price per share. Mutual fund withdrawal plans. In addition to lump sum withdrawals where customers sell all of their shares, mutual funds offer systematic withdrawal plans, normally a free service. Most mutual funds require a customer's account to be worth a minimum amount of money before a withdrawal plan may begin. Additionally, most funds discourage continued investment once withdrawals start. Not all mutual funds offer withdrawal plans, but those that do may offer plans that include one or more of the following. Fixed dollar plan. A customer may request the periodic withdrawal of a fixed dollar amount. Thus, the fund liquidates enough shares each period to send that sum. The amount of money liquidated can be more or less than the account earnings during the period. The amount of each check is known. How long the checks will last is determined by the performance of the fund and is therefore unknown. Fixed percentage or fixed share plan. Under a fixed percentage or fixed share withdrawal plan, either a fixed number of shares or a fixed percentage of the account is liquidated each period. Theoretically, a fixed percentage plan has a variable check and no end date, such as 1% of the fund distributed monthly. A fixed share plan has a variable check and a variable end date if dividends and capital gains distributions are reinvested. Fixed time plan. Under a fixed time withdrawal plan, customers liquidate their holdings over a fixed period, such as 10 years, 120 months. How long the checks will last is known. The amount of each check is determined by the performance of the fund and is, therefore, unknown. Withdrawal plans are not guaranteed. With fixed dollar plans, only the dollar amount to be received each period is fixed. All other factors, including the number of shares liquidated and a plan's length, are variable. For a fixed time plan, only the period is fixed. The amount of money the investor receives varies each period. Because withdrawal plans are not guaranteed, a registered representative must never promise an investor a guaranteed rate of return. Stress to the investor that it is possible to exhaust the account earlier than expected, and never use charts or tables unless a principal clears their use. Example: the West Valley Growth Fund, an open-end investment company, offers shareholders the option of liquidating their position by receiving a monthly payment for a specified number of years. Your customer, Robert, will receive a monthly check for the next 20 years. He understands that the checks will vary in amount. This is an example of a fixed percentage withdrawal plan. B, a fixed time withdrawal plan. C, dollar cost averaging. D, a fixed dollar withdrawal plan. The answer is B. This plan specifies the number of years a payment will be made, so a fixed time plan. Knowledge Check 2.1, Question 1. Open-end investment companies under the Investment Company Act of 1940 are required to redeem shares within 4 to 5 days of purchase, refunding the original purchase price in full to the purchaser. B, within 2 days after the tender of the shares to the company or its designated agent. C, at an amount equal to the most recently computed NAV. D, at an amount equal to the next calculated NAV. The answer is D. This is an example of forward pricing. Shares are redeemed at the next calculated NAV. Question 2. Your customer is interested in a growth fund that offers A shares and B shares. He would like to know the differences between them. Which of the following statements could you not make? AB shares typically convert to A shares after 5 to 7 years. B shares are purchased at NAV. C shares typically convert to B shares after 5 to 7 years. D shares are suited to large volume, long-term investments. The answer is C shares remain shares. They do not convert to B shares. Question 3. An investor has requested a withdrawal plan from her mutual fund and currently receives $600 per month. This is an example of which type of plan? A. Contractual. B. Fixed share periodic withdrawal. C. Fixed dollar periodic withdrawal. D. Fixed percentage withdrawal. The answer is C. The same amount every month indicate that this is a fixed dollar plan. Lesson 2.2. Variable insurance products. Introduction. Annuities and life insurance products make up a significant portion of most Series 6 limited representative sales. Many of those taking the SIE in the Series 6 are currently licensed to sell life insurance by their state and are looking to expand their practice. Many who are new to the industry start by dealing in investment companies and dealing in variable products as a part of learning the industry. Fixed annuities and life insurance are not securities, but the variable versions of the products are. The variable portion refers to the separate accounts. When an investor deposits money into a variable product, a portion, or all, of the funds are invested in a separate account. The separate account may also be divided into a number of sub-accounts. The investments made in this separate account are placed in a type of open-end management company. As open-end management companies are a type of security, and annuities and life insurance are types of insurance, selling these products requires both an insurance and a securities license. Learning Objective 2D. Recall the characteristics of variable annuities. An annuity is an insurance contract designed to provide retirement income. The term annuity refers to a stream of payments guaranteed for some specified period, for the life of the annuitant, until the annuitant reaches a certain age, or for a specific number of years. The actual amount to be paid out may or may not be guaranteed, but the stream of payments itself is. Because an annuity can provide an income for the rest of someone's life, the contract has a mortality guarantee, a guarantee tied to lifespan. When you think about a retiree's greatest fear, it is typically outliving her income. This product can take away that fear. Insurance companies offer fixed and variable annuities. With both, the annuitant makes after-tax lump sum or periodic payments to the insurance company, which invests the money in an account and grows it tax-deferred. At retirement, the funds become available for withdrawal, either as a lump sum or as periodic payments to the annuitant, typically for life. Withdrawals before the age of 59 to result in a 10% penalty, in addition to full income tax on anything over cost basis taken out of the account. Exceptions to the 10% penalty include death and annuitization under Rule 72T. Annuitization is discussed later in this unit. Usually, 100% of the investor's money goes to his annuity as no front-end load is charged. However, surrender charges will be applied if the contract is canceled within a stated number of years, often 7-10 years from issue. Take note, annuities discussed in this section are non-qualified. That is, they are funded with after-tax dollars. The money grows tax-deferred, and only the earnings are taxed at distribution. Fixed annuities. In a fixed annuity, investors pay premiums to the insurance company that are, in turn, invested in the company's general account. The insurance company is then obligated to pay a guaranteed amount of payout, typically monthly, to the annuitant based on how much was paid in. Note that the insurer guarantees a rate of return and therefore bears the investment risk. Because the insurer is the one at risk, this product is not a security. An insurance license is required to sell fixed annuities, but a securities license is not. Purchasing power risk, inflation risk, is a significant risk associated with fixed annuities. The fixed payment that the annuitant receives loses buying power over time due to inflation. Example: an individual who bought a fixed annuity in 1995 began to receive monthly income of $375 in 2005. Years later, this amount, which seemed a sufficient monthly income at the time, may no longer be enough to live on. Index annuity. In an effort to overcome the purchasing power risk of fixed annuities without the market risk of a variable annuity, the industry developed the index annuity. Index annuities are currently popular among investors seeking market participation, but with a guarantee against loss. Unlike a traditional fixed annuity, an index annuity credits interest to the owner's account using a formula based on the performance of a particular stock index, such as the S&P 500. If the index does well, the annuitant is credited with a specified percentage of the growth of the index, typically 80% or 90% of the growth. This is known as the participation rate. If the index does poorly, the annuitant may receive a guaranteed minimum interest rate, such as 1% or 2%. To give you an idea of how an index annuity might work, consider a participation rate of 80% and a minimum guarantee of 1%. If the index shows growth of 9% during the measurement period, the annuitant would be credited with 7.2% growth, 80% of 9%. If the index dropped 7%, the annuitant would receive the minimum guarantee of 1%. In addition to the participation rate, there is usually a cap rate. A typical cap might be 12%. This means that if the index annuity was pegged to the S&P 500 and that index increased 30% during the year, your gain would be capped at 12%. One other negative characteristic of these products is that they tend to have longer surrender charge periods, as long as 15 years, than other annuities, especially if there is a front-end bonus. Take note, index annuities are a type of fixed annuity. The only license required to sell index annuities is an insurance license. Variable annuities. Insurance companies introduce the variable annuity as an opportunity to keep pace with inflation. For this potential advantage, the investor assumes the investment risk rather than the insurance company. Because the investor takes on this risk, the product is considered a security. It must be sold with a prospectus by individuals who are both insurance licensed and securities licensed. The premium payments for variable annuities are invested in the separate account of the insurer. The separate account is comprised of various sub-accounts that behave like mutual funds. We just can't call them mutual funds. These accounts will have a variety of investment objectives to choose from, such as growth, income, and growth in income. The returns in this separate account are not guaranteed and therefore, a loss of principal is possible. As with all recommendations, suitability of any purchase is number one. However, in light of the large number of cases involving variable annuities, where there was failure to supervise egregious unethical behavior, FINRA Rule 2330 evolved. This rule applies to recommended purchases and 1,035 exchanges of deferred variable annuities, not immediate, and recommended initial sub-account allocations. Deferred and immediate annuities are discussed later under purchasing annuities. A 1,035 exchange is a tax-free exchange between like contracts. The IRS allows annuity and life insurance policyholders to exchange their policies without tax liability. For example, if a life insurance policyholder wanted to exchange her policy with that of another company, she could transfer all cash values from the old policy into the new policy without recognizing any tax consequences. This 1,035 exchange provision applies to transfers of cash values from annuity to annuity, life to life, and life to annuity. It cannot be used for transfers from an annuity to a life insurance policy. Test topic alert. FINRA is concerned about Section 1035 exchange abuses, where the registered representative emphasizes the tax-free nature of the exchange without pointing out possible disadvantages. Those include possible surrender charges on the old policy, a new surrender charge period on the new policy, and possible loss of a higher death benefit that existed on the old policy. The representative and a principal of the firm must believe that the customer has been informed, in general terms, of various features of deferred variable annuities, such as the potential surrender period and surrender charge, potential tax penalties if customers sell or redeem deferred variable annuities before reaching the age of 59 1/2, mortality and expense fees, investment advisory fees, potential charges for and features of riders, the insurance and investment components of deferred variable annuities, and market risk. In addition, the firm must ask the customer if he had an exchange of a variable annuity at another broker-dealer within the last 3 to 6 months. Key features of fixed annuities and variable annuities. Fixed annuity. Payments made with after-tax dollars. Payments invested in the general account portfolio of fixed income securities and real estate. Who assumes investment risk? Insurer. Is it a security? No. Rate of return. Guaranteed. Administrative expenses. Fixed. Guaranteed lifetime income option. Yes. Monthly payments. Constant. Purchasing power risk protection. No. Regulation. Subject to insurance regulation. Variable annuity. Payments made with after-tax dollars. Payments invested in the separate account portfolio of equity, debt or mutual funds. Who assumes investment risk? Annuitant. Is it a security? Yes. Rate of return. Depends on performance of separate account. Administrative expenses. Fixed. Guaranteed lifetime income option. Yes. Monthly payments. May fluctuate up or down. Purchasing power risk protection. Typically provides some protection. Regulation. Subject to insurance and securities regulation. Although annuitants of variable annuities can choose a guaranteed monthly income for life, the amount of monthly income received is dependent on the performance of the separate account. Monthly income either increases or decreases, as determined by the separate account performance. Investors may purchase a combination annuity to receive the advantages of both the fixed and variable annuities. In a combination annuity, the investor contributes to both the general and separate accounts, which provides for guaranteed payments as well as inflation protection. Test topic alert. Whenever you see the term variable, as in variable annuity or variable life, discussed later, 2 licenses are required for the sale, an insurance license and a securities license. Suitability must be determined and a prospectus must be delivered before or with solicitation of the sale. Investing variable annuity premium dollars. Purchasing annuities. Insurance companies offer a few purchase arrangements for annuities. The various purchasing plans are discussed next. Aggregate fees include not only sales charges on the front end, but also those levied upon surrender, commonly referred to as conditional deferred sales loads, CDSLs. In many cases, there is no load to purchase, but if surrender, other than through annuitization, occurs during the early years of the contract, the charges can be significant. An investor is offered a number of options when purchasing an annuity. Payments to the insurance company can be made either with a single lump sum payment or periodically on a monthly, quarterly, or annual basis. A single premium deferred annuity is purchased with a lump sum, but payment of benefits is delayed until a later date selected by the annuitant. A periodic payment deferred annuity allows investments over time. Benefit payments for this type of annuity are always deferred until a later date selected by the annuitant. An immediate annuity is purchased with a lump sum, and the payout of benefits usually commences within 60 days. Test topic alert. There is no such thing as a periodic payment immediate annuity. Bonus annuities. Direct financial benefits are sometimes offered with annuities called bonus annuities. These benefits include enhancement of the buyer's premium, with the insurance company contributing an additional 3%-5% to the premium payment. This comes with a cost, of course, in the form of higher fees and expenses and longer surrender periods than the typical 7-10 years of standard contracts. Recommendations to customers must include the additional costs as well as the benefits of the bonuses and enhancements. The bonus amount is credited to the customer's account on the initial investment. Annuity sale charges. Although there are no stated maximum sales charges on variable annuities, the SEC has charged FINRA with the responsibility of ensuring that they are fair and reasonable. As a practical matter, most annuities, both fixed and variable, are sold with little or no sales charge. Instead, there is a surrender charge, think CDSC or CDSL, for early termination. This surrender period is longer for bonus annuities and generally the longest for index annuities. Accumulation phase. A variable annuity has 2 distinct phases. The growth phase is its accumulation phase, while the payout phase is its annuity phase. A contract owner's interest in this separate account is known as either accumulation units or annuity units, depending on the contract phase. Accumulation units vary in value based on this separate account performance. The payout phase, when the annuitant decides to begin receiving payments from the annuity, she may choose to annuitize the contract and choose the desired settlement option. Although not required, if annuitized, the owner enters into a contractual obligation with the insurance company for the systematic distribution of the asset. Once annuitized, the money will be distributed per the payout option chosen, discussed later. At that point, the accumulation units purchased over time will be converted into a fixed number of annuity units. This becomes one of the factors used to calculate the payout each month during retirement. Annuity units vary in value based on this separate account performance. Test topic alert. As mentioned earlier in our comparison chart with mutual funds, accumulation unit values are computed daily on a forward pricing basis. As you will soon see, annuity unit values are computed monthly based on actual performance versus the assumed interest rate. Receiving distributions from annuities. An annuity offers several payment options for money accumulated in the account. The investor can withdraw the funds randomly in a lump sum or annuitize the contract, receive monthly income. Annuitization. If the investor chooses annuitization, the amount of the monthly check is dependent on several factors. Gender. Biological females typically live longer than males. Therefore, the check would be less for a female. Amount of money in the contract. More money equals a bigger check. Age. The older one is, the larger the check will be. Payout option, reviewed next. Investment return versus assumed interest rate, AIR, for variable annuities, reviewed shortly. Take note, annuities are designed to help fill the retirement income gap that many people experience. The payout is calculated using the earlier criteria, called SOPI, sex amount, age, payout option, and interest rate. Payout option. If the annuitant wishes to receive scheduled payments for life, she may annuitize, in which case she must select a payout option, such as life annuity, also known as straight life or life only, life annuity with period certain, joint life with last survivor annuity, or unit refund option. Life annuity / straight life. If an annuitant selects the life income option, the insurance company will pay the annuitant for life. When the annuitant dies, there are no continuing payments to a beneficiary. Money remaining in the account reverts to the insurer. Because there is no beneficiary during the annuitization, this represents the largest monthly check an annuitant could receive for the rest of her life. The insurance company has no further obligation at death. Take note, the life annuity probably would not have been a good choice if the annuitant died after receiving only 1 month's payment. With the life income option, all money accumulated that was not paid out at the time of the annuitant's death would belong to the insurer. Life annuity with period certain. The following options are a little less risky, because they allow for payments to a beneficiary. To guarantee that a minimum number of payments are made even if the annuitant dies, the life with period certain option can be chosen. The contract will specifically allow the choice of a period of 10 or 20 years, for instance. The length of the period certain is a choice that is made when a payout option is selected. The annuitant is guaranteed monthly income for life with this option, but if death occurs within the period certain, a named beneficiary receives payments for the remainder of the period. Because there is a named beneficiary for the period certain, the size of this check will be smaller than a straight life option. The insurance company is obligated to pay the named beneficiary an income if death occurs during the period certain. Take note, to illustrate the life annuity with period certain option, assume a 70-year-old client selects a life annuity with a 10-year period certain. If the annuitant lives to be 120 years old, annuity payments are still made by the insurer. But if the annuitant dies after receiving payments for 2 years, the beneficiary will receive payments for 8 more years. Joint life with last survivor annuity. The joint life with last survivor option guarantees payments over 2 lives. It is often used for spouses, because the insurance company is obligated to pay a check over 2 lifetimes. This check is considered to be smaller than a life with period certain option. Example: when one spouse dies, the surviving spouse would continue to receive payments as long as she lives. Typically, the payment amount is reduced for the survivor. Unit refund option. If the annuitant chooses this option, a minimum number of payments are made upon annuitization. If value remains in the account after the death of the annuitant, it is payable in a lump sum to the annuitant's beneficiary. This option may be added as a rider to one of the others. For test purposes, this option represents the smallest check a person could receive for the rest of his life. Take note, the unit refund option is the only lifetime annuitization option that guarantees all of the money in the contract will be distributed. If unit refund is chosen for a $100,000 contract, the insurance company guarantees that a minimum of $100,000 will be distributed and also guarantees a monthly check for life. Therefore, more than $100,000 may be distributed, but never less. Unit refund is sometimes offered as a rider. Assumed interest rate. If the annuity is variable, the actuarial department of the insurance company determines the initial value for the annuity units and the amount of the first month's annuity payment. At this time, an assumed interest rate, AIR, is established. The AIR is a conservative projection of the performance of the separate account over the estimated life of the contract. The value of an annuity unit and the annuitant's subsequent monthly income will vary depending on separate account performance as compared to the AIR. To determine whether the monthly payment will increase, decrease, or stay the same as the previous month, the following rules apply. If separate account performance is greater than the AIR, next month's payment is more than this month's. If separate account performance is equal to the AIR, next month's payment stays the same as this month's. If separate account performance is less than the AIR, next month's payment is less than this month's. Example, assume an AIR of 4% and that the actuaries have determined the first payment to be $1,000. Note that these figures are for illustrating the concept. They are not exact. Month 2's separate account performance is 6%, which is greater than the AIR. The next check goes up. Month 3's separate account performance is 4%, right at AIR. The next check received equals the last check received. Month 4's separate account performance is 3%, which is below AIR. Therefore, the next check received will be less than the last check received. Month 5's separate account performance is 3% again, which, although the same as Month 4's, is still below AIR. The next check is therefore less than that of the last. Month 6, separate account performance is not shown, but if separate account performance is above the AIR of 4%, the next check will be more than $950. If it is below the AIR of 4%, the next check will be less than $950, and if it is exactly 4%, the check will remain $950. Take note, consider this. If the AIR is 4% and the separate account always returns 4%, the check would never change. Surrender. If she wishes, the annuitant may simply cash in her annuity. In this case, her cost base is the total amount she has invested. She will be liable for income tax on the growth, plus a 10% penalty on the growth if she is under the age of 59. 1/2. Death of annuitant. If the annuitant dies during the accumulation period, the death benefit takes effect. Her beneficiary is guaranteed either the total value of the annuity or the total amount invested, whichever is greater, and is liable for income tax on any growth, but there is no 10% penalty if the beneficiary is under the age of 59. 1/2. Suitability. A variable annuity can be a very important part of one's financial well-being if utilized correctly. However, there are suitability issues to consider. Variable annuities are meant to bring supplemental income into the household at a time in one's life when the income is needed. Therefore, supplemental income for retirement, not preservation of capital, should be the catalyst to consider a variable annuity. Here are some general rules of thumb regarding the suitability of variable annuities. Variable contracts are considered most suitable for someone who can fund the contract with cash. In other words, enticements to cash out a life insurance policy or an existing annuity, either of which might come with high surrender charges, is considered abusive and not a suitable recommendation. Refinancing a home or withdrawing equity from a home to fund a purchase is never considered suitable. Variable contracts are not suitable for anyone who might need the lump sum of cash invested in the variable annuity at a later time for any reason. Anticipating buying a home, needing cash for your children's college education, or any other upcoming expense would need to be considered outside the variable annuity investment. Growth in a variable annuity is tax-deferred until withdrawal, so they are generally not considered suitable for placement in a tax-favored account like an IRA. Variable annuity contracts are insurance company products that invest in a portfolio of securities via their separate account. If someone has a low risk tolerance or is wary of the stock market, a variable annuity is not likely a very suitable recommendation for that individual. Maximum contributions to all other retirement savings vehicles available to an individual should be made before a variable annuity is considered a suitable recommendation. In other words, they are best considered supplements to retirement income one can already anticipate, like pensions and IRA or 401k distributions. Taxation. As stated, variable annuities are designed to be a supplement to a customer's retirement savings. Growth within this separate account is not subject to taxation until it is withdrawn. Once withdrawn, it is considered ordinary income for the year of the withdrawal. Note that on the exam, a variable annuity will be non-qualified, not held in a qualified plan like an IRA, unless the question specifies otherwise. When a person withdraws the entire amount of the annuity, any growth is taxed as income that year. If an owner annuitizes the variable annuity, converts the lump sum into a life income, then a portion of the regular payment is considered income, and part is considered return of principal. This principal portion is called the exclusion ratio. Note that a return of principal is not taxable. However, if the owner withdraws a portion of the variable annuity on a random basis, the growth, the part subject to taxation, comes out first. All the growth in the separate account must be withdrawn before you get to the principal. Also, if the annuitant is under the age of 59 1/2, the taxable portion of a withdrawal is subject to a 10% penalty. Voting rights. Unit holders of units of a separate account within a variable annuity have voting rights similar to those of mutual fund shareholders. A change of the objective of the account or a change of investment manager is voted on by the owners of the variable annuity. Test topic alert. Though not forbidden, several regulators, including FINRA and the SEC, view the use of variable annuity inside of a tax-advantaged account, like an IRA, to be generally unsuitable. Take note. Remember that a separate account within the annuity is a type of management company and is a security requiring registration with the SEC. It is the separate account that's registered, not the annuity. Learning Objective 2E. Recall the characteristics of variable life insurance. Life insurance provides a death benefit to a named beneficiary in the event of an insured's premature death. There are many variations of whole life and term insurance that serve different needs. We will review these policies and focus on one considered a security. Permanent life insurance is designed to last until at least age 100 or the death of the insured, whichever occurs first. These policies also accrue cash value that may be borrowed for living needs. An insurance license is required to sell life insurance. The premium for permanent life insurance is calculated according to the policy owner's health, age, and sex, as well as the policy's face amount at issue. Permanent life insurance is not a security and is not sold as an investment. Variable life insurance has a fixed, scheduled premium but differs from whole life insurance in that the premiums paid are split. Part of the premium is placed in the general assets of the insurance company. These general assets are used to guarantee a minimum death benefit. The balance of the premium is placed in this separate account and represents the cash value of the policy. Because the cash value is invested in the separate account, which fluctuates in value, the cash value is not guaranteed. The policy's death benefit may increase above the minimum guaranteed amount as a result of investment results, but may never fall below the minimum, as long as premiums are paid. Take note, because a variable life insurance policy has a minimum death benefit, the premiums necessary to fund this part of the death benefit are held in the insurer's general account. Any policy benefit that is guaranteed is invested in the insurer's general account. Any premium above what is necessary to pay for the minimum death benefit is invested in this separate account. This portion of the premium is subject to investment risk. Therefore, variable life insurance is also defined as a security. As long as premiums are paid, the policy remains in force even if the separate accounts lose money every year. Once the premium has been determined and the expenses have been deducted, the net premium is invested in this separate account. There will be several subaccounts to choose from, including the following: Growth Subaccount, Income Subaccount, Balanced, Index or Indices, and Money Market. Take note, death benefits from a life insurance policy are generally received free of income taxes. Variable Life Prospectus Delivery. Because a variable life insurance policy is considered a security as well as an insurance product, a prospectus is required just as with any new issue. The prospectus must be delivered before or at the time of solicitation and cannot be altered in any way. No highlighting or writing in the prospectus. Assumed interest rate and variable death benefit. The death benefit payable under a variable life insurance policy is adjusted on an annual basis and can increase or decrease based on the performance of the separate account compared to an AIR. So one of the benefits of variable life is that the death benefit may adjust upward and possibly keep pace with inflation. If the separate account returns are greater than the AIR, these extra earnings are reflected in an increase in death benefits and cash value. If the separate account returns equal the AIR, actual earnings meet estimated expenses, resulting in no change in the death benefit. Should the separate account returns be less than the AIR, the contract's death benefit will decrease. However, it will never fall below the amount guaranteed at issue. Take note, the variable death benefit is adjusted annually. If there have been several months of negative performance, they must be offset by an equivalent positive performance before the variable death benefit can be adjusted upward. Hypothetical illustrations. The policy owner's cash values reflect the investments held in the separate account. The individual policy's cash value must be calculated at least monthly. The cash value, like the death benefit, may increase or decrease depending on the separate account performance. If performance has been negative, the cash value may decrease to zero, even if the contract has been in force for several years. When illustrating hypothetical returns for variable life insurance cash value, the maximum gross return is 12%, provided a 0% return is also illustrated. For scheduled premium policies, cash value may be accessed through surrendering the policy or taking a loan. Take note, the AIR has no effect on cash value accumulation in a variable life policy. The cash value will grow whenever the separate account has positive performance. The AIR, however, does affect the death benefit. Just remember the rules for variable annuities. The rules for the death benefits are analogous. If the separate account performance for the year is greater than the AIR, the death benefit will increase. If the separate account performance for the year is equal to the AIR, the death benefit will stay the same. If the separate account performance for the year is less than the AIR, the death benefit will decrease. Loans, like traditional whole life, a variable life contract allows the insured to borrow against the cash value that has accumulated in the contract. Loans are not considered constructive receipt of income and therefore are received income tax-free. However, certain restrictions exist. Usually, the insured may only borrow a percentage of the cash value. The minimum percentage that must be made available is 75% after the policy has been in force for 3 years. There is no scheduled repayment of a loan. However, if the death benefit becomes payable and a loan is outstanding, the loan amount is deducted from the death benefit before payment. The interest rate charged is stated in the policy. If an outstanding loan reduces cash value to a negative amount, the insured has 31 days to deposit enough into his account to make it positive. If he fails to do so, the insurance company will terminate the contract. If this happens, the loan, of course, need not be repaid. Contract exchange. During the early stage of ownership, a policy owner has the right to exchange a variable life contract for a traditional fixed benefit whole life (WL) contract. The length of time this exchange privilege is in effect varies from company to company, but under no circumstances may the period be less than 24 months. The exchange is allowed without evidence of insurability. If a contract is exchanged, the new WL policy has the same contract date and death benefit as the minimum guaranteed in the variable life contract. The premiums equal the amounts guaranteed in the new WL contract, as if it were the original contract. Test topic alert: 2 testable facts about the contract exchange provision are as follows. The contract exchange provision must be available for a minimum of 24 months. No medical underwriting evidence of insurability is required for the exchange. Sales charges. The sales charges on a fixed premium variable life contract may not exceed 9% of the payments to be made over the life of the contract. The contract's life, for purposes of this charge, is a maximum of 20 years. For those of you familiar with life insurance compensation, the effect of this is that renewal commissions are earned up to the 20th anniversary of policy issue. Refund provisions. The insurer must extend a free look period to the policy owner for 4 to 5 days from the execution of the application or for 10 days from the time the owner receives the policy, whichever is longer. During the free look period, the policy owner may terminate the policy and receive all payments made. The refund provisions extend for 2 years from issuance of the policy. If, within the 2-year period, the policy owner terminates participation in the contract, the insurer must refund the contract's cash value, the value calculated after the insurer receives the redemption notice, plus a percentage of the sales charges deducted. After the 2-year period has lapsed, only the cash value need be refunded. The insurer retains all sales charges. Test topic alert. Several testable facts about sales charges and refunds are as follows. The maximum sales charge over the life of the contract is 9%. A policy owner who wants a refund within 4 to 5 days receives all money paid. After a variable life policy has been in effect for 2 years, the surrender value of the policy is the cash value. Suitability of variable life insurance. There must be a life insurance need. The applicant must be comfortable with this separate account and the fact that the cash value is not guaranteed. The applicant must understand the variable death benefit feature. A prospectus must be delivered before or at the time of solicitation. Test topic alert. Never recommend life insurance unless the customer has a need for life insurance. Practice question. All of the following require a representative to hold an appropriate securities license except an equity index annuity. B. Variable life insurance policy. C. Variable annuity. D. Treasury bond fund. The answer is A. An equity index annuity is considered a fixed annuity. Only an insurance license is required. Knowledge Check 2.2, Question 1. Which of the following types of annuity contracts would your customer not be able to purchase? A. Periodic payment deferred annuity. B. Periodic payment immediate life annuity. C. Lump sum payment immediate life annuity. D. Lump sum payment deferred annuity. The answer is B. There is no periodic payment immediate annuity. It makes no sense to make periodic payments into an annuity while taking annuitized payments out. Once annuitized, no more contributions may be made to an annuity. Question 2. Which of the following annuities includes augmentation of the premium payments by the insurance company? A. Fixed annuity. B. Combination annuity. C. Equity index annuity. D. Bonus annuity. The answer is D. A bonus annuity provides an immediate credit to the balance of an annuity upon the initial investment. Note that surrender fees will apply if the customer tries to take the money out early. The fees will more than offset the bonus for the first several years. Question 3. An insurance company offering a variable annuity makes payments to annuitants on the 15th of each month. The contract has an AIR of 3%. In July of this year, the contract earned 4%. In August, the account earned 6%. If the contract earns 3% in September, the payments to annuitants in October will be A. Greater than the payments in September. B. Less than the payments in September. C. The same as the payments in September. D. Less than the payments in August. The answer is C. The contract earned 3% in September. The AIR for the contract is 3%. Payment size in October will not change from that of September. Question 4. A customer is considering the purchase of either a variable annuity or variable life insurance. In discussing the merits of the respective contracts, a registered representative may state that all of the following characteristics are common to both contracts except all gains are tax deferred. B. The AIR is a factor in determining certain values. C. Death benefits are received income tax-free. D. The representative must have a securities license and an insurance license. The answer is C. Death benefits in a life insurance policy are free of income tax. Any gains received from an annuity are subject to taxes. Lesson 2.3. Investment Taxation. Learning Objective 2F. Differentiate long-term capital gains, short-term capital gains, and income taxation, including reinvestments. Long-term capital gains. A long-term gain is taxed differently than a short-term gain. To receive long-term capital gains treatment, a position must have been held for more than 1 year. This means that any position that was held for 1 year or less is short-term. There is a difference in how long-term gains and short-term gains are taxed, so the determination that a position has been held long enough to receive long-term capital gains treatment is important. Long-term capital gains are taxed at an advantaged rate. The actual rate is not tested, as the rate changes regularly. The long-term rate is, for test purposes, always lower than the investor's ordinary income tax rate. Take note, mutual funds that realize capital gains pay the gains out to investors once per year. Short-term capital gains made from assets held for 1 year or less, are taxed as ordinary income. For test purposes, the ordinary income tax rate will exceed the long-term cap gains tax rate. Long and short-term capital losses. The difference in how long and short-term capital losses are handled for taxes is not a testable point. However, what could be tested is the use of capital losses. Capital losses may be used to offset capital gains on a dollar-for-dollar basis. Furthermore, if an investor has losses that exceed gains in a given year, she may use up to $3,000 of those losses to reduce ordinary income. If an investor still has losses in excess of her gains and the $3,000, she may carry those losses into the following tax year. These are called carry-forward losses, and they may be carried forward until used, with no time limit, indefinitely. Example: in the prior tax year the investor has the following: capital gains, $24,000, capital losses, $32,000, net losses, $8,000. The investor may reduce his ordinary income by $3,000 and may carry the remaining $5,000 of losses into the new tax year. Take note, unrealized gains and losses are found on open positions. Unrealized gains and losses have no tax impact. If you buy a stock for $20 a share and the stock rises to $25 a share, you have a gain of $5 a share. The gain is unrealized and has no tax implications, but it likely pleases you. From a tax perspective, nothing has happened. If you were to then sell the stock, closing the position, the $5 would become a realized capital gain and taxes would be due. Take note, remember that when a customer sells a portion of a position, the IRS default is that the oldest position is sold first, called FIFO, first in, first out. Wash sale. Consider that an investor can use capital losses to offset capital gains. A wash sale is an attempt to create a loss for tax purposes, sell a loss, when one's intent is to still maintain ownership of the securities. Any repurchase of the same or substantially equal security within 30 days before or after the date establishing the loss would trigger a wash sale. If this occurs, the loss established at the time of the sale is disallowed for tax purposes. Take note, a wash sale is not illegal. Attempting to use the losses from the wash sale to reduce taxes is illegal. Example, October 21, 2013, buy 1,000 XYZ at 30. November 17, 2014, sell 1,000 XYZ at 28. Note that a loss has been established. November 23, 2014, buy 1,000 XYZ at 27. Note that the long position in XYZ stock has been reestablished a few days after the sale that had created the loss. The sale is now considered a prohibited wash sale, and the loss is disallowed for tax purposes. 2 additional points on wash sale rules should be noted. First, the rule applies to recreating long positions, as in the previous example, and to recreating short positions. Second, the rule applies for attempts to recreate the same position using not only the exact same security, but also substantially identical securities. For instance, a long stock position in XYZ stock is closed with a sale for a loss. Not only does the wash sale rule prohibit reestablishing the position by repurchasing XYZ stock, but it would also recognize the purchase of XYZ call options or rights that can be exercised to purchase shares of XYZ stock as a way of reestablishing the position if the options or rights are exercised. In this light, the XYZ call options or rights would be considered substantially identical to the XYZ stock. Also, the purchase of a convertible bond or convertible preferred stock from the same issuer would trigger a wash sale. Take note, any position that may be converted or exercised into the same security as the one that was sold for a loss may be substantially identical. Cost basis on inheritance and gifts. Securities that are received as a gift from a living person retain the donor's cost basis and holding period. Securities that are inherited have a cost basis based on their value as of the date of decedent's death, or the estate may choose an alternate date of 6 months after death. Inherited shares are considered a long-term holding for tax purposes. Interest. Interest from bonds and other debt securities is part of portfolio or investment income. A customer's investment income is added to her ordinary income for tax purposes. Dividends. Dividends are payments from profit paid to shareholders. They may be either qualified or non-qualified. Qualified dividends. Qualified dividends are taxed at the investor's capital gains tax rate. This rate is lower than the investor's ordinary income tax rate. In order for a dividend to be qualified, it must meet the following criteria. The dividend must be from stock of a U.S. corporation, an American depository receipt, or a foreign corporation that is eligible under a tax treaty. The position must have been held for more than 60 days during the 121-day period that begins 60 days before the ex-dividend date. Dividends for preferred stocks are normally qualified, but the actual holding period is not tested. Example, Linus purchases stock in the Softer Blanket Company on Monday, March 9, 4 days before the ex-dividend date of March 13. The holding period begins on the settlement date, Wednesday, March 11. The 121-day period begins on January 13, 60 days before the ex-date, and ends April 22. In order for the dividend to be considered a qualified dividend, Linus must own the stock for more than 60 days total within the 121-day period. Non-qualified dividends. If a dividend does not meet the previous criteria, it will be treated as a non-qualified dividend. Non-qualified dividends are taxed at the investor's ordinary income tax rate. Learning Objective 2G recall the pipeline theory of taxation and how it applies to investment companies. Because an investment company is organized as a corporation or trust, one might assume its earnings are subject to tax. Consider, however, how an additional level of taxation shrinks a dividend distribution's value. Triple taxation of investment income may be avoided if the mutual fund qualifies under Subchapter M of the Internal Revenue Code. If a mutual fund acts as a conduit or pipeline for the distribution of net investment income, NI, the fund may qualify as a regulated investment company, subject to tax only on the amount of investment income the fund retains. The investment income distributed to shareholders escapes taxation at the mutual fund level. Subchapter M requires a fund to distribute at least 90% of its NII to shareholders. The fund then pays taxes only on the undistributed 10%. If the fund distributes 89%, it pays taxes on 100% of NII. Example, the Windmill Balanced Fund holds a mix of stocks and bonds. In the current year, they received $500,000 in dividends from stocks and $600,000 in interest from bonds. Over the year, they have had $100,000 in expenses. Dividends, $500,000. Interest, $600,000. Total income, $1,100,000. Expenses, $100,000. Net investment income, $1 million. The fund must distribute at least $900,000, 90% of NII, to avoid taxes on the amount it distributes to shareholders. It will still pay taxes on the NII it retains. If the fund distributes less than $900,000, the tax bill is based on the entire NII, $1 million. The fund's shareholders pay tax on the amount they receive. Test topic alert: dividends are reported to shareholders of Form 1099 DIV. Remember that the investor pays taxes on all dividends, whether received as cash or reinvested. If a mutual fund customer is reinvesting dividends or capital gains, that reinvestment will be based on the NFE, not public offering price, on the record date. Knowledge Check 2.3 Question 1. All of the following are normally taxed at the investor's ordinary income tax rate except A. Qualified dividends, B. Interest from a corporate bond, C. Non-qualified dividends, D. Short-term capital gains. The answer is A. Qualified dividends are normally taxed at the investor's capital gains tax rate. Non-qualified dividends, interest from most debt instruments, and short-term gains are taxed at the investor's nominal, ordinary income, tax rate. Question 2. Casey sells 100 shares of XYZ Corporation common stock on January 21 for $22 per share. The shares were purchased 3 years ago for $23 per share. On February 1, Casey buys one XYZ Corporation bond. The bond is convertible into 25 XYZ Corporation shares. How much capital loss may Casey claim for this trade? A. $75, B. $25, C. $100, D. None? The answer is A. Casey has a $75 loss. The purchase of the convertible bond, a substantially equal security, washed away the loss of 25 of the 100 shares. As Casey only reestablished 25 of the 100 share position, the $1 per share loss may still be claimed on the remaining 75 shares. Question 3. To qualify as a conduit, a mutual fund must pay out a minimum of A. 90% of gross investment income, B. 90% of net expenses, C. 90% of net investment income, NII, D. 95% of net investment income, NII. The answer is C. To qualify for this tax treatment, the fund must pay out 90% of NII.
Unit 3 Customer Accounts. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 3 A. Recall the different types of accounts and account registrations. Learning Objective 3B. Identify the requirements and approvals needed for opening different types of accounts. Learning Objective 3C. Group qualified and non-qualified retirement plans. Learning Objective 3D. Recall the characteristics of different retirement plans. Learning Objective 3E. Identify characteristics of employer-sponsored plans. Learning Objective 3F. Define ERISA and its application to private sector retirement plans. Learning Objective 3G. Recall the components of a Customer Identification Program, CIP, and the Know Your Customer, KIC, rule. Learning Objective 3H. Identify customer protection and information security rules. Learning Objective 3I. Classify the types of third-party account authorizations. Learning Objective 3J. Identify the procedure for account registration changes and transfers. Introduction. As a registered representative, your relationship with a customer begins with the opening of an account. It is the action of opening an account that turns a prospect into a customer. It is important to open the right type of account with the correct account features to help your customers accomplish their investing goals. Unit 3 covers the types of account registrations and the different features of a brokerage account. The unit also dives into the approvals needed for different accounts, the authorizations needed for different types of third-party managed accounts, as well as the process for making changes and transferring accounts. Your exam will include approximately 5 questions from the topics covered in Unit 3. Lesson 3.1, Basic Accounts. Learning Objective 3 or recall the different types of accounts and account registrations. There are several different types of registrations available for brokerage accounts. Individual accounts. An individual account has one beneficial owner and is sometimes called a single account. The account holder is the only person who may control the investments within the account, request distributions of cash or securities from the account, authorize third parties to perform these functions, and add a transfer on death, TOD, designation. Take note, transfer on death, TOD, sometimes called pay on death, POD, is a designation that may be added to an account by the account owner. A TOD identifies how the assets in the account are distributed upon the death of the account holder. A TOD account avoids probate, but is still considered part of the account owner's estate for estate tax purposes. Joint accounts. In a joint account, 2 or more adults are named on the account as co-owners, with each allowed control over the account. There are some restrictions with a tenants by the entirety account, which will be explained shortly. In addition to the appropriate new account form, a joint account agreement must be signed. The account forms for joint accounts require the signatures of all owners. Joint account agreements allow any of the tenants to transact business in the account. Checks must be made payable to the names in which the account is registered and must be endorsed for deposit by all tenants, although mail need only be sent to one address. To be in good delivery form, certificates, stocks, or bonds sold from a joint account must be signed by all tenants. Some types of joint accounts allow for a TOD designation. All tenants must agree to and sign the TOD. The TOD provision becomes effective after the last tenant dies. The suitability requirements for a joint account follow the same basic rules as all accounts. Put the interest of the client first. Because a joint account is really nothing other than a collection of individuals, suitability information must be obtained on all of the account owners, and any recommendations must be appropriate based upon that information. In other words, the suitability of recommendations must be based on the group, not any individual within the group. Owners in a joint account have an undivided interest in the account. This means that all parties own all of the account and any owner may place a trade, but all distributions will be in all owners' names. Joint tenants with rights of survivorship, J.T. Rose. Joint tenants with right of survivorship, J.T. Rose. Ownership stipulates that a deceased tenant's interest in the account passes to the surviving tenantess. A J.T. Rose account may include a TOD provision which becomes effective after the death of the last surviving tenant. All tenants have an equal share of the account. Tenants in common. Tenants in common, TIC. Ownership provides that a deceased tenant's fractional interest in the account be retained by that tenant's estate and not passed to the surviving tenantess. If one account owner dies or is declared incompetent, all pending transactions and outstanding orders must be canceled immediately. The account is treated as a decedent account until the decedent's portion of the account is removed or a representative takes control of that portion in place of the decedent, executor, administrator, etc. With a TIC account, the ownership may be unequal. If the ownership is unequal, the percentage of ownership should be documented. A TIC account may not have a TOD designation. Tenants by the entirety, TBE. Tenants by the entirety is used for legally married people only. It functions much like a JTWROS, except it requires all owners to sell or encumber, that is, take a loan against, any property registered this way. TBE is often used for real estate titles. A TBE account may have a TOD designation. Test topic alert. JTROS and TBE accounts allow for a TOD designation. TIC accounts do not. Take note, some states have community property laws for married couples. In these states, all assets in a marriage are assumed to be joint property until death, separation, or divorce. Any property owned by a married person must be specified as separate property to not be part of the community property. Any property that is acquired during the course of the marriage is likely community property, except for inheritance or gifts that are held separately or property that was owned before the marriage that was never titled in joint name. Business accounts. Businesses may want to open a brokerage account for any number of purposes. The types of accounts are normally referred to by the type of business opening the account. Sole proprietor. This is the simplest form of business organization and is treated like an individual account. In a sole proprietorship, all income or loss is that of the individual. In fact, one of the risks of operating in this fashion is that all of the owner's assets are liable for the debts of the business. This is one of the major considerations when opening an account for this form of business. The taxes flow through to the sole proprietor and are reported as part of that person's tax return. Partnership, unincorporated associations. A partnership is an unincorporated association of two or more individuals. Partnerships frequently open cash, margin, retirement, and other types of accounts necessary for business purposes. The partnership must complete a partnership agreement stating which of the partners can make transactions for the account. If the partnership opens a margin account, the partnership must disclose any investment limitations. A partnership is a tax reporting entity, but not a tax-paying entity. The business results of the partnership, income or losses, are passed through to the partners for tax purposes. The partnership reports each partner's share of any profits or losses to the partner and the government. An amended partnership agreement must be provided if changes have been made. In a general partnership, all the partners have a management role in the company and are liable for the partnership's debt. In a limited partnership, there are two types of partners, general and limited. General partners have management responsibilities and unlimited liability. Limited partners are investors only. They have no management role and are not liable for the partnership's debt. Their only risk is the loss of their investment. C corporations. C corporations are legal entities and tax-paying entities. All liability belongs to the corporation, and the investors are not held liable for the corporation's debt. C corporations also pay taxes. Some corporations may pay a portion of their profits to their owners, shareholders, in the form of a dividend. Limited Liability Company, LLC. An LLC is a legal entity that protects the investors from the company's liabilities but functions like a partnership for taxes. LLC report their profits or losses but do not pay taxes. All tax implications for the business pass through to the investors. S corporations. S corporations are legal entities that protect the investors from the company's liabilities but function like a partnership for taxes. S corporations report their profits or losses but do not pay taxes. All tax implications for the business pass through to the investors. Fiduciary accounts. A fiduciary is a person who manages assets for the account of another. A fiduciary has a duty to act in the best interest of the account's owner, often called the beneficiary. A failure to act in the beneficiary's interest may be a breach of fiduciary duty and have negative legal consequences. Trusts. There are a number of different types of trust accounts. Trusts are most often set up to hold an individual's or family's assets or for qualified retirement plans. Retirement trusts are covered later in this unit. A trust is created by a trustor or grantor. The truster places his assets into the trust. The trust is managed by a trustee, fiduciary, that is appointed within the trust document. The trust will also indicate the beneficiary of the trust. A trust may be revocable or irrevocable. A revocable trust may be modified or revoked by the truster. An irrevocable trust may not be modified after it is established and funded. A trust may be a living trust or a decedent trust. A living trust is formed and funded by the grantor during her lifetime. A decedent trust is formed and funded as part of the grantor's estate settlement after her death. Guardianship accounts. A guardian is a fiduciary appointed by a court to manage the affairs of a beneficiary. Typically, the beneficiary is an adult who is unable to manage her own affairs, but there are other reasons why a guardian may be appointed to manage a person's assets. Custodial accounts. Custodial accounts are established for a minor under one of two laws, either the Uniform Gift to Minors Act, UGMA, or the Uniform Transfer to Minors Act, UTMA. The account has one custodian, an adult, and one minor beneficiary. Which law applies depends on the state where the minor resides. Take note, almost every state has adopted the UTMA over the UGMA. You will not be expected to know which states have not adopted the UTMA, but UTMA is the default when discussing custodial accounts. Learning Objective 3B identify the requirements and approvals needed for opening different types of accounts. FINRA's suitability rule, FINRA Rule 2111, is based on a fundamental requirement to deal fairly with customers. Firms and their associated persons must have a reasonable basis to believe that a recommended transaction or investment strategy involving securities is suitable for the customer. The more information a representative has about a customer's income, current investment portfolio, retirement plans, and net worth, as well as other aspects of his current financial situation, the better a recommendation will be. The more a customer knows about the risks and rewards of each type of investment, the better the customer's investment decisions will be. Both financial and non-financial information must be gathered before making investment recommendations. Basic account information. Knowing your customer begins with the new account form. The SEC requires that brokerage firms create a record for each account with an individual customer that includes the following required information: customer name, tax identification number, e.g., Social Security number, address, date of birth, telephone number, driver's license, passport information, or information from other government-issued identification, employment status and occupation, whether the customer is employed by a brokerage firm, whether the customer owns more than 10% of a company, corporate insider, annual income, net worth, and account investment objectives. Brokers must make a good faith effort to obtain additional information. However, if the customer neglects or refuses to provide all the information or is unable to provide it, then the rule excuses the broker from obtaining it. If a customer only provides minimum information and refuses to provide all information requested, the account may still be opened if the firm believes the customer has the financial resources necessary to support the account. If sufficient information has not been received to determine suitability, recommendations cannot be made, and only unsolicited trades may occur. Test topic alert. The customer's signature is not required on the new account form. The only signature required to open an account is a partner, officer, or manager, i.e., a principal, of the broker-dealer, signifying that the account has been accepted in accordance with the member's policies and procedures for acceptance of accounts. Accounts may be opened by any legally competent person above the age of majority. Individuals who have been determined legally incompetent may not open accounts. Ideally, when opening an account, representatives should know all essential facts about a customer's current financial situation, present holdings, risk tolerance, needs, and objectives. Such information should be updated periodically as situations change. Take note. A firm must confirm this information with a customer within 30 days of the account opening. Also, this information should be reconfirmed with the customer at least every 36 months, 3 years. Opening an account for the employee of another member firm. Sound supervisory practices require that a member firm monitor personal accounts opened or established outside of the firm by its associated persons. FINRA Rule 3210 requires an associated person to obtain the written consent of her employer before opening an account at another member or other financial institution. Specifically, the rule provides that no person associated with a employer member firm will, without the prior written consent of the member, open any account in which securities transactions can be effected and in which the associated person has a beneficial interest at a member other than the employer member, executing member, or at any other financial institution. The rule specifies accounts in which an associated person is presumed to have a beneficial interest. As such, the rule's requirements would apply to these accounts. The associated person shall be presumed to have a beneficial interest in and to have established any account that is held by the spouse of the associated person, a child of the associated person or of the associated person's spouse, provided that the child resides in the same household as or is financially dependent upon the associated person, any other related individual over whose account the associated person has control, or any other individual over whose account the associated person has control and to whose financial support the associated person materially contributes. Any associated person, before opening or otherwise establishing an account subject to the rule, must notify in writing the member opening the account or other financial institution of his association with the employer member. Members opening an account have specified obligations under the rule. The member must, upon written request by the employer member, transmit duplicate copies of confirmations and statements. If the associated person is opening an account at a financial institution that is not a FINRA member, the employing member must consider the extent to which it will be able to obtain, upon written request, duplicate copies of confirmations and statements. If there is doubt, the employing member may decide not to give its written consent to open or maintain the account. Margin accounts. Trading on margin is a common practice in the securities industry. It allows customers to increase their trading capital by borrowing either cash or securities through their broker-dealers, BD. There are 2 types of margin accounts, long and short. In a long margin account, customers purchase securities and pay interest on the money borrowed until the loan is repaid. In a short margin account, stock is borrowed and then sold short, enabling the customer to profit if its value declines. All short sales must be executed through and accounted for in a margin account. Stock can be borrowed from several sources for short sales in a margin account. The member firm executing a short sale on behalf of the customer, margin customers of that member firm, other member firms, specialized companies known as stock lending firms, and institutional investors. The most common source is another customer's margin account, but permission must be given by signing a consent to loan agreement, which we'll discuss later in this unit. Margin accounts offer some advantages for customers. Consider that in a margin account, a customer can purchase more securities with a lower initial cash outlay and leverage the investment by borrowing a portion of the purchase price. Leveraging magnifies the customer's rate of return or rate of loss in adverse market conditions. The following table demonstrates this, but does not account for trading costs, commissions, or for interest costs applied for the funds borrowed. Cash purchase. Purchase of 1,000 shares of ABC for $20. Customer pays $20,000 for purchase. Margin purchase. Customer borrows 50%, $10,000 from BD, deposits equity of $10,000. Return after increase from $20 to $30 per share. Cash purchase. Customer experiences 50% return, gain/initial investment, $10,000 divided by $20,000 equals 50%, margin purchase. Customer experiences 100% return, gain/initial investment. $10,000 divided by $10,000 equals 100%. Return after decrease from $20 to $15 per share, cash purchase. Customer experiences 25% loss/initial investment. $5,000 divided by $20,000 equals 25%, margin purchase. Customer experiences 50% loss/initial investment. $5,000 divided by $10,000 equals 50%. The advantages of margin accounts for BD are margin account loans generate interest income for the firm, and margin customers typically trade larger positions because of increased trading capital, generating higher commissions for the firm. Hypothecation and rehypothecation. Hypothecation is the pledging of customer securities as collateral for margin loans. A hypothecation agreement must be signed by a customer who wants to open a margin account. This agreement is generally contained within the margin agreement, so customers are giving permission for this process to occur when they sign the margin agreement. Typically, a BD will not use its own cash to lend for margin purchases. Instead, the BD borrows the money from the bank. The loan from the bank to the broker for this purpose is also secured by a portion of the stocks purchased on margin. After a customer pledges her securities to the BD by signing the margin agreement, the BD rehypothecates, repledges them as collateral for a loan from a bank. Federal Reserve Regulation U oversees the process of a bank lending money to BD based on customer securities having been pledged as collateral for the loan. Firms cannot commingle customer securities with securities owned by the firm. However, firms can commingle one customer's securities with another customer's securities for hypothecation if customers have given specific permission by signing the hypothecation agreement. Accounts that may have a margin feature. Most individual and joint accounts may be margin accounts once all the required forms are submitted and a principal approves. This would also apply to sole proprietor business accounts. Corporate and partnership accounts may open margin accounts. However, before margin may be added to one of these account types, the corporate charter or bylaws, partnership agreement in the case of a partnership, must be checked to see if a prohibition against margin exists in the document. If the document is silent, then margin is allowed. Trust and other fiduciary accounts require that the trust or similar document be checked. For this type of account to trade on margin, the document must specifically allow it. If the trust is silent, then margin is not allowed. As written earlier, accounts that have contribution limits, IRA and other retirement plans, and custodial accounts under UTMA and UGMA may not be margin accounts. Like all accounts, margin accounts would need to be approved by a principal of the firm before the first trade. The approval would need to be in accordance with whether or not margin is permissible for the type of account being set up, as outlined in the previous section. Forms for a margin account. There are 3 forms associated with adding margin borrowing to an account. Credit agreement. The credit agreement discloses the terms of the credit extended by the BD, including the method of interest computation and situations under which interest rates may change. Hypothecation agreement. As noted earlier in this learning objective, the hypothecation agreement allows the securities to be pledged for the loan and gives permission to the BD to repledge customer margin securities as collateral. The firm rehypothecates customer securities to the bank, and the bank loans money to the BD on the basis of the loan value of these securities. All customer securities must be held in street name, registered in the name of the BD, to facilitate this process. When customer securities are held in street name, the BD is known as the nominal or named owner. The customer is the beneficial owner because he retains all rights of ownership. Consent to loan agreement. If signed, the loan consent form gives permission to the firm to loan the customer's margin securities to other customers or BD, usually to facilitate short sales where securities need to be borrowed. Take note: to open a margin account, it is mandatory that the customer signs the credit agreement and hypothecation agreement. The loan consent form is optional. A further note: a BD may make the consent to loan agreement mandatory for their margin customers, but this form is not a regulatory requirement. Additionally, before opening a margin account, the BD must provide customers with a risk disclosure document. This information must also be provided to margin customers on an annual basis. The document discusses the risks associated with margin trading, some of which are as follows. Customers are not entitled to choose which securities can be sold if a maintenance call is not met. Customers can lose more money than initially deposited. Customers are not entitled to an extension of time to meet a margin call. Firms can increase their in-house margin requirements without advance notice. Securities eligible for margin borrowing. Regulation T also identifies which securities are eligible for purchase on margin and which may be used as collateral for loans for other purchases. The following may be purchased on margin and used as collateral: exchange-listed stocks, bonds, NASDAQ stocks, OTC issues approved by the Federal Reserve Board, FRB, for margin, warrants. The following cannot be purchased on margin and cannot be used as collateral for a margin loan: options, both calls and puts; rights, non-national market securities, NMS, OTC issues not approved by the FRB; insurance contracts. The following cannot be bought on margin, but can be used as collateral after being held for 30 days. Mutual funds. New issues if they meet the requirements listed earlier. Lastly, certain securities are exempt from the FRB Regulation T margin requirements. Securities exempt from Regulation T include U.S. Treasury bills, notes and bonds, government agency issues, and municipal securities. If these exempt securities are bought or sold in a margin account, they are subject to the firm's determination of an initial deposit requirement. Firms may impose stricter requirements, but at a minimum must follow maintenance requirements established by FINRA. These requirements are covered later. Test topic alert: differentiate between the use of the terms margin and marginable. Margin is the amount of equity that must be deposited to buy securities in a margin account. Marginable refers to securities that can be used as collateral in a margin account. Take note: the FRB can change Regulation T at any time, but the current requirement, 50%, has been in place since 1974. Assume Regulation T equals 50% in test questions unless it is specified differently. Calculate initial deposit requirements. Customers are required to deposit a minimum amount of equity for their first purchase in a margin account. Regulation T states that a deposit of 50% of the market value of the purchase is required. FINRA also has an initial requirement of $2,000 or 100%, whichever is less. The customer is required to deposit the greater of the Regulation T requirement or the FINRA minimum. The following table depicts the required initial deposit. Customer purchase: buy 100 shares at $50/share. Regulation T requirement: $2,500. FINRA minimum rule: $2,000. Customer deposit required: $2,500. Customer purchase: buy 100 shares at $30/share. Regulation T requirement: $1,500. FINRA minimum rule: $2,000. Customer deposit required: $2,000. Customer purchase: buy 100 shares at $15/share. Regulation T requirement: $750. FINRA minimum rule: $1,500. Customer deposit required: $1,500. Here is another way to approach this. If the customer's first purchase in a margin account is greater than $4,000, deposit 50%. Regulation T requirement: if it is between $2,000 and $4,000, deposit $2,000. FINRA minimum: if it is less than $2,000, deposit 100% of the purchase price. FINRA minimum. Define maintenance call: just as margin trading can accelerate gains, it can also accelerate losses. If a stock's market value drops, the customer's equity in the account will also drop. If the customer's equity drops below 25% of the account's market value, the customer receives a maintenance call, also called a margin maintenance call. The customer is required to deposit additional assets to bring the equity in the account up to the 25% minimum. If a customer fails to make the required deposit, normally required by the end of the day, the BD may liquidate assets from the account to bring the account's equity up to 25%. The minimum maintenance requirement is a FINRA rule. A BD is allowed to have higher minimums, called a house call. The calculation of a maintenance call is not expected to be on the Series 6 exam, but the concept of a maintenance call is a possible test point. Knowledge Check 3.1. Question 1. Jim and Darlene, a married couple, have 3 nephews, Bryce, Ryan, and Kyle. They have assets in a brokerage account that they would like to pass to the nephews at their death, but they want to retain control until they both pass away. You would likely recommend they open which of the following accounts? A joint tenants with rights of survivorship, J.T. Rose, account with a transfer on death, Todd, designation. B, a tenants in common, Tick, account with a transfer on death, Todd, designation. C, a joint custodial account for the 3 boys. D, a joint tenants account with all 5 individuals listed as owners. The answer is A, J.T. Rose with a TOD is the best answer here. The assets would pass to the boys upon the second tenant's death. A TIC account would require the surviving spouse to probate the decedent spouse's estate, and TOD is not allowed on TIC accounts. There is no such thing as a joint custodial account, and no one said the nephews are minors. A joint account with all 5 people would give the nephews access to the account assets immediately and might constitute a gift. Question 2. All of the following information would normally be found on a new account application except A, employment status, B, address, C, education, D, investment objective. The answer is C, education is not required on a new account form. All of the other selections are normally required information when opening a brokerage account. Question 3. Which of the following government-issued documents would not be considered acceptable proof of identity? A current driver's license issued by the state of Ohio. B, a current birth certificate issued by Los Angeles County, California. C, a current U.S. passport. D, a current military identification issued by the U.S. Department of Defense. The answer is B, a birth certificate is not an acceptable ID. Also, in order for an ID to be current, it must have an expiration. Birth certificates do not come with expiration dates. Lesson 3.2. Retirement Accounts. Introduction. Helping clients with their retirement planning is one of the most important services we provide to our customers. Likewise, retirement help is the most requested service from customers. Knowledge of the different sorts of retirement savings vehicles is important for the representative and necessary for the Series 6 exam. Learning Objective 3C Group Qualified and Non-Qualified Retirement Plans. There are 2 basic types of retirement plans in the United States: qualified and non-qualified. Generally speaking, qualified plans allow pre-tax contributions to be made. However, there are exceptions to this rule. Non-qualified plans are always funded with after-tax money. Both plans can allow money to grow tax-deferred until needed. There are exceptions to these basic characteristics. Contribution limits for qualified retirement plans vary and are adjusted from time to time. Non-qualified plans may not have contribution limits. A taxable distribution from any retirement plan is normally taxed as ordinary income. There are exceptions. Distributions are not treated as a capital gain. Qualified vs. non-qualified retirement plans. Qualified plans. Contributions tax deductible. Plan approved by the IRS. Plan cannot discriminate. Tax on accumulation is deferred. All withdrawals taxed. Plan must be a trust. Non-qualified plans. Contributions not tax deductible. Plan does not need IRS approval. Plan can discriminate. Tax on accumulation is deferred. Excess over cost base taxed. Plan may be a trust, but that is not required. Retirement plans may also be qualified as self-sponsored or employer-sponsored. If a retirement account may be established by an individual without an employer's sponsorship, it is self-sponsored. If an employer must establish the plan, it is an employer-sponsored plan. Learning Objective 3D recall the characteristics of different retirement plans. Self-sponsored non-qualified plans. The primary self-sponsored non-qualified plan is an annuity. Contributions to an annuity are not deductible from income, grow tax-deferred, and gains are taxable upon withdrawal. Contributions to an annuity do not require earned income, and there is no regulatory limit to how much may be invested in an annuity. Self-sponsored qualified plans. Traditional individual retirement plans, ERA, IRA were created in 1974 as part of the Employee Retirement Income Security Act, ERISA, to encourage people to save for retirement in addition to other retirement plans in which they participate. IRA contributions. Anyone who has earned income is allowed to make an annual contribution of up to an indexed maximum, $6,000 through 2020, or 100% of earned income, whichever is less. Earned income is defined as income from work, e.g., wages, salaries, bonuses, commissions, tips, and other income generated from work. Income from investments is not considered earned income. If the account owner is age 50 or over, she may contribute up to an additional $1,000, called a catch-up provision. Take note, contributions to IRA must be from earned income, not investment or other ordinary income. Married couples may make IRA contributions for both spouses based on the family's earned income. Contributions may be made for a spouse that exceeds his earned income as long as the combined income is sufficient. If the contribution limit is exceeded, a 6% excess contribution penalty applies to the amount over the allowable portion, unless corrected shortly thereafter, as defined by IRS rules. Contributions may be made for a tax year during that year and as late as April 15 of the following year. Between January 1 and April 15, contributions may be made to an IRA for both the current year and the previous year. Contributions into a traditional IRA are either fully deductible, partially deductible, or not deductible, depending on access to corporate plans and income limits. Contributions are fully deductible, regardless of income, if the investor and spouse is not covered by a qualified employer plan. If covered or eligible for coverage, contributions are only deductible if the taxpayer's adjusted gross income falls within established income guidelines and those amounts are not tested. Basically, the more one makes, the less he can deduct. Once the AGI exceeds a certain amount, the contributions can still be made, but the contribution is not deductible. Distributions. Distributions from a traditional IRA are generally treated as taxable income. If a portion of the contributions are from after-tax income, then a portion of the distributions will be tax-free. Distributions made before age 59 are subject to income tax plus a 10% penalty. There are a number of exemptions to the penalty. There are exceptions to the penalty, but not the taxes, if the distribution is due to death of the owner, disability of the owner, first-time home buyer for purchase of a principal residence, up to $10,000. Education expenses for the taxpayer, spouse, child, or grandchild. Medical premiums for unemployed individuals, and medical expenses in excess of defined GI limits. Distributions made after age 59 are not subject to the 10% penalty. Required minimum distributions. The required minimum distributions, RMDs, must begin by April 1 of the year following the year in which the individual turns 72. The IRS requires distribution to begin in the year an individual turns 72, but does allow an individual to delay the year's distribution until April 1 of the following year. Note that all distributions after the first are due by December 31. If the IRA owner delays the first distribution into the following year, she will still be required to take another distribution by December 31 of that year. Test topic alert. An individual turns 72 in June of this year. The RMD should occur this year. However, the distribution for this year can be delayed until April 1 of next year. The catch is 2 distributions will be required next year, 1 distribution coming by April 1 and a second distribution taken out by December 31. If RMD do not begin by April 1 of the year after the individual turns 72, a 50% penalty on the insufficient distribution applies. The technical term for this is excess accumulation. It is applicable to the amount that should have been withdrawn based on IRS life expectancy tables. Ordinary income taxes also apply to the full amount. Take note, the first RMD may be delayed until April 1 of the year after turning 72. All subsequent annual RMDs must be taken by December 31. The penalty applies to any missed RMDs, not just the first one. Suitable and unsuitable investments. Certain investments are not permitted for funding IRA, including collectibles, e.g., antiques, gems, rare coins, works of art, stamps, life insurance contracts, and municipal bonds, which are considered inappropriate because the benefit of their tax-free interest is lost within a retirement plan. Take note, municipal bonds are technically permitted, but regulators strongly discourage the practice. As the recommendation for municipal securities in an IRA is very difficult to justify, the practice is effectively prohibited. Certain investment practices are prohibited in retirement accounts. Those that are not permitted within IRA or any other retirement plan include margin account trading, short sales of stock, and selling uncovered call options. Selling covered calls is permissible because it does not increase risk. A covered call occurs when an investor writes, sells, a call option against stock the investor already owns. The thought here is if the call is exercised, investors are obligated to deliver the stock. They simply sell the stock they already own, so the call is covered. Take note, although life insurance is not allowed within IRAs, annuities are allowed. Regulators have expressed concern about the suitability of funding a tax-advantaged account, like an IRA with a tax-advantaged product, like an annuity, but there is no prohibition against recommending annuities for IRA. Following is a partial list of which investments are appropriate for IRAs: stocks and bonds, mutual funds, other than municipal bond funds, UITS, government securities, U.S. government-issued gold and silver coins, Roth IRA. Roth IRA are a type of IRA, but with some important differences. Contributions. Contributions for a Roth IRA are combined with those for traditional IRA. An investor may contribute to both a traditional and a Roth IRA, but the total contributed to all IRA in a year may not exceed the annual maximum. Contributions to a Roth IRA are not tax-deductible. Taxpayers with incomes above a certain limit may not contribute to a Roth IRA. The income limit is not tested. Growth. Growth within the account is tax-deferred. Distributions. For Roth IRA that have been established for at least 5 years and the account holder is at least 59 years old, all distributions are tax-free. Distributions not meeting these requirements are generally subject to tax on the earnings and a 10% penalty. Note that contributions may be withdrawn at any time without tax. There are no RMD for Roth IRA. Rollovers vs. transfers. A rollover takes place when an investor withdraws funds from an IRA and returns the funds no more than 60 calendar days after the withdrawal. An investor is allowed to do this once per rolling year, 365 days in most years. Note this is one time per year per person, not per account and not per calendar year, but per 12 months. Transfers occur when assets are transferred from one qualified account to another qualified account. Unlike a rollover, the investor never takes possession of the funds. There is no regulatory limit on the number of transfers a customer may perform. Also, assets from a traditional IRA may be transferred to a Roth IRA with no penalty, though the amount transferred is taxable income. Take note, you may be familiar with the term rollover IRA. A rollover IRA is simply a traditional IRA that has received a transfer of assets from an employer-sponsored qualified plan. As the funds are from an existing qualified plan, these transfers are not subject to the annual contribution limits. Learning Objective 3E. Identify characteristics of employer-sponsored plans. Employer-sponsored retirement plans may be tax-qualified, like 401(k)s and pension plans, or non-qualified, like deferred compensation plans. The differences are discussed as follows. Employer-sponsored non-qualified plans. There are two types of employer-sponsored non-qualified plans: deferred compensation plans and Section 457 plans. Deferred compensation plans. A deferred compensation plan is an agreement between a company and an employee in which the employee agrees to defer receipt of current income in favor of payout at retirement. It is assumed that the employee will be in a lower tax bracket at retirement age. Deferred compensation plans may be somewhat risky because the employee covered by the plan has no right to plan benefits if the business fails. In this situation, the employee becomes a general creditor of the firm. Covered employees may also forfeit benefits if they leave the firm before retirement. When the employer makes the contribution, it is not considered an expense, as the employer retains control of the asset and is taxed accordingly. When the benefit is payable at the employee's retirement, it is taxable as ordinary income to the employee. The employer is entitled to the tax deduction at the time the benefit is paid out. The contributions are often held in a tax-deferred account, often an annuity. Take note, deferred compensation plans are non-qualified and employers are allowed to discriminate, allow some employees access to the plan, and provide different levels of benefit. They are normally used for key and slash or highly compensated employees who are approaching retirement. Section 457 plans. Section 457 plans are non-qualified retirement plans set up by state and local governments for their employees and contract employees. They function as deferred compensation plans in which earnings grow tax-deferred and all withdrawals are taxed at the time of distribution. Employees may defer up to 100% of their compensation, up to an indexed contribution limit. Employer-sponsored qualified plans. Though there are a number of employer-sponsored qualified retirement plans for businesses other than corporations, the Series 6 exam has focused on those qualified plans that are sponsored by corporations. Defined benefit plans. A defined benefit plan promises a specific benefit at retirement that is determined by a formula involving typical retirement age, years of service, and compensation level achieved. The amount of the contribution is determined by the plan's trust agreement and uses actuarial calculations involving investment returns, future interest rates, and other matters. This type of plan may be used by firms that wish to favor older employees. A much greater amount may be contributed for those with only a short time until retirement. Defined contribution plans. Defined contribution plans are easier to administer. The current contribution amount is specified by the plan's trust agreement, and funds are held in individual employee accounts. However, the benefit that will be paid at retirement is unknown. These plans favor younger employees, as they have more time for the money to grow. Following are several types of defined contribution plans. Money purchase plans are the simplest of the qualified defined contribution plans. Any employer that meets funding requirements may offer such a plan. The employer simply contributes a specified percentage of the employee's compensation up to an indexed maximum. Profit-sharing plans are a popular form of defined contribution plan. These plans do not require a fixed contribution formula and allow contributions to be reduced or skipped in years of low or no profits. 401k plans, the most popular form of defined contribution retirement plan, allow the employee to elect to contribute a specific percentage of salary to a retirement account. Contributions are excluded from the employee's gross income and accumulate tax-deferred. Employers may make matching contributions up to a specified percentage of the employee's contributions. Additionally, 401k plans permit certain hardship withdrawals. Roth 401k plans are a relatively new plan option. A Roth 401k, like a Roth IRA, requires after-tax contributions and allows tax-free withdrawals, provided the plan owner is at least 59. Unlike a Roth IRA, there are no income limitations on who may have such a plan. Like a 401k, it allows the employer to make matching contributions, but the employer's contributions must be made into a traditional 401k account. The employee, who would thus have two 401k accounts, may make contributions into either, but may not transfer money from one to the other once it has been deposited. In contrast to a Roth IRA, the account owner must begin withdrawals by the age of 72, unless still working. See required beginning date in the following topic. A Simplified Employee Pension Plan, SEP, is a qualified retirement plan designed for smaller employers. Contributions made to each employee's individual retirement arrangement account grow tax-deferred until retirement. An SEP is a qualified plan that offers ease of administration to small business owners. Employees open IRA and the employer makes contributions on their behalf. This is commonly known as a SEP-IR because the contributions are made to each employee's IRA employee, non-SEP. Contributions may be made into the same IRA accounts. Contributions to SEP exceed contribution levels of other types of IRA, as employers are allowed to contribute up to 25% of an employee's salary, up to an indexed maximum. Any employee who is at least 21 years old has worked for the employer for 3 of the past 5 years and has received a minimum level of compensation in the current year is eligible to participate. Corporate plans required beginning date. We have already covered the age at which minimum distributions must begin for IRA. What about in the case of qualified corporate plans? The term used here is required beginning date. A participant must begin to receive distributions from her qualified retirement plan by April 1 of the later of the following years. The first year after the calendar year in which she reaches age 72, the first year after the calendar year in which she retires from employment with the employer maintaining the plan. In other words, if you are still working for that employer and are over 72, contributions to the corporate plan can still be made and minimum distributions are not required until after you retire. Stock purchase plans and stock options. Some publicly traded companies offer their employees the ability to purchase company stock. There are several ways this can be done, but perhaps the most straightforward method of employee stock ownership can be found in an Employee Stock Purchase Program, ESP. These plans provide a convenient method for employees to purchase company shares. Employee stock purchase plans are essentially a type of payroll deduction plan that allows employees to buy company stock without having to affect the transactions themselves. Money is automatically taken out of a participant's paycheck on an after-tax basis every pay period and accrues in an escrow account until it is used to buy company shares on a periodic basis, such as every 6 months. These plans are similar to other types of stock option plans in that they promote employee ownership of the company, but do not have many of the restrictions that come with more formal stock option arrangements. Plus, they are designed to be somewhat more liquid in nature. Here are the basics. The employee contributes 1% 10% of her salary. The contribution is a payroll deduction. This is calculated on the pre-tax salary but taken after tax. Unlike 401ks, there is no tax deduction on S contributions. At the end of a purchase period, usually every 6 months, the employer will purchase company stock for participants using contributions made during the purchase period. There will be a discount on the purchase price. The employer takes the price of the company stock at the beginning of the purchase period and the price at the end of the purchase period, whichever is lower, and then gives a discount from that price. Participants can sell the purchased stock right away or hold on to it longer for preferential tax treatment. An employer may also offer stock options that give an employee the right to purchase a specified number of shares of the employer's common stock at a stated price over a stated time period. Unlike qualified retirement plans, there are no non-discrimination requirements for these plans. For publicly traded stock, the strike price, also called the grant or exercise price, is usually the market price of the stock at the time the option is granted. In most cases, there is a minimum time the employee must remain with the company to be able to use the option, the vesting period. The hope of the employee is that the market price of the employer's stock will increase in value. Then, the employee will be able to purchase the stock by exercising the option, purchasing the stock at the lower strike price, and then selling the stock at the current market price. Stock options are available only to employees of the issuing company. Most states require that the stock option plan be approved by the board of directors. Learning Objective 3F define ERISA and its application to private sector retirement plans. Employee Retirement Income Security Act of 1974, ERISA. The Employee Retirement Income Security Act, ERISA, was established to prevent abuse and misuse of pension funds. ERISA guidelines apply to private sector, corporate, retirement plans, and certain union plans, not public plans like those for government workers. Significant ERISA provisions include the following. Participation. ERISA sets eligibility rules for employees. All employees must be covered if they are 21 years old or older and have performed 1 year of full-time service, which ERISA defines as working 1,000 hours or more. Funding. Funds contributed to the plan must be segregated from other corporate assets. Plan trustees must administer and invest the assets prudently and in the best interest of all participants. IRS contribution limits must be observed. Vesting. Vesting rules define when an employer contribution to a plan becomes the employee's money, such as an employer matching contribution to a 401k plan. ERISA limits how long the vesting schedule can last before the employee is fully vested. Note that an employee is always fully vested in his own contributions to a plan. Communication. The plan document must be in writing, and employees must be given annual statements of account and updates of plan benefits. Non-discrimination. All eligible employees must be treated impartially through a uniformly applied formula. Beneficiaries. Employees may choose the beneficiaries of the plan should they die before retirement. Take note, you may see a question that asks for the type of plans that ERISA regulates. ERISA applies to private sector plans, corporate, only. It does not apply to plans for federal or state government workers, public sector plans. Knowledge Check 3.2. Question 1. Allowable investments within an IRA include all of the following except A. Investment company securities, B. Corporate stocks and bonds, C. Certain U.S. government-minted gold and silver coins, D. Collectibles such as postage stamps. The answer is D. Collectibles are not allowed investments in an IRA. All of the others listed are allowed. Question 2. Generally speaking, non-qualified retirement plans are funded with after-tax dollars. B. Must have a trust agreement. C. May not discriminate with regard to who can participate. D. Must have IRS approval. The answer is A. Non-qualified plans are funded with after-tax dollars. Discrimination is allowed, but neither IRS approval nor a trust is required. Question 3. ERISA rules and regulations include all of the following except A. ERISA protects participants in private sector retirement plans, such as a pension, from the creditors of the corporation. B. A retirement plan covered by ERISA may not discriminate against who is eligible to participate in the plan. C. They define when employer contributions become the employee's money. D. ERISA allows the corporation to choose the beneficiary of plan benefits for employees before their retirement. The answer is D. ERISA requires that employees be allowed to choose the beneficiary of their plan, not the employer. Lesson 3.3 Customer Identification and Information Security. Introduction. Our customers rely on us to provide them with sound financial advice. To provide sound advice, we need to understand our customers' circumstances and needs. To understand customer needs, we need to collect information from our customers. This information is both private and sensitive. If we do not apply the utmost care in handling and protecting that information, we reduce the trust that customers have in us to take care of them. This hurts all parties, so we need to keep our customers' information safe. In addition, financial services firms are in a unique position to notice illegal activity. We have a part to play in protecting the nation from criminals and terrorists. This lesson covers the rules around collecting and storing customer information and processes for ensuring that our customers are who they say they are. Learning Objective 3G recall the components of a Customer Identification Program, CIP, and the Know Your Customer, KIC, rule. Customer Identification Program, CIP. Under provisions of the USA Patriot Act, BD are required to institute a Customer Identification Program, CIP, designed to verify the identity of any new customer. For an individual, an unexpired government-issued identification, such as a driver's license, passport, military ID, or state ID, will meet the requirements. For a customer other than an individual, documents showing the existence of the entity, such as certified articles of incorporation, a government-issued business license, a partnership agreement, or a trust instrument, will work. The firm must maintain records of the information used to verify identity and determine whether the person appears on any list of known or suspected terrorists or terrorist organizations. These rules are designed to prevent, detect, and prosecute money laundering and the financing of terrorism. The Patriot Act requirements exceed those of the SEC and FINRA. As part of its CIP, before opening an account, a BD must obtain the following information at a minimum: customer name, date of birth for an individual, address for an individual, a residential or business street address. For an individual who does not have a residential or business street address, an Army post office or fleet post office box number, or the residential or business street address of a next of kin or another contact individual. For a person other than an individual, such as a corporation, partnership, or trust, a principal place of business, local office, or other physical location. Social Security number for an individual or tax ID number for a business entity. An exception is granted to U.S. persons who do not currently have, but who have applied for, a Social Security number. In this instance, The firm must obtain the Social Security number within a reasonable period, and the Social Security number record must be marked applied for. For a non-U.S. person, one or more of the following: a taxpayer identification number, a passport number and country of issuance, an alien identification card number, or the number and country of issuance of any other government-issued document evidencing nationality or residence and bearing a photograph or similar safeguard. The CIP must include procedures for responding to circumstances in which the BD cannot form a reasonable belief that it knows the true identity of a customer. These procedures should describe when the BD should not open an account, the terms under which a customer may conduct transactions while the BD attempts to verify the customer's identity, when the BD should close an account after attempts to verify a customer's identity fail, and when the BD should file a suspicious activity report in accordance with applicable laws and regulations. Know Your Customer. The Know Your Customer (KYC) Rule 2090 places an obligation on the firm and associated person to seek information from customers. Customers are not required to provide all information asked. Therefore, the KYC rule provides some flexibility when information is unavailable, despite the fact that the firm or associated person asked for it. When some customer information is unavailable, despite a firm's request for it, the firm may narrow the range of recommendations it makes. The rule does not prohibit a firm from making a recommendation in the absence of certain customer-specific information if the firm has enough information about the customer to have a reasonable basis to believe the recommendation is suitable based on what the firm knows. The significance of specific types of customer information will depend on the facts and circumstances of the particular case. Of course, in order for customers to receive recommendations, the firm itself may require that customers provide certain types of information. Knowing your customers means more than just knowing their financial information. It includes an understanding of their circumstances and needs, both financial and non-financial. More on the differences between these is in Unit 4. When you have a clear understanding of your customer's circumstances, needs, and objectives, you are better able to make suitable recommendations to them. When customers are confident that you understand their circumstances, needs, and objectives, they will be more confident in the recommendations you provide. Learning Objective 3H Identify customer protection and information security rules. Regulation SP. It is important to understand SEC Regulation SP, which stands for Security and Privacy. Regulation SP derives from the privacy rules under the Gramm-Leach-Bliley Act. The Act states that each financial institution has a responsibility to protect the privacy of its customers' non-public personal information, NPI. NPI is personally identifiable financial information, such as information obtained on an application for a product or service that is not publicly available, e.g., Social Security number, driver's license number, account number, and security codes. Regulation SP requires firms to maintain adequate safeguards to protect customer information from unauthorized access or use. In addition, a financial institution may not disclose NPI to a non-affiliated third party unless proper disclosures are made. Disclosures. Disclosure of a firm's policies and procedures regarding customer privacy must be made no later than when the customer relationship is established, generally at the time a new customer opens an account. The customer must receive an updated notice containing the same information at least annually. Guidelines include the following. Financial institutions must clearly and conspicuously disclose to the customer, in writing or in electronic form or other form permitted, that such information may be disclosed to a third party. The customer must be given the opportunity, before any information is initially disclosed, to direct that information not be disclosed to a third party. The customer is given an explanation of how to opt out of the sharing of information. Right to opt out. Federal law requires that each customer be given the opportunity to opt out of the sharing of NPI. The opt-out notice must identify the products or services to which it is applicable. In addition, the notice must clearly explain how to exercise one's right to opt out. Take note, methods to opt out must be simple. Having a customer return a postage-paid reply card would be compliant with this regulation, but requiring a customer to write a letter and send it in would not. Customer communications. Once the account is opened, the customer may place trades in the account. He will want to see a receipt of those transactions, and rightly so. The SEC mandates the customer receive confirmations of all trades in the account. Payment and delivery instructions. After opening an account, the customer and the registered representative establish payment and delivery instructions. Although these instructions may be changed for individual transactions or at any time to be applied going forward, the customer selects any of the following when initially opening the account. Transfer and ship. Securities are registered in the customer's name and shipped to them. Transfer and hold in safekeeping. Securities are registered in the customer's name, and the BD holds them in safekeeping. Hold in street name. Securities are registered in the BD name and held by the BD. Although the BD is the security's nominal owner, the customer is the beneficial owner. Delivery versus payment, DVP. DVP securities are delivered to a bank or depository against payment. Normally used for institutional accounts, this is a cash-on-delivery settlement. The BD must verify the arrangement between the customer and the bank or depository, and the customer must notify the bank or depository of each purchase or sale. In addition, the customer designates whether the BD should hold or forward any cash balance. Mailing instructions. A customer gives specific mailing instructions when opening a new account. Statements and confirmations may be sent to someone who holds power of attorney for the customer if the customer requests it in writing, and if duplicate confirmations are also sent to the customer. Knowledge Check 3.3. Question 1. A retail investor opens an account at your firm but only provides the minimum information and states she does not want to provide financial information or objectives. Which of the following statements best describes the responsibilities of the registered representative handling the account? A. Recommendations can be made because the customer decides whether or not to accept them. B. The account cannot be opened without financial and non-financial information. C. Only unsolicited trades can be made in this account. D. The representative is limited to investment company recommendations only. The answer is C. The customer's refusal to answer suitability questions means you may be restricted when making recommendations on investments for this account. The account may still be opened and unsolicited trades accepted. Question 2. Which of the following is not required information for a customer identification program? A. Address. B. Place of birth. C. Social Security number or tax ID. D. A valid, government-issued photo ID. The answer is B. Though citizenship and residency are needed, the customer's place of birth is not. Speaking of place of birth, one of the choices in a question like this might be an official birth certificate. That would not be an acceptable form of identification. Question 3. Disclosure of a firm's policies and procedures regarding customer privacy must be made no later than when the customer relationship is established. B. Annually on the account anniversary. C. Annually within 30 days of the beginning of the calendar year. D. Annually within 30 days of the firm's fiscal year. The answer is A. This disclosure is made at the beginning of the relationship. If the relationship is ongoing, like an active account, this disclosure is made annually as well. However, there is no specific time frame beyond annually. Lesson 3.4. Third-party authorizations, transfers, and registration changes. Learning Objective 3, I classified the types of third-party account authorizations. Normally, the only persons allowed to direct trading in an account are the owners of the account, or in the case of a business or other legal entity, those authorized by the business. However, owners of an account may authorize others, third parties, to act on their, the owner's, behalf in managing a brokerage account. The most common types of third-party authorization are discussed here. Discretion, discretionary trading authority. A customer can give discretionary power over her account S to a registered representative by signing a discretionary trading authorization with the BD. The authorization must also be signed by a principal of the BD. No discretionary transactions may take place without this document on file. Entering a discretionary trade without having written discretionary authority is a serious violation of securities regulations. Once authorization has been given, the customer must accept the trade entered by the person holding discretionary authority, although the customer may continue to enter orders on her own. A customer may revoke the discretionary power at any time, but the revocation must be in writing. In addition to requiring the proper documentation, discretionary accounts are subject to the following rules. Each discretionary order must be identified as such at the time it is entered for execution. A principal of the brokerage house must approve each order promptly and in writing, but not necessarily before order entry. A record must be kept of all transactions. No excessive trading or churning may occur in the account relative to the size of the account and the customer's investment objectives. To safeguard against the possibility of churning, a designated supervisor or manager must review all trading activity frequently and systematically. Take note, the discretionary power is granted to a registered representative of a BD over a specific account, not to the firm. If the customer passes away or the representative dies or otherwise leaves the firm, the discretionary power ends. What is a discretionary trade? A customer may grant trading authority to a registered representative to place trade in his account without pre-authorization from the customer. This is a discretionary trade. Exercising discretion requires specific authorization to place such trades. This is a type of power of attorney granted by the customer to the registered representative. These trades must be marked as discretionary. Failure to do so is a serious violation. What constitutes a discretionary trade? There are three key elements of discretion in a trade: an action, buy or sell, the amount of the trade, shares or dollars, the specific asset to be traded. What are you buying or selling? These three elements are called the 3 A's of discretion. In addition to these three, there is also an element of time and price. However, time and price are not considered elements of discretion, and time and price authority do not require discretionary power. If a representative chooses on his own discretion one or more of the 3 A's, the trade is a discretionary trade. In order for a trade to not be considered a discretionary trade, the customer must provide or agree to all three of the A elements in a way that it may be objectively identified. Practice question: which of the following orders taken from a customer would not require the representative to use discretionary powers to enter? A. Buy 100 shares of a great retail company. B. Sell a security because I need to raise $10,000 in cash. C. Sell all the California municipal bonds in the account. D. Sell as many shares as you think prudent of XYZ stock and reinvest the money in the Windmill Growth Fund. The answer is C. The customer identified the activity, sell, the amount, all, and the asset, California municipal bonds. Options A and B do not identify the asset, and D does not specify the amount. Power of attorney, POA. A power of attorney, POA, is given by a customer to a third party, granting authority to that party to operate the account. The POA is different than discretion in that the third party is not, normally, a registered representative, and the powers granted may be broader than trading. The POA is either limited, LPOA, or full, FPOA. All POA must be in writing. Full power of attorney. A full power of attorney allows someone who is not the owner of an account to deposit or withdraw cash or securities, make investment decisions for the account owner, and possibly have even broader powers, like changing the address of record. Limited power of attorney, LPOA. An LPOA allows an individual to have some, but not total, control over an account. The document specifies the level of access the person may exercise. LPOA, also called Limited Trading Authorization, allows the entering of buy and sell orders, but not the withdrawal of assets. Removal of a POA. POA authorizations may be revoked by the grantor of the power, the customer, at any time, but the revocation must be in writing. All POA end with the death of the grantor or the appointed person. Generally, POA will also end if the grantor becomes incapacitated. However, if the POA is designated a durable power of attorney, the authority continues during incapacity. Investment advisors. When a customer engages an investment advisor firm to manage her account, she normally grants the investment advisor an LPOA to place trades. Note that the authority is granted to the investment advisor, a firm, not an individual. This is different from discretion, where the authority is granted to a specific individual. Other third-party authorizations. There are other types of third-party authorizations, also known as fiduciaries. On the exam, there are fiduciary accounts, as covered earlier. Anyone who is trading authority in a brokerage account has a fiduciary duty to the beneficiaries of the account, meaning they are expected to act in the best interest of the beneficiaries and put the beneficiaries' interest before their own. Take note, discretion and POA are added to an account when it is opened or any time after that. They are an add-on to the account. Trusts and trustees exist before an account is opened. Trustees may be added or changed, but there was a trustee in place for the trust when it was created and before the account was opened. Guardians are appointed before an account is opened. The guardian may be changed, but a guardianship is in place before an account is opened. Custodial accounts require the appointment of a custodian. The custodian may be changed, but there is always a custodian on a custodial account. Learning Objective 3J identify the procedure for account registration changes and transfers. An account's registration shows who owns an account. Most accounts are not designed to change ownership, and such a change often requires closing one account and opening another. Also, account owners may want to move the assets to a different firm altogether. This section goes into the process of changing registrations and transferring accounts. Changing registration. Various types of accounts, individual, joint, business, and so on, handle registration changes in different ways. Individual accounts. If the owner of an individual account undergoes a name change, most firms will make that change to the account with a letter of authorization, LOA, from the account holder and evidence of the legal name change. Also, firms may allow an individual account to convert to a joint account as long as the tax ID remains the same. The new tenant must sign new account forms. If the tax ID number needs to change, indicating a new owner, this can be done by opening a new account for the new owner and getting an LOA from the current account holder or his representative to journal the assets to the new account. Take note, to move assets by a journal entry means to move them from one account to another within a firm or financial institution. Joint accounts. Similar to an individual account, a new tenant may be added to a joint account with the authorization of all account holders and the new tenant signing a new account form. Removal of a tenant is generally not allowed and will require opening a new account and a journal transfer. Business accounts. Partnerships and corporations may change authorized persons. The company will need to authorize the new persons with a new resolution of the board for a corporation or the partners if a partnership. As the owner of the account remains the same, the business entity, there is no requirement to open a new account. Trust, guardianships, and custodial accounts. As with a business account, the ownership of these accounts does not change if the trustee, guardian, or custodian changes. Proper LOA are needed but not a new account. Transferring an account to a new firm. Transferring an account transfer, or TOA, is generally done through the Automated Customer Account Transfer Service, ACATS, which automates and standardizes the procedure for the transfer. The customer signs a Transfer Initiation Form, TIF, which is sent to ACATS by the receiving new firm. Once forwarded and received by the carrying old firm, the carrying firm has 1 business day to validate the securities listed on the TIF or take exception to the transfer instructions. If there are no exceptions, the carrying firm validates the transfer. This should happen in 1 business day. Within 3 business days following validation, the carrying firm must complete the transfer of the account. A BD may not interfere or obstruct a transfer unless there is a legitimate claim or lien against the account. Take note. Remember the information from Learning Objective 1G on account transfers when a registered representative changed firms. Knowledge Check 3.4. Question 1. Henry, a customer of Seacoast Securities, granted his representative, Nancy, discretionary trading authority. Sometime later, Nancy retires from Seacoast Securities. What happens to the discretionary power? A. Seacoast may reassign the power to Henry's new representative. B. The power continues as it authorizes Seacoast Securities to trade. C. The power ends. D. Nancy may continue to place trades in the account. The answer is C. The power ends, as discretion was granted to Nancy in her role as a registered representative, not to the firm. Henry would have to authorize a different representative, and a principal of Seacoast would need to approve discretion for the new representative. Question 2. A durable LPOA ends when the customer A. is incapacitated. B. passes away. C. issues verbal instructions revoking the POA. D. is out of the country for more than 6 months. The answer is B. POA ends with death or incapacity, but a durable POA survives incapacity. No POA continues after the grantor has died. POA must be revoked in writing. An extended absence is one of the reasons someone might grant a POA to another person. Question 3. After a carrying firm receives and validates a transfer initiation form, the transfer must be completed in how many days? A. 3 business days. B. 1 business day. C. 3 calendar days. D. 5 business days. The answer is A. A transfer must be completed within 3 business days of validation. Unit 4. Investment Recommendations. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 4A. Identify the components of customer account analysis. Learning Objective 4B. Apply portfolio analysis theories. Learning Objective 4C. Employ fundamental analysis in recommendations. Learning Objective 4D. Classify investment risks. Learning Objective 4E. Recall specific disclosure requirements for certain transactions. Learning Objective 4F. Differentiate financial and non-financial considerations in customer circumstances. Learning Objective 4G. Apply suitability standards in customer recommendations. Introduction. The ability to make a suitable recommendation is likely the most important skill a registered representative possesses. A Series 6 licensed representative will be working with clients, making investment recommendations as a regular part of the position. Many of the questions on the exam will be aimed at testing your ability to analyze a customer's situation, make a suitable recommendation, and explain the risks of the investment to a client. Because all investments involve trade-offs, the representative's task is to select securities that will provide the right balance between investor objectives and investment characteristics. New financial instruments, new classes of mutual funds, and new forms of variable contracts are also constantly being developed. The fact that something is the newest does not make it a good investment for a customer. Risk factors and suitability requirements apply to new investment instruments just as much as to those that have been around for centuries. Your exam will include approximately 8 questions from the topics covered in Unit 4. Lesson 4.1. Customer Account Analysis and Risk. Learning Objective 4A identified the components of customer account analysis. By analyzing an investment portfolio and an account, a registered representative may select products to fit the needs of the customer. One of the important items to consider is the performance of various securities that are recommended. The securities and performance measures will depend on the information gathered and the customer's investment experience. Aggressive investors may try timing the market and may seek capital appreciation. For example, a customer may like moving in and out of the market. If a customer is trading a lot, it would be important to know whether market prices are going up, have started to slide, or seem to have reached a plateau. On the other hand, a buy and hold investor may be more concerned about the stock's value 15 or 20 years in the future and is likely to be more interested in whether it has a pattern of earnings growth and seems to be well positioned for future expansion. A buy and hold investor is still considered aggressive. After all, they hold stocks, but just less aggressive than a market timer. With a conservative investor or one that is approaching retirement, the primary concern may be the income your recommendations provide. An examination of the interest rate that bonds and certificates of deposit, CDs, are paying in relation to current market rates would be important. Also, an evaluation of the yield from stock and mutual funds bought for the income they provide is important. Of course, if market interest rates are down, reinvestment opportunities may disappoint as existing bonds mature. There may be a temptation to buy investments with a lower rating in expectation of getting a potentially higher return. In either event, a performance measure that assesses the risk to the results would be helpful when making investment decisions. In measuring investment performance, be sure to avoid comparing apples to oranges. Finding and applying the right evaluation standards for investments is important. Otherwise, the wrong conclusions may result. For example, there's little reason to compare yield from a growth mutual fund with yield from a treasury bond because they don't fulfill the same role in a portfolio. Instead, measure performance for a growth fund by the standards of other growth investments, such as a growth mutual fund index or an appropriate market index. Test topic alert. Diversification, with its emphasis on variety, allows the spreading of assets around. In short, don't put all your investment eggs in one basket. As such, diversification works very nicely to offset unsystematic risks. When analyzing a customer's portfolio, always think about diversification. Learning Objective 4B. Apply portfolio analysis theories. Asset allocation. Asset allocation, as previously stated, refers to the spreading of portfolio funds among different asset classes. Proponents of asset allocation feel that the mix of assets within a portfolio, rather than individual stock selection or marketing timing, is the primary factor underlying the variability of returns in portfolio performance. There are three major types, each with subclasses, of asset classes. Stock, with subclasses based on market capitalization, value versus growth, and foreign equity. Bonds, with subclasses based on maturity, intermediate vs long-term, and issuer, Treasury vs corporate vs non-U.S. issuers. Cash, focusing mainly on the standard risk-free investment used commonly in the financial industry, the 13-week Treasury bill, but also including other short-term money market instruments. In some instances, tangible assets, real estate, usually in the form of rates, precious metals and other commodities, and certain collectibles, think fine art, are part of the asset allocation because these types of assets tend to reduce inflation risk. Increasingly, institutional investors and some very high net worth individuals, due to the high cost of entry, are using such alternative investment asset classes as hedge funds, private equity, and venture capital. Strategic asset allocation. Strategic asset allocation refers to the proportion of various types of investments composing a long-term investment portfolio. This is often considered a passive management style, as conditions for rebalancing tend to be slow-moving and a bit more predictable. Think strategy. Example: a standard asset allocation model suggests subtracting a person's age from 100 to determine the percentage of the portfolio to be invested in stocks. According to this method, a 30-year-old would be 70% invested in stocks and 30% in bonds and cash. A 70-year-old would be 30% invested in stocks with the remainder in bonds and cash. Tactical asset allocation. Tactical asset allocation refers to short-term portfolio adjustments that adjust the portfolio mix between asset classes in consideration of current market conditions. For our purposes, this typically requires an active management of the portfolio. Active management relies on the manager's stock picking and market timing ability to outperform market indexes. Example: if the stock market is expected to do well over the near term, think weeks to a couple of months, a portfolio manager may allocate greater portions of a portfolio to stocks. If the market is expected to decline, the portfolio manager may allocate greater portions of the portfolio entirely to bonds and cash. Modern portfolio theory, MPT, portfolio theory. Modern portfolio theory, MPT, which is sometimes called just portfolio theory, employs a scientific approach to measuring risk and, by extension, to choosing investments. It involves calculating projected returns of various portfolio combinations to identify those that are likely to provide the best returns at different levels of risk. It is the concept of minimizing risk by combining volatile and price-stable investments in a single portfolio. Harry Markowitz, the founder of MPT, explained how to best assemble a diversified portfolio and proved that the portfolio with a lower amount of volatility would do better than a portfolio with a greater amount of volatility. MPT focuses on the relationships among all the investments in a portfolio. This theory holds that specific risks can be diversified away by building portfolios of securities whose returns are not correlated. MPT seeks to reduce the risk in a portfolio while simultaneously increasing expected returns. Holding securities that tend to move in the same direction as one another does not lower an investor's risk. Diversification reduces risk only when assets whose prices move inversely or at different times in relation to one another are combined. Let's dig a little deeper into MPT, as some of the analysis tools that are utilized in MPT follow. Capital Asset Pricing Model, CAPM. The CAPM is a securities market investment theory that attempts to derive the expected return on an asset on the basis of the asset's systematic risk. William Sharpe first formulated the CAPM in the 1960s. The basic premise is that every investment carries two distinct risks: systematic, think market, which cannot be diversified away, and unsystematic, think business, risk, which can be mitigated through appropriate diversification. As a result of this work and its further refinements, Sharpe was awarded the Nobel Prize in Economics in 1990. That isn't tested. The CAPM is used to calculate the return that an investment should achieve based on the risk that is taken. The more risk taken, the higher the potential returns. Investors should be rewarded for the risks they take. The CAPM calculates a required return based on a risk multiplier called the beta coefficient. A portfolio's total risk is made up of unsystematic risk and systematic risk. If an investor has a diversified portfolio, unsystematic risk is reduced to almost zero. Therefore, the only real risk is systematic risk, and this is the risk that needs a required return to offset. Investors with a well-diversified portfolio will find that the risk affecting the portfolio is wholly systematic. Individual investments have both systematic and unsystematic risk. However, when a portfolio is diversified, unsystematic, or business, risk is all but eliminated and only systematic or market risk would be relevant. In other words, if an individual investment becomes part of a well-diversified portfolio, The unsystematic risk can be ignored. Beta coefficient. Beta and beta coefficient mean the same thing. In the securities industry, coefficient is ordinarily dropped for purposes of convenience. A stock or portfolio's beta is a measure of its volatility in relation to the overall market, systematic risk. The overall market is typically based on the S&P 500 and is given a beta coefficient of 1.0. A security that has a beta of 1.0 moves in line with the market. A security or portfolio with a beta greater than 1.0 is generally going to be more volatile than the overall market. The reverse is true when the beta is less than 1.0. Take note, if the S&P 500 rises or falls by 10%, a stock with a beta of 1.0 should rise or fall by about 10%. A stock with a beta of 1.5 is expected to rise or fall by about 15%, and a stock with a beta of 0.75 is expected to rise or fall by about 7.5%. Alpha. The alpha is the extent to which an asset's or portfolio's actual return exceeds or falls short of its expected returns. A positive alpha rather than a negative one is desirable. Example: if an investment has a beta of 1.5, it is 50% more volatile than the market. Therefore, if the market goes up 10%, it is expected that the investment with a beta of 1.5 will go up 15%, 2 times the market. However, if the investment only goes up 11%, the investor took a greater risk for less return on her money. Therefore, the actual return of 11% is less than the 15% expected return, negative alpha. If the investment increased by 17%, the investor received a greater return than the risk she took. Therefore, the actual return of 17% is greater than the expected return of 15%, positive alpha. The CAPM calculation of alpha would replace the expected return with the required return. In other words, if you as an investor required a more dynamic way of looking at risk and reward, and you required a return better than a certain index, e.g. S&P 500, the beta of a security would show its volatility, but alpha gives you a benchmark to know whether or not the returns of that security are doing better than the risks taken. Analysts advise when to buy, sell, or hold securities. The CAPM is a method that analysts may use to make these decisions. An analyst would calculate the expected return and required return for the security. By subtracting the required return from the expected return for each share, they calculate the alpha for the security. A positive alpha would indicate a buy recommendation. Learning Objective 4C. Employ fundamental analysis and recommendations. Fundamental analysis is the study of the business prospects of an individual company within the context of its industry and the overall economy. Analysts do this by examining the company in detail, including the financial statements and company management. We could compare this to an individual receiving a full physical examination, which, in addition to all kinds of tests, would include a detailed family medical history. With a company, the financial statement analysis is like the blood tests, X-rays, stress test, and so on, and the evaluation of the company's management is like the medical history. Business cycle. Because business cycle phases have different effects on different industries, fundamental analysts look for companies in industries that offer better than average opportunities within the current business cycle. Practice question. Which of the following places the phases of the business cycle in correct order? A. Expansion, contraction, trough, growth. B. Contraction, trough, prosperity, expansion. C. Peak, expansion, contraction, trough. D. Trough, expansion, peak, contraction. The answer is D. Check the chart. D is the only one that puts them in order. Types of industries and the business cycle. Industries can be categorized based on how they are affected by the normal business cycle. Industries can be defensive, cyclical, countercyclical, or special. Defensive industries. Defensive industries are least affected by normal business cycles. Companies in defensive industries generally produce non-durable consumer goods such as food, pharmaceuticals, tobacco, and utilities. Public consumption of such goods remains fairly steady throughout the business cycle. During economic contraction, including recessions and bear markets, stocks in defensive industries generally decline less than stocks in other industries. During expansions and bull markets, defensive stocks may advance less. Investments in defensive industries tend to involve less risk and, consequently, lower investment returns. Take note, those using sector rotations will rotate into defensive issues when it appears the business cycle is headed into the contraction phase, and then rotate into cyclical issues when the economy is in the expansion phase. Cyclical industries. Cyclical industries are highly sensitive to business cycles and inflation trends. Most cyclical industries produce steel, heavy equipment such as tractors, airplanes, and cranes, light trucks and automobiles, or durable goods, also called capital good, things like washers and dryers. During recessions, the demand for durable goods declines as manufacturers postpone investments in new capital goods and consumers postpone purchases of automobiles. Cyclical industries perform better in expanding economies. Take note, if the industry produces or makes products from steel or aluminum, it is a cyclical industry. Counter-cyclical industries. Counter-cyclical industries, on the other hand, tend to turn down as the economy heats up and rise when the economy turns down. Gold and gold mining stocks have historically been a counter-cyclical industry. Test topic alert. On the exam, you are likely to see the term precious metals rather than gold. Precious metals is just a broader term than gold and includes items such as silver and platinum. When you see precious metals, remember that is a counter-cyclical industry. Growth industries. Every industry passes through 4 phases during its existence: introduction, growth, maturity, and decline. An industry is considered in its growth phase if the industry is growing faster than the economy as a whole because of technological changes, new products, or changing consumer tastes. Technology associated with computers and bioengineering are considered growth industries. Because many growth companies retain nearly all of their earnings to finance their business expansion, growth stocks usually pay little or no dividends. Special situation stocks. As previously covered, special situation stocks are stocks of a company with unusual profit potential resulting from non-recurring circumstances, such as new management, the discovery of a valuable natural resource on corporate property, or the introduction of a new product. Tools of fundamental analysis. A fundamental analyst who takes a top-down approach to investing will look first at the overall economy, then look at industries that perform well within the current economy, and then zero in on individual companies within that industry to consider as an investment. A fundamental analyst or fundamentalist looks at fundamentals of a specific company, like the management quality, market share, new products and financial statement, and balance sheet health. A fundamentalist looks at what to buy, company A or company B. A corporation's financial statements provide a fundamental analyst with the information needed to assess that corporation's profitability, financial strength, and operating efficiency. Companies issue quarterly and annual financial reports to the SEC. A company's balance sheet and income statement are included in these reports. By examining how certain numbers from one statement relate to prior statements and how the resulting ratios relate to the company's competitors, the analyst can determine how financially viable the company is. Balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific time. It identifies the value of the company's assets, what it owns, and its liabilities, what it owes. The difference between these two figures is the corporation's owner's equity or net worth. The balance sheet equation is assets equals liabilities plus owner's equity, or assets less liabilities equals owner's equity. Although the balance sheet is useful in determining a company's current value, it does not indicate whether the company's business is improving or deteriorating. The balance sheet gets its name from the fact that its two sides must balance. The balance sheet equation mathematically expresses the relationship between the two sides of the balance sheet. Simply stated, everything that is owned, assets, minus everything that is owed, liabilities, is equal to the net worth, owner's or shareholder's equity of the entity. Assets. Assets appear on the balance sheet in order of liquidity, which is the ease with which they can be turned into cash. Assets that are most readily convertible into cash are listed first, followed by less liquid assets. Balance sheets commonly identify three types of assets: current assets, cash and assets easily convertible into cash; fixed assets, physical assets that could eventually be sold; and other assets, usually intangible and only of value to the corporation that owns them. Current assets. Current assets include all cash and other items expected to be converted into cash within the next 12 months, including the following. Cash and equivalents include cash and short-term safe investments, such as money market instruments that can be readily sold, as well as other marketable securities. Accounts receivable include amounts due from customers for goods delivered or services rendered, reduced by the allowance for bad debts. Inventory is the cost of raw materials, work in process, and finished goods ready for sale. Prepaid expenses are items a company has already paid for but has not yet benefited from, such as prepaid advertising, rents, insurance, and operating supplies. Fixed assets. Fixed assets are property, plant, and equipment. Unlike current assets, they are not easily converted into cash. Fixed assets, such as factories, have limited useful lives because wear and tear eventually reduce their value. For this reason, their cost can be depreciated over time or deducted from taxable income in annual installments to compensate for loss in value. Other assets. Intangible assets are non-physical properties, such as formulas, brand names, contract rights, and trademarks. Goodwill, also an intangible asset, reflects the corporation's reputation and relationship with its clients. Liabilities. Liabilities are a debt of financial obligation that can be categorized as current or long-term. Current liabilities. Current liabilities are those liabilities that are due and payable in the near future, roughly a year. Long-term liabilities. Long-term liabilities are those that are debt that is not due in the immediate future. It normally consists of the corporation's bonds. Net worth. Net worth represents the corporation's invested capital and retained earnings, essentially what the company is worth. Learning Objective 4D classify investment risks. In general terms, the greater the risk the investor assumes, the greater the potential for reward. Representatives should consider all potential risks in determining the suitability of various types of investments. Following are the most common risks. Those that affect all investments are called systematic risks. Those that affect some and not others are non-systematic risks. Business risk, non-systematic. Whether caused by bad management or unfortunate circumstances, some businesses will inevitably fail, even more so during economic recessions. Typically, when a business fails, it liquidates, sells off its assets in a bankruptcy, pays its creditors from the proceeds, and pays whatever is left, if anything, to its shareholders. Business risk is a form of non-systematic risk. It affects companies and industries individually. Business risk can be reduced by diversifying investments. Example: a large manufacturer has just been charged with a major accounting scandal by the SEC. As a result, the company's stock price falls significantly. The scandal does not impact the stocks of other manufacturers in the industry. This is an example of business risk. Inflation risk, systematic. Also known as purchasing power risk or constant dollar risk, inflation risk is the effect of continually rising prices, resulting in less purchasing power for fixed income payments as time goes on. A client who buys a fixed return security, such as a bond, fixed annuity, or preferred stock, may not see the investment keep pace with inflation. Capital risk, non-systematic. Capital risk or principal risk is the potential for an investor to lose all his money, invested capital, under circumstances either related or unrelated to an issuer's financial strength. Timing risk, non-systematic. Even an investment in the soundest company with the most profit potential might do poorly simply because the investment was timed wrong. The risk to an investor of buying or selling at the wrong time and incurring losses or lower gains is known as timing risk. Example, short-term investors are subject to timing risk. If investing on the absolute worst day of the year, in other words, at the very top of the market just before it falls, the average time to recover the lost money has historically taken 3 years. Interest rate risk, systematic. Interest rate risk refers to the sensitivity of an investment's price or value to fluctuations in interest rates. The term is generally associated with debt, i.e., bonds or bond funds, and preferred stocks, as their prices are interest rate sensitive. An inverse relationship exists with these securities. As yields go up, prices go down and vice versa. You must know that the longer a bond's maturity or duration, see the following, the more volatile it is in response to interest rate changes compared with similar short-term bonds. For bonds with short maturities, the opposite is true. Their prices remain fairly stable because investors generally will not sell them at deep discounts or buy them at high premiums. Example, if interest rates go up, the overall price of debt securities, no matter how diversified the debt portfolio is, will decline. Therefore, we can define interest rate risk as a type of systematic risk. Test topic alert. Short-term interest rates are more volatile than long-term interest rates because they change more frequently. The federal funds rate is considered volatile because it changes daily. Make sure you differentiate between the question that is asking about interest rate volatility, short-term is more volatile, versus price volatility, long-term is more volatile. Duration. Duration is another useful tool in bond calculations. It is a measure of the amount of time a bond will take to pay for itself. Each interest payment is taken to be part of a discounted cash flow, so there is more to the calculation than simply adding up the interest payments. For the Series 6, remember that duration is often used to assess the sensitivity of a bond in response to interest rate changes. The longer the duration, the greater the sensitivity and thus the greater the interest rate risk in an environment of changing interest rates. Remember that the duration of an interest-paying bond is always shorter than the time to its maturity because the interest payments can be reinvested and earn additional interest. By way of comparison, the duration of a zero-coupon bond is always equal to the time to its maturity because there is only one payment, the one made when the bond matures. Reinvestment risk, systematic. When interest rates decline, it is difficult for bond investors to reinvest the proceeds from investment distributions and maintain the same level of return at the same level of default risk. Reinvestment risk is mostly associated with bonds that mature or when the issuer calls a bond or preferred stock. Example, in 1979, an investor purchased a 12% 30-year Treasury bond and earned 12% for 30 years. But when that bond matured in 2009, interest rates had dropped to below 5%. The investor could not reinvest his Treasury bond proceeds and get 12% with no default risk anymore. This is an example of reinvestment risk. Market risk, systematic. Both stocks and bonds involve some degree of market risk. The risk that investors may lose some of their principal due to price volatility in the overall market, also known as systematic risk. An investor cannot diversify away market risk. If the entire market is in a tailspin, all of the investor's securities will likely decline. Example, if the S&P 500, an index of 500 large-cap stocks, drops in value by 10%, it is highly likely that every investor who owns a stock portfolio has lost money as well, even if that stock portfolio was composed of many different stocks in many different industries. This is an example of market risk. Test topic alert. Because the market is a system, market risk is a type of systematic risk. Credit risk, non-systematic. Credit risk, also called financial risk or default risk, involves the danger of losing all or part of one's invested principal through an issuer's failure. Credit risk is associated with debt securities, not equity securities, and varies with the investment product. Bonds backed by the federal government or municipalities tend to be very secure and have low credit risk. Long-term bonds involve more credit risk than short-term bonds because of the increased uncertainty that results from holding bonds for many years. Bond investors concerned about credit risks should pay attention to the ratings. Two of the best-known rating services that analyze the financial strength of thousands of corporate and municipal issuers are Moody's Investors Service and Standard & Poor's Corporation. To a great extent, a bond's value depends on how much credit risk investors take. The higher the rating, the less likely the bond is to default, and therefore, the lower the coupon rate. Clients seeking the highest possible yields from bonds might want to buy bonds with lower ratings. Higher yields reward investors for taking more credit risk. There is also a variable price difference between speculative and investment-grade debt, other things such as maturity date being equal. During times of confidence in the economy, the price of an AAA bond and that of a BB bond, for example, will be closer together than during periods of economic uncertainty. This reflects investors' reduced willingness to take risks during periods of uncertainty. Speculative debt is discounted more than during periods of confidence. Bond ratings, bank grade or investment grade bonds, AAA, Standard & Poor's and Moody's, highest rating. Capacity to repay principal and interest judged high. AA, Standard & Poor's and Moody's, very strong, only slightly less secure than the highest rating. A, Standard & Poor's and Moody's, judged to be slightly more susceptible to adverse economic conditions. BBB, Standard & Poor's, or BA, Moody's, adequate capacity to repay principal and interest, slightly speculative. Speculative, or non-investment grade, bonds, BB, Standard & Poor's, or BA, Moody's, speculative, significant chance that issuer could miss an interest payment. B, Standard & Poor's and Moody's, issuer has missed one or more interest or principal payments. C, Standard & Poor's, or CA, Moody's, no interest is being paid on bond at this time. D, Standard & Poor's and Moody's, issuer is in default. Payment of interest or principal is in arrears. Liquidity risk, non-systematic. The risk that a client might not be able to sell an investment and receive its current market value quickly is known as liquidity risk. The marketability of the securities you recommend must be consistent with the client's liquidity needs. Example, it is not always easy or quick to turn real estate or thinly traded securities into cash. Unlisted non-NASDAQ securities are considered thinly traded. Thinly traded securities bring with them liquidity risk. Legislative/political/social risk, non-systematic. Legislative risk exists because federal and state legislatures have the power to change laws, and this can impact securities, companies, negatively and result in capital loss for investors. Risk associated with the possibility of unfavorable government action or social changes resulting in a loss of value is also called social risk or political risk. Political risk is an important risk to discuss when recommending foreign or international investments, as governments outside the United States may not be as stable as ours. Call risk, systematic, related to reinvestment risk. Call risk is the risk that a bond might be called by the issuer before maturity, and investors cannot reinvest their principal at the same or a higher rate of return. Bonds with higher coupon rates are most likely to be called when interest rates are falling. Investors concerned about call risk should look for call protection, a period during which a bond may not be called. Call protection is a period, perhaps 3, 5, or 10 years, etc., and determined by the issuer, during which the investor is protected from the issuer calling the bond in before maturity. Corporate and municipal issuers generally provide some years of call protection. Take note, bond funds can't be called, but the bonds within the bond fund's portfolio can be called. Currency risk, systematic. Currency risk is the risk that changes how the rate of exchange will adversely affect an investment. As a rule of thumb, an investor who purchases an international fund, e.g., a foreign bond fund, will lose if the U.S. dollar appreciates against the foreign currency. The investor will profit if the U.S. dollar weakens, depreciates, against the foreign currency. Learning Objective 4E recalls specific disclosure requirements for certain transactions. Some types of investments and certain transactions present unique risks or costs to customers. When recommending these products or transactions, it is important to provide customers with disclosures specific to the situation. Illiquid investments, investments that are difficult or impossible to sell, liquidate, require that the representative disclose that fact when making a recommendation to a customer. If a customer has expressed a concern about access to her money or has a need for liquidity, an illiquid investment will not be suitable. Options. Though derivative products like options are outside of the scope of the Series 6, the fact that they require special disclosures may be tested. Before a customer account may be approved for options trading, the customer must be provided a disclosure document. Note that mutual funds that use options, option income funds, do not require the delivery of an option disclosure document. It is the fund manager that makes trading decisions, not the customer who owns shares of the fund. Surrender fees and deferred sales charges. It is very important that any sort of charge that occurs at liquidation be disclosed before the purchase is complete. Surrender fees are common with annuities, and deferred sales charges, CDSC or back-end load, are typical of B-share mutual funds. Both FINRA and the SEC have expressed the importance of clear disclosure when a charge is applied at liquidation. Take note, FINRA has stated that it is generally unsuitable to use funds from the hypothecation, borrowing, or liquidation of another asset, like a home, for a securities investment. Knowledge Check 4.1. Question 1. During an economic downturn, a fundamental analyst may be interested in which industry? A. Producers of capital goods, like washers and dryers. B. The technology industry. C. The steel industry. D. The food industry. The answer is D. The food industry is defensive in nature. During an economic downturn, people still eat. Therefore, the food industry would be fairly stable when the economy goes south. Question 2. If a company has the following items on its balance sheet, what is the net worth of the company? Current assets of $1 million, inventory of $300,000, fixed assets of $2 million, liabilities of $2 million, A. $5.3 million, B. $1 million, C. $1.3 million, D. $300,000. The answer is B. Inventory is a part of current assets. Using the standard equation for a balance sheet, assets minus liabilities equals net worth, we can take assets, current assets plus fixed assets, $3 million, minus liabilities, $2 million, equals net worth of $1 million. Using inventory and current assets in the question this way is the sort of trick you may see on the exam. Question 3. Which of the following items would not be important to a fundamental analyst when reviewing a possible investment? A. Which phase the business cycle is in? B. The quality of management. C. The company's market share of its core business. D. The stock's trading range over the last 12 months. The answer is D. The stock's trading range is not what a fundamental analyst looks at when evaluating a company. It is more interested in the company's fundamentals, such as how the current and future economy will impact the industry, quality of management, and market share. Question 4. Investors cannot diversify away which of these risks? A. Business risk. B. Default risk. C. Legislative risk. D. Market risk. The answer is D. An investor cannot diversify away market risk. If the entire market is in a tailspin, all of the investor's securities will likely decline. Question 5. A conservative customer is invested in a large cap, value-managed equity fund. The stock market drops 10% due to a poor economic forecast for the country. Your customer is upset that her conservative mutual fund lost almost as much as the stock market. Which risks does your customer need to understand? Roman numeral 1. Business risk Roman numeral 2. Market risk Roman numeral 3. Systematic risk Roman numeral 4. Non-systematic risk A1 and 3, B1 and 4, C2 and 3, D2 and 4. The answer is C. Both stocks and bonds involve some degree of market risk, the risk that investors may lose some of their principal due to price volatility in the overall market, also known as systematic risk. Question 6. All of the following would be appropriate for a conservative investor seeking income except an immediate fixed annuity. B. An investment-grade corporate bond fund. C. A high-yield bond fund. D. A utility fund. The answer is C. High-yield bond funds are below investment-grade bonds and are considered speculative in nature. They would not be appropriate for a risk-averse investor. Question 7. Which of the following products would not require a specific disclosure regarding liquidation? A. ABC Junk Bond Fund shares. B. Windmill Funds Option Income Fund B shares. C. Gemco Properties Limited Partnership. D. Hansen Insurance Variable Annuity. The answer is A. Class of shares have all the sales charges applied at purchase. There are no charges for liquidation. Class B shares and most variable annuities have surrender charges, and limited partnerships are nearly impossible to liquidate. Lesson 4.2. Suitability and Recommendations. Introduction. Recently, students who passed both the SIE and the Series 6 exam were asked, how would you describe the differences in the two exams? The synopsis of their responses was, the SIE was a lot about the investment products. The Series 6 is much more about how to use them. You should expect questions on the Series 6 exam to be less about how an investment product functions and more on when and how you would recommend a particular investment. This lesson breaks down the information you need to make suitable recommendations and which types of investments match up with your customers' objectives. Take note. Most of the suitability and recommendation questions are concerned with recommendations made to retail customers. Recommendations made to institutional customers must also be suitable and aligned with the institution's objectives. There are a few special considerations when making recommendations to an institutional customer. An institutional customer must have the ability to independently evaluate the recommendation. How much the institutional customer depends upon the recommendation of the registered representative versus exercising independent judgment in evaluating a recommendation. Learning Objective 4F differentiate financial and non-financial considerations in customer circumstances. Check the foundation. If a customer wants to invest but does not have a solid foundation to build an investment portfolio, the foundation should be solidified first. Consider the following before investing. Are insurance needs met? Life. For married couples and parents, life insurance can be a very important consideration. Health. An extended and expensive medical issue can disrupt the best plans. Disability. Closely related to health, disability insurance answers the question of how to pay for things if you can't work. Are there sufficient cash reserves? Typically 3 to 6 months of living expenses. A few of the events that can disrupt a plan are job loss, non-insured medical emergencies, and major home or car repairs. Financial considerations. Before making a recommendation for a new customer, a representative must try to find out as much about that person's financial and non-financial situation as possible. Financial investment considerations can be expressed as a sum of money. Financial questions have answers that show up on a customer's personal balance sheet or income statement. Questions like, "What is your income?" or "How much is your 401k worth?" are examples of financial considerations. The customer's balance sheet. An individual, like a business, has a financial balance sheet, a snapshot of his financial condition at a point in time. A customer's net worth is determined by subtracting liabilities from assets. Liabilities equals net worth. Representatives determine the status of a customer's personal balance sheet by asking questions similar to the following. What kinds of tangible assets do you own? Do you own your home, a car, collectibles, a second home? What are your liabilities? Do you make mortgage payments on your home? Do you make car payments? Do you have any other outstanding loans or regular financial commitments? Do you own any marketable securities? Which types of investments do you currently hold? Have you established long-term investment accounts? Do you have an IRA, KIOG, corporate pension, or profit-sharing plan? Are you contributing to annuities? What is the cash value of your life insurance? What is your net worth? How much of it is liquid? Balance sheet questions will help determine a customer's circumstances and help in understanding their investing history. The account application will contain the most basic information on a customer's financials and is a starting point for gaining a better understanding of her financial situation. The customer's income statement. To make appropriate investment recommendations, representatives must know the customer's income situation. They gather information about the customer's financial responsibilities and future changes by asking questions like, "What is your total gross income? Total family income? How stable is this income? Do you anticipate major changes over the next few years? How much do you pay in monthly expenses? Is this a stable figure? Do you expect a change in this amount over the next few years? What is your net spendable income after expenses? How much of this is available for investment?" Income statement questions can help lead to an understanding of a customer's cash flow and current priorities, again deepening a representative's understanding of the customer's circumstances. Non-financial considerations. Once representatives have an idea of the customer's financial status, they gather information on the non-financial status. A non-financial investment consideration is one that cannot be expressed as a sum of money or a numerical cash flow, e.g., risk tolerance or tax bracket. Non-financial considerations often carry more weight than the financial ones and include the following: age, marital status, number and ages of dependents, employment of family members, current and future family educational needs, current and future family health care needs, risk tolerance, attitude toward investing, and tax status. This list covers many of the most common non-financial considerations, but there can be many more. No matter how much an analysis of a customer's financial status tells the representative about his ability to invest, it is the customer's emotional acceptance of investing and motivation to invest that molds the portfolio. To understand a customer's aptitude for investment, the representative should ask questions similar to the following: What kind of risks can you afford to take? How liquid must your investments be? How important are tax considerations? Are you seeking long-term or short-term investments? What is your investment experience? What types of investments do you currently hold? How would you react to a loss of 5% of your principal, 10%, 50%? Which level of return do you consider good, poor, excellent? Which combination of risks and returns do you feel comfortable with? What is your investment temperament? Do you get bored with stable investments? Can you tolerate market fluctuations, risk tolerance? Test topic alert. A representative's job is to assist customers in meeting their financial objectives. Responsible reps must learn all about the customer's financial situations. Securities laws prohibit unsuitable recommendations. Learning Objective 4G apply suitability standards in customer recommendations. Investment objectives. People have many reasons for investing. Most customers claim that they invest so that their money will grow. With careful questioning, however, representatives may learn that because of tax status, income, or other events, some growth investments are appropriate while others are not. Some of the most common financial objectives that customers have are discussed in the following sections. Preservation of capital. For many people, the most important investment objective is to preserve their capital. In general, when clients speak of safety, they usually mean preservation of capital. Recommendations may include money market mutual funds, CDs, and U.S. government treasuries. A principal-protected fund may also be appropriate if they are looking to invest for a longer time horizon. Current income. Many investors, particularly those on fixed incomes, want to generate additional current income. Traditional debt securities such as corporate, government, municipal bond, and agency securities may provide steady interest income. In addition, many equity securities are purchased for the dividends they produce. Equity investments that produce current income include preferred stocks, utilities, and blue-chip stocks that have a solid dividend-paying history. Let's not forget that there are many pooled investments that can provide income as well, such as income-oriented mutual funds. Take note. People who are in a high marginal tax bracket may be interested in municipal bonds because interest received is exempt from federal taxation. Capital growth, capital appreciation. Capital growth refers to an increase in an investment's value over time. This can come from increases in the security's value. Growth-oriented investments are equity-oriented. Example: when an investor has a time horizon that is 7-10 plus years away, such as retiring or funding a college education, investing for capital appreciation is appropriate. Tax advantages. Investors often seek ways to reduce their taxes. Some products, like IRA and annuities, allow interest to accumulate tax-deferred. An investor pays no taxes until money is withdrawn from the account. Other products, like municipal bonds, offer tax-free interest income. Portfolio diversification. You know the saying, don't put all your eggs in one basket. Investors with portfolios concentrated in only one or a few securities or investments are exposed to much higher risks. For them, portfolio diversification can be an important objective. Mutual funds, by their nature, tend to be diversified. An asset allocation fund includes stocks, bonds, cash, and perhaps hard assets and real estate, making it a good option when it comes to diversification. Also, consider a foreign, international, or global fund to increase diversification for a portfolio that is domestic in nature. Liquidity. Some people want immediate access to their money at all times. A product is liquid if a customer can sell it quickly at face amount or very close to it or at a fair market price. Remember that a liquid investment does not mean you won't lose money on your investment. It simply means you can get the current market value of the investment quickly. Liquid investments include securities listed on an exchange, NASDAQ securities, and mutual funds. Illiquid investments include unlisted, non-NASDAQ stocks or bonds, annuities when initially purchased and / or when the annuitant is under age 59 1/2, real estate and limited partnership units. Example, an investor buys $10,000 of a listed security on the NYSE. The value drops to $9,000 and the investor sells the security and receives $9,000 when the trade settles 2 business days later. The investor lost money on the investment, but the investment was liquid because when he sold it, the current market value was received quickly. Test topic alert. Annuities, particularly when issued, are not considered liquid. Most annuities have a surrender penalty that may last 7-10 years or longer. Speculation. A customer may want to speculate, that is, try to earn much higher than average returns in exchange for higher than average risks. Investors who are interested in speculation may be interested in option contracts, high-yield bonds, unlisted or non-NASDAQ stocks or bonds, sector funds, precious metals, and special situation funds. As a registered representative, one must always determine the suitability of such recommendations. Test topic alert. A bullish investor believes the value of a security will move in a positive direction. A bearish investor believes the value of a security will move in a negative direction. Making a suitable recommendation. When preparing to make a suitable recommendation, a representative should consider primary objective, secondary objectives, and similar investments. Match primary objectives. The first step in determining suitability is to only make recommendations that align with the customer's objectives. Questions that ask you to make a recommendation will have one objective that stands out as the most important. Any investment that does not meet that objective is not suitable. Look for secondary objectives. If you have more than one option that matches the stated primary objective, look for secondary objectives. Often these will be issues around risk tolerance or liquidity, and occasionally just a customer's personal preference. Comparing similar investments. On the exam, if the question expects you to compare 2 similar investments, there are several potential points of comparison. How do the long-term performance and performance over the same time period compare? Does one investment provide a tax advantage the other does not? How volatile are the investments? Is one more volatile than the other? For mutual funds, what is the tenure of the fund managers? For corporations, how do the financials compare? Take note. You will find this chart handy in the next unit and when answering questions about which investment to recommend. Common Suitability Recommendation Guidelines. Below is a list of investor objectives with their recommendations. Preservation of capital/safety, CDs, money market mutual funds, fixed annuities, government securities and funds, agency issues, investment-grade corporate bonds and corporate bond funds, growth, common stock mutual funds, balanced/moderate growth, blue-chip stocks, defensive stocks, aggressive growth, technology stocks, sector funds, income, bonds but not zero coupons, rates, CMOs, tax-free income, municipal bonds, municipal bond funds, Roth IRA, high-yield income, below investment-grade corporate bonds, corporate bond funds, income from stock portfolio, preferred stocks, utility stocks, blue-chip stocks. Liquidity, securities listed on an exchange, NASDAQ stocks or bonds, mutual funds, publicly traded rates. Portfolio diversification, mutual funds in general, more specifically, asset allocation funds and balanced funds. For equity portfolios, add some debt and vice versa. For domestic portfolios, add some foreign securities. For bond portfolios, diversify by region/rating, speculation, option contracts, direct participation programs, high-yield bonds, unlisted/non-NASDAQ stocks or bonds, sector funds, precious metals, commodities, futures. Knowledge Check 4.2. Question 1. All of the following would be a financial consideration except A. Income, B. Debt payments, C. Education. D. Home value. The answer is C. A customer's education level is not something you would find on her balance sheet or income statement. It is a non-financial consideration. All of the others are definable by a dollar amount. Question 2. Which of the following is not a non-financial consideration? A. Tolerance for risk. B. Marital status. C. This semester's tuition bill for a college sophomore. D. Attitudes about debt. The answer is C. A current bill is definable in dollar terms, and a current liability is on the balance sheet. A tuition bill due for the current semester is a financial consideration. The other choices are not easily defined as a dollar amount. Question 3. Which of the following is considered an illiquid investment? A. An exchange-listed stock. B. An interest in an apartment building. C. A mutual fund. D. A 30-year T-bond. The answer is B. An interest in a specific piece of real estate is not going to be easily transferred and is considered illiquid. It is certainly the least liquid investment of the choices provided.
Unit 5. Regulatory Issues. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 5A. Define the three main categories of types of communications with the public, their characteristics, and approval requirements. Learning Objective 5B. Identify other communications by characteristics and approval requirements. Learning Objective 5C. Recall customer complaint procedures. Learning Objective 5D. Recognize the formal resolution methods and disputes reporting requirements, including arbitration. Learning Objective 5B. Identify the use and filing requirements of Forms U4 and U5. Introduction. In Unit 5, we take a look at several important regulatory issues for registered representatives. One of a representative's jobs is communicating with customers and prospects. The rules on communications with the public are a source of several questions on the exam. Customers are not always happy with the services we provide. The industry has specific procedures for resolving disagreements with customers. There is a process for both joining and leaving a FINRA member firm. The use of the U4 form for joining and the U5 form for separating is covered in Unit 5. Your exam will include approximately 10 questions from the topics covered in Unit 5. Lesson 5.1, Communications with the Public. FINRA, as an SRO, has taken the federal requirements on communications with the public and expanded on them in its conduct rules. These rules require that all members observe high standards of commercial honor and just and equitable principles of trade. It is strictly prohibited to make use of any manipulative, deceptive, or other fraudulent devices or contrivances when conducting business with the public. Both FINRA and the SEC rules deal with communications concerning a member's investment banking or securities business. A principal must be familiar with the standards for content, supervisory review and approval, and record-keeping for such material. While the SEC is the main governing body of the entire securities industry in this country, we will focus most on FINRA's rules. All of a member's communications with the public must be based on principles of fair dealing and good faith and provide a sound basis for evaluating the facts in regard to any particular security or type of security, industry discussed, or service offered. No material fact or qualification may be omitted if it could cause the communication to be misleading. Although most of these standards apply to all forms of communications with the public, the principal should be aware of the nuances. Exaggerated or misleading statements are prohibited. In determining whether a communication is misleading, FINRA calls for consideration of the following. Overall context of the statement. A statement that is misleading in one context may be appropriate in another. An essential test in this regard is the balanced treatment of risks and potential returns. Different levels of explanation or detail may be needed, depending on the audience and the ability of the member to control who might come in contact with the communication. Overall clarity of the communication, FINRA warns that unclear statements can create serious misunderstandings to the point of constituting a rules violation. Take note, overly technical explanations or material disclosures buried in footnotes are likely to confuse the reader and could be seen as misleading. FINRA provides definitions and categories that differentiate the various types of communications for which the principal is responsible. The definitions of communication with the public are classified into three categories: institutional communications, retail communications, and correspondence. The application of the rules differs depending on the category of a particular communication. For this reason, a principal of the firm must be able to determine what fits where. Learning Objective 5 define the three main categories of types of communications with the public, their characteristics, and approval requirements. In accordance with FINRA, there are three categories of communications: institutional communication, retail communication, and correspondence. Institutional communication. Institutional communication is any written, including electronic, communication that is distributed or made available only to institutional investors, but does not include a member's internal communications, e.g., internal memos. For purposes of this rule, the term institutional account means the account of a bank, savings and loan association, insurance company, or registered investment company. An investment advisor registered either with the SEC under Section 203 of the Investment Advisors Act or with a state securities commission or any agency or office performing like functions, or any other person, whether a natural person, corporation, partnership, trust, or otherwise, with total assets of at least $50 million. FINRA mandates that no member may treat a communication as having been distributed to an institutional investor if the member firm has reason to believe that the communication or any part of it will be forwarded or made available to any retail investor. Each firm must establish if they will require principal approval of institutional communication before use or allow post-use review. If a PD does not require prior principal approval, it must provide for and document education and training of associated persons regarding institutional communication. Retail communication. Retail communication is any written, including electronic, communication that is distributed or made available to more than 25 retail investors within any 30 calendar day period. A retail investor is any person other than an institutional investor, regardless of whether the person has an account with the member. A copy of all retail communication must be filed with FINRA. More specific information on the filing requirements are in Learning Objective 5B. Take note. The requirement is that a member firm send a copy of retail communications to FINRA for filing. This is not an approval process, just a file copy of the communication. Rules require that all retail communication receive principal approval before use or filing with FINRA. However, the requirement to have a principal-approved retail communication does not apply if, at the time that the firm intends to distribute it, another member has filed it with FINRA's advertising department and has received a letter from the department stating that it appears to be consistent with applicable standards, and the member using it in reliance upon the letter has not materially altered it and will use it in a manner that is consistent with the conditions of the department's letter. The requirement of prior principal approval generally will not apply with regard to what is posted to an online interactive electronic forum or any retail communication that does not make any financial or investment recommendation or otherwise promote a product or service of the member. Test topic alert. If they are not institutional customers, they are retail customers. Correspondence. Correspondence is any written, including electronic, communication that is distributed or made available to 25 or fewer retail investors within any 30 calendar day period. Like institutional communication, each firm must establish if it will require principal approval of correspondence before use or allow for post-use review. If a PD does not require prior principal approval, it must provide for and document education and training of associated persons regarding correspondence. Take note. All incoming correspondence must be reviewed by a principal. This is primarily aimed at potential complaints, which require a principal's oversight, and to detect potential fraud or other inappropriate activities. Test topic alert. All public communications require the name of the member firm to be disclosed in the communication. There is a prominent exception to this rule: recruiting advertising. A firm is not required to disclose the firm's name if the communication is used to attract potential employees. However, the general rule regarding honesty and fairness still applies. Social media use. Regarding the use of social media and online activities, firms are required to monitor the business-related social media presence of all representatives. Most static content, such as a website or blog, typically must be approved by a registered principal before use, and sometimes may be required to be filed with FINRA. There is no requirement to pre-approve individual posts in interactive online forums, but firms must have policies and procedures in their written supervisory procedures concerning these activities. Representatives may use social media platforms to engage with both existing customers and prospective clients. Learning Objective 5b identify other communications by characteristics and approval requirements. In addition to the 3 kinds of communications with the public, there are several other types of communications you should be aware of. Public appearance. Public appearance is participation in a seminar, webinar, forum, including an interactive electronic forum such as a chat room, radio or television interview, or other public appearance or public speaking activity. Each member firm needs to establish written procedures to supervise an associated person's public appearances. Each firm determines if pre-approval by a principal will be required or not. The firm's procedures must provide for the education and training of associated persons who make public appearances as to the firm's procedures, documentation of such education, and follow-up supervision to see that procedures are followed is required. Evidence that these supervisory procedures have been implemented and carried out must be maintained and made available to FINRA upon request. Any scripts, slides, handouts, or other written, including electronic materials used in connection with public appearances, are considered retail communications for purposes of this rule, and members must comply with this rule. If an associated person recommends a security in a public appearance, the associated person must have a reasonable basis for the recommendation. The associated person also must disclose any conflicts of interest that may exist, such as a financial interest in any security being recommended. Independently prepared reprint. An independently prepared reprint, IPR, consists of any article reprint that meets certain standards designed to ensure that the reprint was issued by an independent publisher and was not materially altered by the member. To qualify as an IPR, the following criteria must be met. A member may alter the contents of an IPR only to make it consistent with applicable regulatory standards or to correct factual errors. Its publisher is not an affiliate of the member using the reprint or any underwriter or issuer of a security mentioned in the reprint. Neither the member using the reprint nor any underwriter or issuer of a security mentioned in the reprint may have commissioned the reprinted article. IPR are approved according to how they will be used. If used for institutional customers, they are approved under institutional communication rules. If used as retail communication, they require pre-approval by a principal of the firm. However, IPR are exempted from the FINRA filing and spot check requirements. Research reports. A research report is a document prepared by an analyst or strategist, typically as part of a research team for an investment bank or BD. The report may focus on an individual stock or sector of the economy and generally, but not always, will recommend buying, selling, or holding an investment. FINRA has established rules designed to improve the objectivity of research reports and provide investors with more useful and reliable information when making investment decisions. Members must take steps to ensure that all research reports reflect an analyst's honest view and that any recommendation is not influenced by conflicts of interest, such as investment banking business with the issuer. If a member issues a report or a research analyst renders an opinion that is inconsistent with the analyst's actual views regarding a subject company, FINRA considers such action fraudulent. To ensure the investing public receives objective information from the media and publications, the rule requires the following. Firms must clearly explain their rating systems, use rating terms according to their plain meaning, note the percentage of all ratings they have assigned to each category, e.g. buy/sell/hold, and document the percentage of investment banking clients in each category. Analyst compensation may not be tied to the firm's investment banking revenues. Analysts must disclose in their research reports and public appearances whether they or any member of their households have a financial interest in the subject security and whether their employer firms own 1% or more of any class of a subject company's equity securities at the close of the previous month. Research reports must disclose whether, within the last 12 months, the firm has received fees for investment banking services from or managed or co-managed a public offering for a company that is the subject of a research report. They must also disclose whether the firm expects to receive or intends to seek in the 3 months following publication of a research report any investment banking fees from any company that is the subject of a report. An investment advisor or a BD may not present to a client research reports, analyses, or recommendations prepared by other persons or firms without disclosing the fact that the advisor or BD did not prepare him. An advisor or a BD may base a recommendation on reports or analyses prepared by others, as long as these reports are not represented as the advisor's or broker-dealer's own. Take note. The following items fall outside the definition of research reports: discussions of broad-based indices, commentaries on economic, political, or market conditions, technical analyses concerning the demand and supply for a sector, index, or industry, based on trading volume and price, statistical summaries of multiple companies' financial data, including listings of current ratings, notices of ratings or price target changes, electronic communications with the public. Although not classified as a specific type of communication, with the growth of the Internet and the rise of electronic communications in general, it has been necessary for FINRA to bring electronic communications in the securities industry into the regulatory framework. Websites, whether sponsored by the company itself or set up by an individual registered representative, are considered retail communications and are subject to applicable filing and record-keeping rules. They must be reviewed and approved by a principal before first use and must contain no exaggerated claims or misleading information. Members may indicate FINRA membership on a member's website, provided that the member provides a hyperlink to FINRA's homepage, www.finra.org, in close proximity to the member's indication of FINRA membership. This provision also applies to a website relating to the member's investment banking or securities business maintained by or on behalf of any person associated with a member. Electronic bulletin boards are also considered retail communications, but a registered representative using one or a chat room need not identify herself as a registered person. Use of an online interactive forum by a registered representative must be approved by a principal, although each post does not require principal approval. The communications must be held to normal standards of accuracy and completeness. Individual emails to customers fall under the definition of correspondence and are subject to the appropriate standards of conduct and supervision. Instant messaging could qualify as retail communication or correspondence, depending on the size and identity of the audience. Test topic alert. Regulations are clear. Firms must have established procedures to maintain, review, and supervise communications transmitted via blogs, email, instant messaging, texts, Twitter, Facebook, and whatever new communication form is coming our way. Generic advertising, SEC Rule 135A. Generic advertising promotes securities as an investment medium but does not refer to any specific security. Generic advertising often includes information about the securities investments that companies offer, the nature of investment companies, services offered in connection with the described securities, explanations of the various types of investment companies, descriptions of exchange and reinvestment privileges, and where the public can write or call for further information. All generic advertisements must contain the name and address of the sponsor of the advertisement, but never include the name of any specific security. A generic advertisement may be placed only by a firm that offers the type of security or service described. Communications regarding variable life insurance and variable annuities. The following standards apply to all communications related to variable life insurance and variable annuities, in addition to the general FINRA standards governing communications. These standards are applicable to advertisements and sales literature, as well as individualized communications such as personalized letters and computer-generated illustrations, whether printed or made available on screen. Product communications. All communications must clearly describe the product as either variable life or a variable annuity, as applicable. Proprietary names may be used in addition to these descriptions. There may be no implication that the product being offered or its underlying account is a mutual fund. Liquidity. Because variable life insurance and variable annuities frequently involve substantial charges and / or tax penalties for early withdrawal, there may be no representation or implication that these are short-term, liquid investments. Any statement about the ease of liquidation of these products must be accompanied by the negative impact of factors such as contingent deferred sales loads, tax penalties, and the impact on cash value and death benefits. Guarantees. Although insurance products contain a number of specific guarantees, the relative safety of the product from the use of these guarantees cannot be overemphasized. The guarantee is supported by the insurance company, and that depends on the claims-paying ability of the insurance company. There may be no representation or implication that a guarantee applies to the investment return or principal value of the separate account. Also, it may not be represented or implied that an insurance company's financial ratings apply to the separate account. Although the rating firms, Standard & Poor's and Moody's Investor Service, offer ratings on the financial health of insurance companies, the primary source used by almost everyone in the insurance industry is AM Best. An OR Plus rating from them signifies substantial ability to meet their claim obligations. Fund performance predating inclusion in a variable product. Illustrations are sometimes used to show how an existing fund would have performed as an investment option within a variable life or variable annuity policy. Performance that predates a fund's inclusion may be used only if no significant changes occur to the fund at the time or after it became a part of the variable product. Single premium variable life. Communications regarding single premium variable life may only emphasize investment features of this product if an adequate explanation of the life insurance features is also provided. Hypothetical illustrations of rates of return in variable life insurance. Hypothetical illustrations showing assumed rates of return may be used to demonstrate the performance of variable life policies. Rules that apply to the use of these illustrations include the following. Hypothetical illustrations cannot be used to project or predict investment results. Illustrations may use any combination of assumed investment, returns up to and including a gross rate of 12%, provided that one of the returns is a 0% gross rate. The maximum rate illustrated should be reasonable considering market conditions and the available investment options. Illustrations must reflect the maximum mortality and expense charges associated with the policy for each assumed rate of return illustrated. Current charges may also be illustrated. In general, variable life product performance may not be compared to other investment products. However, comparison of variable life to a term insurance product is permitted to demonstrate the concept of tax-deferred growth resulting from investment in the variable product. Record-keeping and filing requirements. A separate file containing all retail communications and IPR, including the names of the persons preparing and approving their use, must be maintained for 3 years from the date of last use. The supervision rule also establishes record-keeping requirements for correspondence. Each member must retain copies of its registered representative's correspondence according to the record-keeping rule, Rule 3110, and SEC record-keeping rules, Rules 17A3 and 17A4. Outgoing electronic securities business correspondence is subject to the 3-year requirement as well. Filing requirements. When a firm becomes registered with FINRA, during the first year of operation, FINRA will require the member to file any retail communication that is published or used in any electronic or other public media, e.g., any generally accessible website, newspaper, magazine, or other periodical, radio, television, telephone or audio recording, video display, sign or billboard, motion picture, or telephone directory, other than routine listings, with FINRA at least 10 business days before first use for filing. A member firm that has completed the first year of registration is sometimes referred to as an established firm and may file retail communications relating to investment companies, including mutual funds, variable contracts, and UIT, within 10 business days of first use, a post-filing, meaning after use. Take note, whether a first-year firm or not, retail communications for investment companies, including mutual funds, variable contracts, and UIT, that include a ranking or comparison that is generally not published or is the creation of the investment company, or the member must be filed with FINRA at least 10 business days before first use for filing. If the ranking or comparison is generally published or is the creation of an independent entity, e.g., Lipper or Morningstar, the usual filing rules will apply, i.e., within 10 business days of first use, post-filing, spot checks. Each member's retail communications are subject to routine spot checks. Members must comply with written requests for such material by FINRA. Material filed previously with FINRA under this rule need not be resubmitted. Exemptions from filing and spot check requirements. Certain types of communications are excluded from the filing and spot check requirements described previously. These exemptions include retail communications that previously have been filed with the department and that are to be used without material change. Retail communications that do not make any financial or investment recommendation or otherwise promote a product or service of the member. Retail communications that do no more than identify a national securities exchange symbol of the member or identify a security for which the member is a registered market maker. Retail communications that do no more than identify the member or offer a specific security at a stated price. Press releases that are made available only to members of the media. Any reprint or excerpt of any article or report issued by a publisher, IPR. Correspondence. Institutional communications. Communications that refer to types of investments solely as part of a listing of products or services offered by the member. retail communications that are posted on an online interactive electronic forum, and press releases issued by closed-end investment companies that are listed on the NYSE. Take note, if FINRA believes a member's retail communication has departed from acceptable standards, it can mandate profiling of any communications with the public. Networking arrangements between members and financial institutions. As part of supervision of communication with the public, there are special rules where a member BD is in a networking association with a financial institution, such as a bank. In these cases, FINRA gives guidance through its Rule 3160 as to the conditions and association. For example, when a member conducts BD services on the premises of a financial institution, the firm must first and foremost be clearly identified as the person providing BD services and distinguish its BD services from the services of the financial institution. Conduct its BD services in an area that displays clearly the member's name, and to the extent practicable, maintain its BD services in a location physically separate from the routine retail deposit-taking activities of the financial institution. Customer disclosures of networking arrangements. At or before the time that a customer account is opened by a member that is a party to a networking arrangement, the member has to disclose in writing to each customer that the BD services are being provided by the member and not by the financial institution, and that the securities products purchased or sold in a transaction are not insured by the FDIC, not deposits or other obligations of the financial institution, and are not guaranteed by the financial institution, and subject to investment risks, including possible loss of the principal invested. The disclosures required by this rule also must be made verbally by a representative of the firm that is a party to a networking arrangement for any customer account opened on the premises of a financial institution. When communicating with the public, the member must make sure everyone knows it is the member who is providing the services. That aspect is especially true for customer confirmations and account statements. All members have to indicate clearly that the BD services are being provided by the member and not the institution. If the member announces the location of a financial institution, e.g., the bank address, where BD services are provided by the member, the same disclosures as covered must be included in the communication. FINRA specifically identifies the retail communications used to make that announcement, such as radio or television broadcasts, automated teller machine, ATMs, screens, billboards, signs, posters, and brochures. Following are the disclosures in simplified form that can be used in communications. This condensed version of the disclosures in short communications can help fulfill the requirement that they must be easy to see. Not FDIC insured, no bank guarantee, may lose value. There are times, however, when those disclosures are not required, as long as the communications is not misleading. The disclosures are not required in messages contained in radio broadcasts of 30 seconds or less. Electronic signs, excluding messages contained in television ads, online services or ATM, and signs, such as banners and posters, when used only as location indicators. Communications about investment companies. FINRA rules state that members may not use investment company rankings in any retail communication other than 1. Rankings created and published by ranking entities, or 2. Rankings created by an investment company or an investment company affiliate, but based on standard performance measurements. Required disclosures of investment company rankings. A headline or other prominent statement must not state or imply that an investment company or investment company family is the best performer in a category unless it is ranked first in the category. Other disclosures include the name of the category, e.g., growth, the name of the ranking entity, and, if applicable, the fact that the investment company or an affiliate created the category or subcategory. Criteria on which the ranking is based, e.g., total return, risk-adjusted performance, the fact that past performance is no guarantee of future results, and a ranking based on total return must be accompanied by rankings based on total return for 1 year, 5 years, and 10 years, or since inception, if shorter. Requirements for the use of bond mutual fund volatility ratings. According to FINRA, the term bond mutual fund volatility rating is a description issued by an independent third party relating to the sensitivity of the NAV of a portfolio of an open-end management investment company that invests in debt securities to changes in market conditions and the general economy, and is based on an evaluation of objective factors, including the credit quality of the fund's individual portfolio holdings, the market price volatility of the portfolio, the fund's performance, and specific risks, such as interest rate risk, repayment risk, and currency risk. These ratings may not describe volatility as a risk rating. The name of the entity that issued the rating must be disclosed along with the date of the current rating. A link to a website that includes the criteria and methodology used, a statement that there is no standard method to determine the rating, a description of the types of risk the rating measures, e.g., short-term volatility, and a statement that there is no guarantee the fund will continue to have the same rating or perform in the future as rated. Take note, disclosure documents, such as a statutory prospectus, summary prospectus, or statement of additional information, are not prepared by member firms. They are prepared by the issuer. As such, they are not subject to approval by a principal. Knowledge Check 5.1. Question 1. Which of the following is not one of the three general classes of communication with the public? A. Institutional. B. Retail. C. Correspondence. D. Educational. The answer is D, though communication may be educational. The three classes of communication are institutional, retail, and correspondence. Question 2. Seco Securities is a new FINRA member firm. They are preparing a new marketing campaign, including a mass mail advertisement. The advertisement must be filed with A. FINRA within 10 days of first use. B. The SEC within 10 days of first use. C. FINRA at least 10 days before use. D. The SEC at least 10 days before use. The answer is C. A new member firm is required to file a copy of all retail communication with FINRA at least 10 days before use. The filing with FINRA is just a record. No approval from FINRA is required. Question 3. Which of the following requires that the communication was issued by an independent publisher and not materially altered by the member? A. IPR. B. Research report. C. A website article. D. A script for a public appearance. The answer is A. Independently prepared reprints, IPRs, are issued by an independent publisher and were not materially altered by the member. A member may alter the contents of an IPR only to make it consistent with applicable regulatory standards or to correct factual errors. Question 4. If a firm wanted to promote securities as an investment medium without referring to any specific security, it would likely use which of the following? A. Generic advertising. B. An independent generic research report. C. A generic website post. D. A blind ad. The answer is A. Generic advertising doesn't promote a specific investment, just investing in general. Question 5. Company-sponsored websites, set up by an individual registered representative, are considered advertisements. B. Speculative and may be pre-approved by the representative before first use. C. Correspondence. D. Retail communications. The answer is D. These static, web-based ads are treated as retail communications. Lesson 5.2. Customer Complaint Resolution. Introduction. In a complex and fast-paced industry like ours, there will be mistakes and misunderstandings. When customers, PDs, associated persons, and other organizations clash, there are processes and procedures in place to fairly resolve disagreements. Similarly, there are procedures for handling violations of the regulations in a way that is fair to all parties and provides protection for investors. One way that FINRA attempts to reduce potential harm to customers is by applying strict guidelines on who may be licensed and setting ongoing expectations for ethical conduct for registered representatives and member firms. Learning Objective 5C Recall Customer Complaint Procedures. When a customer delivers a written complaint to the representative of a firm, the first step is to immediately forward the complaint to a principal of the firm. Registered representatives should not attempt to resolve a complaint. All such activities should be performed by a principal. Complaints that are not delivered in writing, oral complaints, do not have standing in the regulations. Although member firms will have internal procedures for handling these complaints, they will vary from firm to firm. As each firm sets these rules, they cannot realistically be tested. Test Topic Alert. For test purposes, only written complaints have regulatory standing. Note that written does not only mean paper, but also includes emails, text messages, instant messages, social media posts, Twitter, and so on. If it is letters organized into words, it's written. Record keeping and filing. All firms are required to maintain records concerning written complaints for a minimum of 4 years after resolution. Member firms are also required to submit a quarterly statistical and summary report on all written customer complaints to FINRA. Withdrawing a complaint. If after speaking with a principal, a customer chooses to withdraw a written complaint, a record of the complaint and its resolution must still be maintained by the firm. Also, the complaint will be included in the firm's quarterly report to FINRA. Availability of manual to customers. FINRA wants all customers to have access to the rules of the industry. As such, they require all members to make available a current copy of the FINRA Procedures Manual for examination by customers upon request. However, they do take into consideration that we work in a digital world, so members may comply with the rule by maintaining electronic access to the FINRA Manual and providing customers with the access upon their request. Take note, for FINRA's purposes, customer includes any person other than a BDEV with whom the member has engaged or has sought to engage in securities activities, and complaint includes any written grievance by a customer involving the member or person associated with a member. All complaints received by the registered representative must promptly be transmitted to the supervising principal. Furthermore, complaint records must be kept for 4 years. Mediation. An alternate dispute resolution process and a reasonable, inexpensive first step is mediation. FINRA encourages mediation be attempted before an arbitration hearing. If both parties agree to mediation, a meeting may be held in an attempt to work out a settlement. A mediator is selected to preside over the discussions and to assist the parties, if possible, in reaching their own solution. If mediation is unsuccessful, an arbitration hearing is conducted. A mediator is prohibited from serving on an arbitration panel regarding any matter in which that person served as mediator. Sometimes, parts of a dispute settle in mediation, leaving fewer differences to be settled in arbitration, which can translate into savings of time and money. The issue is settled when the Memo of Understanding MOU is signed. Practice question. FINRA encourages that members in a monetary dispute attempt to settle the disagreement before entering into arbitration. This process is called adjudication. B. Pre-arbitration. C. Mediation. D. Hypothecation. The answer is C. In mediation, the parties attempt to work out a resolution to the dispute with the help of a third-party mediator. Mediation is non-binding, and either party may walk away from the attempt. Learning Objective 5D recognize the formal resolution methods and disputes reporting requirements, including arbitration. If parties in a dispute are unable to find a resolution, they may take the dispute into FINRA's arbitration procedure. FINRA arbitrations are governed by the Code of Arbitration Procedure, sometimes referred to as the Code of Arbitration. Code of Arbitration Procedure. The Code of Arbitration Procedure was originally established to mediate unresolved industry disputes. It was mandatory in controversies involving a member against another member or registered clearing agency, a member against an associated person, and an associated person against another associated person. Today, virtually all new account forms contain a pre-dispute arbitration clause that must be signed by customers before account opening. Thus, assuming the customer has signed the arbitration agreement or the new account form containing the pre-dispute arbitration agreement, unresolved customer complaints must be resolved under the Code of Arbitration Procedure. Take note, in the absence of a signed arbitration agreement, a customer can still force a member to arbitration, but a member cannot force a customer to arbitration. Class action claims are not subject to arbitration. In addition, claims alleging employment discrimination brought against a member firm by its own employees, including sexual harassment claims, are not required to be arbitrated unless the parties agree. The advantages of arbitration over suits in state or federal courts are savings of time, money, and the fact that all decisions are final and binding. No appeals are allowed. One party may not like the result, but the dispute is settled. Take note, if customers request to see the pre-dispute arbitration agreement they have signed, a member firm must supply them with a copy within 10 business days of the request. Initiation of proceedings. Any party to an unresolved dispute may initiate proceedings by filing a claim with the Director of Arbitration of FINRA. The statement of claim must describe in detail the controversy and dispute, include documentation in support of the claim, and state the remedy being sought, dollar amount. The claimant must also include a check for the required claim filing fee. The director will then send a copy of the claim to the other party respondent. The respondent then has 4 to 5 calendar days to respond to both the director and the claimant. The answer must specify all available defenses and any related counterclaim the respondent may have against the claimant. A respondent who fails to answer within 4 to 5 days may, at the sole discretion of the director, be barred from presenting any matter, arguments, or defenses at the hearing. If the dispute involves irreparable injury to one of the parties, that party may seek an interim injunction or permanent injunction. The party seeking relief must make a clear showing that its case is likely to succeed on its merits, and that it will suffer permanent harm unless immediate relief is granted. Selection of arbitrators. FINRA maintains a list of arbitrators divided into two categories, non-public and public. Non-public arbitrators are as follows: any persons who worked in the financial industry for any duration during their careers, including persons associated with a mutual fund or a hedge fund and persons associated with an investment advisor, will always be classified as non-public arbitrators. Any professional, like lawyers and accountants, who regularly represents or provides services to investor parties in disputes concerning investment accounts or transactions, including attorneys, accountants, or other professionals, whose firms earned significant revenue from representing individual and/or institutional investors relating to securities matters, are classified as non-public arbitrators. However, for these individuals, waiting 5 years, cooling off period, after ending the affiliation based on their own activities, or 2 years after ending an affiliation based on someone else's activities, reclassifies and allows them to serve as public arbitrators. Public arbitrators are any persons who do not meet the definition of non-public arbitrator. They may serve as a public arbitrator. Arbitration thresholds and simplified arbitration. For both the customer and the industry codes, the following threshold rules apply. $50,000 or less, one arbitrator. No meeting is required. Parties submit their information in writing. This is a simplified arbitration. Greater than $50,000 and up to and including $100,000. One arbitrator, unless both parties agree to 3 greater than $100,000. 3 arbitrators unless both parties agree to 1 awards. All monetary awards must be paid within 30 days of the decision date. Any award not paid within this time will begin to accrue interest as of the decision date. In addition, all awards and details on the underlying arbitration claim are made publicly available by FINRA. Statute of limitations. No claim is eligible for submission to arbitration if 6 years or more have elapsed from the time of the event giving rise to the claim. Code of procedure. The Code of Procedure deals with alleged violations of FINRA rules, MSRB rules, and federal securities laws. If after an investigation or audit, FINRA believes a member or its associated persons has violated one or more rules or laws, the Department of Enforcement will issue a formal complaint. With the filing of a complaint, the Department will name a hearing officer to preside over the disciplinary proceeding, hearing, and will appoint panelists to serve as a jury. All panelists in Code of Procedure hearings are from the industry. The respondent has 25 days after receiving the complaint to file an answer with the hearing officer. Answers must specifically admit, deny, or state that the respondent does not have sufficient information to admit or deny. Take note, if a complaint is filed by FINRA against a registered representative, it is not unusual for that person's designated supervisor, e.g., branch manager, to be charged as well for failure to supervise. Hearing. At the hearing, which resembles a courtroom proceeding, the prosecution, Department of Enforcement, proceeds first. Cross-examination of witnesses is permitted. FINRA may require a firm or registered representative to provide oral information, testify under oath, and provide access to books and records. At the conclusion, panelists convene and, within 60 days, render a written decision reflecting the majority view. Sanctions. Sanctions against a member or associated person, if found guilty, are included with the written decision. Under the Code of Procedure, sanctions could include censure, fine, suspension of the membership of a member or suspension of the registration of an associated person for a definite period, not to exceed 2 years, expulsion of the member, canceling the membership of the member, barring an associated person from association with all members, and imposition of any other fitting sanction. Regarding suspension, if an associated person is suspended, that person cannot remain associated with the member in any capacity, including a clerical or administrative capacity. During the suspension period, that person cannot remain on the member's premises. Also, the member is prohibited from paying a salary, commission, or remuneration that the person might have earned during the suspension period. Appeals. If either side is displeased with the decision, an appeal may be made to the National Adjudicatory Council, NAC. Any appeal must be made within 25 days of the decision date, otherwise the decision is final. If no satisfaction is received from the NAC, The appealing party may take the case to the SEC. Again, if turned down, the appealing party has the right to continue the appeal process by taking its case to the federal court system. Appealing a decision stays the effective date of any sanctions other than a bar or expulsion. Knowledge Check 5.2. Question 1. When addressing customer complaints, FINRA may require the firm or representative to do all the following except A. Provide information orally. B. Give testimony under oath. C. Provide access to any books. D. Testify in front of a grand jury. The answer is D. A grand jury is established to decide whether to bring criminal charges or an indictment against a potential defendant. This is usually reserved for serious felonies and is outside the scope of FINRA. Question 2. A customer accusation of churning an account will be aligned with the firm's directives of resolving issues. B. Mediated under the Code of Arbitration Procedure. C. Resolved through the Code of Procedure. D. Brought before the proper panel via legal representation. The answer is C. Trade practice violations are handled through the Code of Procedure. Monetary disputes are handled through the Code of Arbitration. Question 3. Non-public arbitrators meet which of the following criteria? A. Any person who worked in the financial industry for any duration. B. Private persons who were not associated with a mutual fund. C. An attorney who has represented a broker-dealer in a civil case once in the last 5 years. D. A retail investor who has filed a complaint against a broker-dealer in the last 2 years. The answer is A. Any person who has worked in the financial industry for any duration during their careers will always be classified as non-public arbitrators.